Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from credit-worthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
Good morning and welcome to this very first Better Investor Conference, and this is Moneyweb's first conference and hopefully a series of these Better Investor Conferences to assist normal people to become better investors. Over the next 2 days we will hear from 27 investment experts about their views and insights, and hopefully get a few tips as well of how to navigate the difficult investment world and hopefully help people to build and start a journey to build wealth for the future. I would like participants and viewers to participate in this conference. Send questions to events@moneyweb.co.za or just type in a question on the YouTube channel, and throughout the panels we will put those questions to the panelists and hopefully get some fantastic answers. So without further ado, over to the first panel. And please enjoy this conference. I believe it will add a lot of value to viewers, and hopefully it starts the journey to a better investment future.
Good morning, I'm Simon Brown, host of Moneyweb Now, and hosting the first session of the Moneyweb Better Investment Conference. As Greg said there, we've got 2 days of guests. I'm kicking off. I've got Sepa Madiba, Craig Gradage. We're going to be talking mechanics of investing. It's been a tough 2022 so far, and I think in many senses that's as good a reason as any to maybe go back to the basics, good to revisit some of what we need to understand around investing, what we should be looking for. These are the sort of questions we're going to be delving into. Also, we're going to touch on what do we do about some of those stocks in your portfolio which really you're wishing you'd never met and you'd never bought at all. Is there anything we can do perhaps beyond just selling them and moving on from them? But let me introduce my guests. Sepa Madiba, CIO at Cannon Asset Managers. Sepa's been in the industry since 2007, Siriti Asset Management Advisories and Capital. Also spent some time at Investment Solutions. And Craig Gradage, co-founder, executive director and CIO at Gradage Mahora Investments. Craig's been in the industry since 1996. Gents, welcome to you both. You both came into the industry, excuse me, shortly before collapses, SEPO 2008, Craig 1998. I remember 1998, the Asian tigers and the like. Craig, what we're seeing in the market at the moment so far this year is kind of what markets do. I mean, I know it feels new because we haven't had anything in some time. We've had a decade of low inflation, low rates, quantitative easing, but really selling off in bear markets is just stock markets.
Yes, good morning, Simon. Good morning to the listeners. I think, what we see is nothing new. The reason why the markets are falling at the moment may differ to previous crashes,
Sure.
But it's a function of how markets work. A bit of excess builds up over time, and reality strikes, and a lot of that enthusiasm comes out of the markets, and markets start to fall. So there were a lot of excesses in the last, I would say, particularly the last 2 years post-COVID, low interest rates. So people were disincentivized from investing or keeping their money in the bank. If you're looking for yield, bond yields were quite low. In fact, at one stage, the majority of global bonds, or at least I think 50% of global bonds, were offering negative yields. Something we haven't seen, or I certainly haven't seen in the 20-odd years I've been in markets. So when you have those sort of that sort of environment, it's expected that you'll see equity valuations run way ahead of where they should be, and now there's a bit of pullback.
Seppo, the pullback's not bad. I mean, it's scary. I was saying to you before we came on, at least we're all in the same boat. This isn't, even the crypto folks are taking some pain, and we're going to have a bunch of sessions on crypto later today. This is, in the classic sense, opportunity. And I know it's easy for us to sit here and say that, but to Craig's point, I mean, there were some stocks out there, particularly I'm thinking the big tech in America, which really were at what we can politely call lofty valuations. A bit of normality and a bit of sort of common sense returning to the market maybe makes it a little more harder, but a little bit easier. Harder in the sense that now we've got to go and pick stocks rather than just buy the new tech stock. But easier because now there's some stocks at valuations we can get our head around.
I think that makes a lot of sense. I think to your point and Craig's point, the market continuously is a play-off between, I guess, two underlying themes. The first being mean reversion, which is that markets at some point revert back to long-term averages, and then structural changes, which is almost the exact opposite. And when assessing a stock, a company, a sector, you continuously have to balance off those two factors. And big tech over the course of the last decade is exactly that. The reality is, operationally, those businesses have done phenomenally well, and have warranted investors to pay attention and for them to rally. But to your point, the markets overreact one way or the other. And in this environment, if you have the stomach for it, it does present opportunities to look at some sectors that have traditionally been overlooked. Well, I say traditionally, over the course of the last decade, overlooked. And some companies where I certainly didn't think we'd get the opportunity to own.
In the price. I want to touch on your point around mean reversion, and I get the concept around it. Does it mean that the returns of the decade ahead, and I appreciate that a decade is a long time and the future is unknown, but theoretically does it mean that the decade ahead we're probably going to see lower returns than we saw in the past decade, particularly if we're starting to see rates rise, which means there's an opportunity for me to go into good old-fashioned cash and earn some return there, whereas for much of the last decade, certainly globally, you weren't.
I think it really is a function of where you look, right? So I think the pockets of the market that have done well over the course of the last decade, is there scope for significant rallying in that going forward? Perhaps not. But as always, the market is quite broad, and depending on where you focus, there's businesses that are likely to do well, and markets indeed.
Okay, so I suppose it comes to the point that there's always going to be some opportunity. The job perhaps to find it is to find it. Great, let's sort of go right back to the beginning. Principles investing, that surely starts with having a plan, having a strategy, and that will be broadly the same for everybody, which is, put some money aside every month, but of course going to be nuanced as to your own personal circumstances. Perhaps kids heading to school, perhaps nearing retirement, perhaps a first job, but having a long-term plan in place around the stock market and ultimately that wealth creation.
Yeah, that's the starting point, is to have understand what it is that you're trying to achieve from your investment, because ultimately that will determine the strategy that you need to adopt to achieve what you're trying to achieve. So your money needs to serve you and to serve the lifestyle that you want and to help you achieve the objectives that you have. And that's the one thing we find with a lot of investors when speaking to prospective clients for the first time. You say, well, I've got R1 million to invest. And you say, okay, great, what do you want to achieve with it? I don't know.
2 million.
Yeah. So it's that whole, I think the SMART acronym is what people use to define their objectives. It must be specific. Is it for retirement? Is it for kids' education? As you said, is it for a trip around? Whatever the case may be, needs to be measurable. It needs to be achievable. It needs to be realistic. I've had somebody email me and say they want to achieve R1 billion in the next 10 years, and they were starting out with R100 a month.
Look, I like the ambition.
Yeah, no, look, you can't fault them on that. And then it's got to be time specific. So a lot of investors don't spend very little time on that. So as a result, their investment strategies become a bit messy. So they kind of go whichever way the wind is blowing. And then the principle of diversification. Diversification, even if you're investing in one share, you can apply the principle. You could buy a Remgro, for example, which is a diversified entity. So you would start there as a beginning point, as opposed to buying Thungela, which is invested in coal. But that's the way the wind is blowing at the moment, is the Thungela way. So the principle of diversification, critical, and it can be applied in any circumstance. Then I think a long-term investment, and that refers to the mindset that investors have. But truly understanding what taking a long-term means. Again, when you're in this game long enough, you come across anecdotes. And I had a call from a client, well, no, she wasn't a client, from a lady the one day who was very upset with her returns. After some digging, I realized that she was invested in cash in the money market, and she had been there for 20 years. But to her, that was taking a long-term perspective, because, she invested where she was getting a good return. 20 years ago, cash was giving fantastic returns. However, the long-term perspective was completely misplaced. For over 20 years, she would have done significantly better anywhere else. So, again, it's understanding what does it mean. It's when I'm making a decision today, what gives me the best result over time, not what gives me the best result over the next 2 or 3 weeks. So, for income investors, very often they look at the highest yield that they can get. And typically that's in an income solution, in an enhanced income type fund. However, if you look over 20 years, they'd probably earn more income from dividends over a 20-year period than they would from an income solution. But then what does that mean? It means accepting the volatility of equity. But they still achieve their investment objective. So I think those are some of the basics, is understand why you're investing. Apply the principle of diversification, take a long-term perspective. And I think that actually helps solve a lot of the challenges investors tend to face.
And it's also, I remember someone contacting me a few years ago. They had they had some money they wanted to put away for the long term. It was 3 years. And I'm like, I don't know, where I come from, that's the short term. Long term is decades. Seppo, you're managing funds. Growing up in the 80s as a kid at school, learning about markets, we talked about these bottom drawer stocks. You buy Disney, or General Motors was a favorite, and of course that didn't survive 2008. And you put it in the bottom drawer and you leave it for your grandchildren. On individual stocks, is it still possible to do that? Or I appreciate within a fund. Craig's talking a fund, you manage it, but is there still going to be that opportunity? I imagine you monitoring it on every time results come out. But how much sort of change is there happening within the funds that you manage?
I think it really is a function of individual stocks. You mentioned an important point there, which is that you need to monitor it. There's a balance of considerations. Earlier I spoke about mean reversion versus structural change, which are almost opposite factors. But similarly, with looking at a company, you need to be prepared to own it over the long term, but you need to monitor it continuously to assess whether anything structurally has changed, or not even just the company, but your investment strategy overall, to see whether something structurally has changed and it warrants fundamental changes. In terms of items such as companies that you may invest in and keep in the bottom drawer, there are those companies. We, as an example, we spoke about big tech for a while. We've been invested in Microsoft for well over a decade. But fundamentally, the business has changed over that decade, and we've continuously monitored it. So it hasn't been a case of we've bought it, kept it in the bottom drawer, and not looked at it, because the business itself has continuously evolved. So I think just given the change in technology and the rapid change in economic realities around the world, I don't think it makes sense to just buy and hold for 20 years anymore. You really need to assess continuously each investment that you take, because things can change quite dramatically.
That's a great point. At Microsoft, the change is there. 10 so years ago, under Steve Ballmer, Microsoft was selling software, and that software was Windows and Office. Windows is now free. I think I subscribe to Office for $100 a month, and that gives me 5 licenses. They've brought on Azure, the cloud. They're bringing in AI. The Xbox has suddenly become so much more significant. There's been structural changes, but they've been in a positive sense rather than perhaps in a negative sense.
For sure. And it could have been, and it was the reality of Microsoft probably until 2015, that any changes that they were looking to implement were actually negative. And with the change in the management team, that has facilitated positive change. I don't want to hop necessarily just on Microsoft,
Sure.
but the point remains that if you don't continuously assess your investment strategy, whether you invested in equity, whatever it is, it needs a robust ongoing assessment, hopefully not daily, but a clear-eyed assessment of whether that particular investment still meets the criteria that you used to go into it.
Craig, I'd imagine this is the same in an individual who would perhaps come to you, a prospective client or a client. Their circumstances may change. They suddenly have kids, twins, triplets. They get divorced or married or whatever the case is. You want an overall strategy that kind of encompasses that, but they're going to be small little points during a lifetime which maybe are going to suddenly you need an education policy or something.
100%. For us, we are referring to clients often as we're not changing your portfolio because markets have changed.
Yeah.
We're changing your portfolio because something on your side has changed. Like you say, there's some kind of life event, and that life event necessitates a review of the strategy and what needs to change there. So typically, your investment strategy, if you've set it up properly at the start, it's really a change on your side that should change your strategy or your plan.
Probably smaller, if it's properly set up, the changes are perhaps more tweaks than giant overhauls.
100%. So you refine your strategy, so the new reality that's there, so the strategy has to help adjust to that. But on an ongoing basis, the market should never be a catalyst for a change in strategy, unless, as Seppo said, there's a structural shift of some sort. But that you would do with the annual review of your portfolio, or whatever period you choose to review your portfolio.
I want to delve into the research process, and it's going to be different for each of you because you, Seppo, are running funds, so you're looking at the individual stocks. You, Craig, are putting clients into funds, so you're not looking at the stocks, you're looking at the funds. Let's start with you. I imagine what you don't do is get a list of prospective investments and sort them by return over the last, I don't know, quarter or year or something like that. That's nice, but there's a much deeper process you're going to go into to if a fund meets the requirements for you to recommend it to clients, which is returns important, but there's so much more to it that I suspect it's on your list, but it's probably down the list.
Yeah. So our starting point is to filter out the rubbish. Because that's half the challenge.
So how do you do that part? I mean, I appreciate that. That's easy said.
So you got to understand the various metrics that So for one, funds with kind of highly volatile returns, very expensive funds, so fee structures that don't quite make sense. So you start there by just filtering out the rubbish, because then it reduces what you need to spend a lot more time digging into. So again, very expensive funds we take out. We look at volatility of returns compared to the sector and see, why is this one so far away from everybody else? Are they trying to be cute, or is that their strategy? What does it mean? So typically we tend to avoid funds like that. And then when you're left with kind of funds that meet your criteria, you start digging in, how do they manage money? What's their philosophy, their process, the people, pricing, all of those issues. And then once you filter down to a smaller set, so we've distilled the number of funds we offer to clients to about 35.
Wow.
And that's out of a pool of over 2,000 funds. And then in terms of structuring a portfolio, we need to understand how various funds work together and what kind of sort of correlations are we looking at. So when I structure a portfolio, that portfolio needs to be quite robust. So we have, in every portfolio, we have active and passive. Okay, those are not religions, they're not football teams. We do not have to choose one over the other. Passive gives me strategic asset allocation, it gives me low pricing. Active, I'm looking for kind of sound, pragmatic philosophies that generally have stood the test of time in different market conditions. And then ultimately, I want a portfolio that will produce the desired return at a level of risk that I think the client will be comfortable with.
Risk and volatility. Quick point, folks, if you've got questions, send them in, events@moneyweb.co.za. You can send your questions for either Craig or Seppo. I will put them to them. I've got them coming on my phone as and when they come through. I quickly want to touch on fees. The fee debate, probably when you were starting some 25 years ago, probably was hardly not there at all. It's become important, but I like your point around religion. It almost, yes, there are high fee funds out there, but we oftentimes we're arguing over 0.5%, which, frankly, always rather in my pocket than somebody else's. But it's almost a debate which has moved to the low is better, and we've got there. We've got that range available.
Yeah, so fees alone is not a fault. You don't filter out based on fees only. So we do have one or two funds in our range that are expensive, but that cost is driven more by performance-based fees.
Gotcha.
So they do make it through the filter on their base fee. And then you got to monitor the manager over different market cycles to understand their philosophy applying in that. So we don't hold it against the manager if they have a performance-based fee. We want to make sure that there's an appropriate hurdle in place
Sure.
Some managers, essentially the first 2 or 3% of return is theirs. Those managers we're not really interested in. And we got to make sure that it's fair, because the client is ultimately taking the risk. And then it's got to blend into the portfolio and add value to the rest of the portfolio. So I think, and then our size allocation. So typically we wouldn't put 30-40% into an expensive fund, because then the fee becomes a factor. So there's a few moving parts. Our starting point is always a broad-based index or passive fund, and then we build around that.
So let's move across to you. As I said, you're coming at this completely different, because you're looking at the stocks, and that then raises bunches of questions in my head. Do you have do you come at a philosophy of its value or its growth, or it's this or that? Do you do a top down and look at sectors and industries, or is it a case of stock specific that you're focusing on?
I'll start out at a principle level,
Sure.
And then touch on how we go about doing it. I mean, our fundamental premise is that each investor needs to use the tools that they have at their disposal to create a process. So, by way of example, if you are a phenomenal litigation lawyer, and you have the ability to discern which direction potential litigation is going to go, you should utilize that in your investment process to look at companies that potentially are being sued, and see whether they're likely to win the case or not. Because if you've got that skill, you can make a lot of money.
Yeah.
If you are extremely tech savvy and can discern between which app, as an example, is going to do better than the other, you can utilize that in your investment process to gain an edge, as you touch on. So I think, as a principle, investors need to use skills that they have at their disposal, rather than copying what everybody else does, right? Use what you think you've got an edge in. As a business, we've put together a team that has quantitative backgrounds, has traditional investment skills in terms of economics backgrounds and finance backgrounds, and we utilize those tools to help our decision making. A part of that is building models that can discern which sectors are likely to do well going forward, but then we do our fundamental research into it to understand the drivers of earnings and returns for a particular company, and base our investment views on that. So really what we then blend is a combination of skills to produce sustainable, repeatable investment process and hopefully returns.
And you're looking, and I get the sector, and it's broadly, I'll look at a sector and think this is a good space to be in. And let's look locally, food retailing, for an example. People are always going to be eating in tough times and bad times. I like the space. I then drill into the different stocks and dig through them to come to one that I like. And then I keep an eye on all of them, because I might own this one, but what's happening there might be a forewarning to what's going to happen here. Maybe they're taking market share. So it comes back to that bottom drawer almost, in a sense. Yes, you've got the stock you prefer. Yes, you've got a position in it. You're monitoring it, but you're keeping a picture, an eye on the sector generally as well.
And I think an important point for us is that there's a fundamental difference. I know this has been said, but there's a fundamental difference between a phenomenal company and a phenomenal investment opportunity. So just because a company is sector leading and it's phenomenal in terms of what it does, a lot of that can be built into the price. And what we try to do is understand the business for what it is. If it's phenomenal, we'll give it credit for being phenomenal. but we are very pragmatic in terms of what that means from a valuation and an underlying value for that business. And how we drive our investments is really that value versus what the market is pricing it. So how we think we make money is that differential between expectations and our version of pragmatic value.
So you could find a truly superb company. The valuation doesn't work. It's just superbly priced. Do you then walk away?
We walk away. As you touch on the big tech businesses, I will stand on this. They are phenomenal businesses. They are game changing in terms of how each of them has gone into the market. I do have concerns around Netflix in particular, but beyond that, they are each phenomenal businesses. The question is, are they each phenomenal investment opportunities? We think Microsoft is, but perhaps the rest, from a pricing perspective, have gone. Expectations are far higher than what we believe the company can generate.
And then when you start digging into the weeds, and I'm thinking, and I know we chatted maybe a decade ago around discount cash flow, and I remember saying to you at the time that there was so much input into it, and there was every one of those inputs. The risk is me. The risk is me making a mistake. And you concurred, but your comeback to me was, but it makes you think about the business so much more, because the little nuances that go into the DCF, the discount cash flow. And then when results come and there's you were wrong, that gives you a space to go and say, well, that part I'm obviously not full in control of. Let me dig into that.
I think that's ultimately everybody who buys any stock, irrespective of how you arrived at the decision to buy it, you are either explicitly or implicitly taking a view on the operational outlook for it.
Yeah,
it's just a matter of fact, right? What we prefer to do is be explicit around that. That way we can have a regular audit as to whether we were right or wrong and what drove the decision to, what made us right or wrong. And we think that then allows us to refine our investment strategy to hopefully be less wrong.
Yeah, and get smarter around the strategy, but also around the business. Craig, will you look at a fund perhaps and see a stock, maybe their biggest holding, a 10% weighting, and think and almost second guess the managers? Or do you say, I've done my analysis of this portfolio, of these managers, and I need to trust them at their story?
Yeah, that's exactly it, Simon. We don't second guess the managers. So our job we've done, and then we leave it up to managers to get ahead with the job of managing money. There's a saying in the market that passive is an active decision, because there's so many choices between different passive funds. By that same logic, active would then be a hyperactive decision, because then I would need to go into managers, into funds, and look at what they're holding and make a call on that. Then I might as well, park all the other work that I'm doing and just do the manager's job. So no, the reason we would choose the managers because we think they could do the job better than we can.
Craig, you mentioned that you start with 2,000 plus funds, you used to still it down to 35. Seppo, you've got a whole bunch more. Certainly in the local market, it's a couple of hundred for a fund, but as soon as I step out, you're talking tens of thousands. I mean, do you have a process which lets you limit that down? I mean, is it, you mentioned certain sectors that you like, or themes that you're interested in, or perhaps just a search and you can say, show me stocks that are only 2 times NAV?
This is where I go back to my starting premise, which is to use the tools you have at your disposal. And one of those, we believe, is strong quantitative skills. So what we've done is we've built models that allow us to assess regions and countries for countries that we like. And within those countries, then we have a way of ranking stocks based on the sectors that they're in, and that's how we narrow the universe from 12,000 odd stocks that meet our size and liquidity criteria around the globe to a manageable subset that we have objectively filtered. Because the important bit of investments is your biases as individuals come in, and if your process, if you're not conscious of the biases that come in, you can underperform and not be aware of why you're underperforming, but it's really your underlying biases. So in narrowing our universe, we try to remove those biases as much as possible.
And I imagine part of being a team as well. And for many of our viewers today, they're not a team. So they need, and that's what I think is the beauty. And I always did it where I would get fellow friends who could, critique me. Because we have blind spots. I remember falling in love with Sasol once, and I had this giant thesis as to why. This was when it was $16 a share the first time, so we're going back 30 years. And I had this giant thesis, and my friend just destroyed it in like 5 minutes flat. And it turned out I should have bought it because it did go up. But nonetheless, a great question coming through from Darren. Seppo, for you. How do you distinguish structural changes in a company, which we were talking about, versus the need to change to the environment that's changing? And what I mean by that, we are entering a quantitative tightening rather than easing. So the easy money is going away. We've got inflation in developed markets for the first time in, 40 years. UK came in at 9.1% this morning. Those sort of fundamental changes, there are going to be some businesses out there which need to change their business model for this new reality which faces.
I think that new reality goes back to your first point that you highlighted, which is that markets and economies always feel like they're structurally new, but in reality, we've seen it before. And I think history is a great gauge of how businesses react in certain environments. So have we seen a high inflationary environment before? Yes, we've seen it in the 70s and the 80s, and there's learnings to be had for how different types of businesses behaved in those periods. And I think that historical anchor is a great reference point to give you a gauge of whether a business is or has to go through structural changes, or if it's actually whether they have to or not, whether they're likely to go through structural changes is the more important part. Because I think what we also need to remember as investors, it's not about what I think the business should do. That's what the business is likely to do. That's the important bit.
Greg, a great question coming from Cuba, and he's making the point, and he says, investing certainly used to be for the elites, and I was talking before we came on air, my first trade, and we're going back to the 80s, I only got a stockbroker because my grandfather basically leaned on him, to be perfectly honest, because he didn't want this kid with a couple of $100. That has changed. I mean, everything from just the minimums for my monthly payments to platforms where it really has, you can now come with a couple of $100. You don't have to arrive in your Porsche.
Yeah, and technology has made that possible. Yeah. And technology, there's the structural change. That comes from the previous question, is understanding these changes, how do they apply in different markets? And that is why you could have something like easy equities, really take that technology and apply it to solve that particular problem. The challenge for investors is trying to find other companies that are taking new technologies and applying it to solve other real problems. But I think, it's also understanding, what does this mean? That you've got perhaps a broader base of smaller, arguably less informed investors, and we've seen the impact of that in quite a spectacular way in the US with I think it was a GameStop or companies like that, and so you've got this growing part of the market that can affect the market. and you've got to understand, how do you respond to that, or what does this growing investor base mean for markets?
I want to move on to managing risk, dealing with risk. Certainly we're seeing at this point, as I said in the intro, the pointy end of it. Craig, in some senses, the simple answer is, well, have a long timeline, have a strategy, and be diversified. You don't even, you mentioned the point of Remgro versus Thungela Resources, taking it wider, an equity long-only fund with some perhaps some money market to sort of offset each other and do that blend.
Yeah, so as I said, the principles often solve a lot of your challenges. So the issue of risk, investing is inherently a risky activity because of the forward-looking nature of investing and the fact that we cannot see the future, and markets are what they call complex adaptive systems, where you think the market will behave in one way, and all you need is a small kind of change somewhere in the chain, and markets behave completely differently. Managing that risk, you've got to decide, based on the strategy that I've got and my objectives, what are the types of risks that I will face, and how do I manage them, and know that you cannot completely avoid risk. So if you avoid risk, you invest in the money market, but that introduces a different type of risk, inflation risk, tax, and so ultimately you're always managing risk. It's understanding what types of risk. So from an equity perspective, the downside risk, the risk that you could lose all your money, how do you manage it? You invest in different types of shares, so shares that respond to or react differently in a specific set of market conditions. On a single stock basis, you can buy a diversified business. You look at the correlations between different types of shares. So I think risk management firstly starts based on what you're trying to achieve, aligning your portfolio, and sometimes it's just about accepting the risks that go with that. Because ultimately, in life, you can't truly avoid risk. If I'm going to walk from here back to the office because it's safer than driving, but then the risk is that I'm going to run out of energy and not actually get to my destination.
Or you get taken up by a taxi. But I like your point. I mean, you can't avoid the risk. If you put money into your mattress, it's not risk-free because fire and inflation are both potentially coming for you. Folks, if you've got questions, 15 minutes left in this session. Send us an email, events@moneyweb.co.za, and I'll put the questions to Seppo and Craig. I've still got the one in ESG. I'm going to come to that in a moment because I think that's a great question. Seppo, risk with you're looking at, obviously at individual stock level, and we've touched on that a fair bit. Do you look at it at portfolio level as well? And maybe you find another great stock, but you think, I've got a lot in that sector already or that space. I mean, is there a sense of trying to balance? Maybe your portfolio's too volatile, so you want some low volatile stock. Do you take that sort of holistic view at it?
We do. I think starting point is really important to define what risks matter to you, and then design a process that manages that. At an individual stock, it could be as permanent loss of capital. So you buy something that goes to zero, right? So how do you manage that? You look at the debt levels, you look at whether you can actually trust the numbers that you're getting from them, just as illustrations of how you manage it at an individual stock level. But we definitively look at it at a portfolio level, and one of the big risks that as a business we have to manage against is we're not measured against cash or zero, we're measured against a benchmark. And part of that risk is underperforming that benchmark over a long period of time. So we certainly look at the benchmark to see how we positioned against that, whether we're comfortable with that positioning. But the premise and the fundamentals of investments come into play in constructing your portfolio. Diversification, as you touched on, that diversification is important from multiple perspectives. Diversification is, having, sure, different stocks, but it's pointless having the same economic exposure across all of the stocks in your portfolio. So it's really making sure that you're not essentially invested in the same thing over and over again. So you've got, in a local portfolio, different economic exposures. In a global portfolio, regional diversification to make sure you're not overly exposed to a particular theme. So even though you could be looking at a South American business, you could be all exposed to what happens in China by virtue of what they do. So it's really important to drill down to the underlying economic exposure, not just where a company is domiciled.
Yeah, that's a great point. You mentioned earlier around geography, and it's an important distinction. It's not where the head office is, it's not where they're listed, it's where do they make their profit. Or perhaps they're an iron ore company and they're selling iron ore in South America, but China's the big player. You've got to be aware of that. A great question came from Jane, and I don't know if there's an answer to it, but I'm going to throw it to you anyway. How many stocks? I mean, obviously, when you're starting, it's probably going to be one or two, maybe three. You can be smart like Craig and go and do a RemGrow, which gives you some exposure to a couple of them. I mean, is there a sweet spot? I mean, that you should be above this number. And I was always told that it was between 20 and 30, and that was the number. But I don't know if that's true.
I think it depends on a few factors, and I hate giving answers. There's the famous quote around how Ronald Reagan asked for a one-handed economist because, on the other hand, right? So I'm always reluctant to say it really depends, but it does. It depends on how much money you're talking about, because transaction fees start playing a hand. So if your portfolio is small but you invested in 50 stocks, you're going to burn a lot of that, not even on just transaction fees. So it depends on how much money you're investing. It depends whether it's a global portfolio, whether it's a local portfolio. Even there, are you looking at local but a broader top 40 type strategy, or are you looking at small cap? I think it's really a function of what you're trying to achieve. But I think the rules of thumb that we try to apply on the global side, we try to target at least 50 by virtue of the size of our book. And on the local side, anywhere between 30 and 40 is what we try to target. But really, it's also a function of the market environment, the opportunities that you're seeing across the board market. So it depends.
It depends, but I take your point. And of course, there's an easy win here. Jane, if you're starting out, start with a fund, a passive or an active fund, but that immediately gives you some diversification. My portfolio is structured just like that. At the bottom is all the ETFs, and then the active sort of sits on top. A quick last question on risk, and then I want to move on. What happens when you own a stock that has knocked it out the park? And a lot of people, who bought a stock 2 years ago, and it is up. It's not up 1 or 2 or 3x. I mean, some of these shares are up, I'm thinking PPC, Sasol and others. These are 10, 20x movers. Do you start to sell your winner? Because I've never resolved this one, right? I bought Capitec at 20, and I've been a net seller for my entire life because it just becomes so big in my portfolio.
So for me, it really is a function of two components. I was going to say one thing, and then you literally highlighted something. It's a function of whether, as you're going along, the fundamentals and the valuation of that business still warrant a further upside. So for me, it's
back to the beginning,
and it's important to highlight that valuation moves. So what the company was worth 10 years ago will be different from what the company is worth today, because the fundamentals of the business change. As it realizes that 30% growth in earnings that you expected a year ago, by definition, a year has passed, so the value increases, right? Because you're discounting by 1 year less, as an example. So it's important that you understand that valuation is an iterative process, so you continuously monitoring it and comparing it to the price. So even if it's gone up 20-fold, but you still see further upside, you should hold.
I got you.
But you raise an important point. How big is it now in your overall portfolio comes into the question of risk. Because if it's too big in your portfolio, you are overly exposed to one theme, and things can structurally change within businesses. Even if management's doing all the right things, legislation can change, as an example.
Yeah.
So
a new
that's
product,
something
a
to-
new widget, something completely out the blue. Craig, a question came through on ESG, and there are a couple of aspects from it: environmental, social, governance. No one says it's a bad idea.
Yeah.
There's certainly been accusations of greenwashing. There's certainly been accusations of it stymieing innovation. There's also been claims that strong ESG gives better performance. How do you, at your firm, view and manage ESG?
Yeah, so we have some clients for whom ESG is a big issue. So for them, we need to go and find funds that pay particular attention to that. But our role is also to highlight to the client the risk of putting too much emphasis on any one issue. I think the governance is a kind of a basic housekeeping.
Yeah, no-brainer.
No-brainer. And you can lose a lot of money to organizations that are badly governed. There's a lot of emphasis on the environmental aspect at the moment. And we think it's out of our pay grade. And we think it's an issue that the fund managers that we choose need to handle. But we do need to understand and manage the client in terms of their response, because they are seeing ESG on the agenda a lot. And now they've heard that with their investments they can somehow influence this. So it's an education thing from our side. So we don't, it's not a factor in choosing a manager for us.
And then how does it play? I mean, I remember Thungela listed, 20 odd rand, and there was the one argument that it was worth zero. There was the flip side that it was worth a heck a lot more. And there was also the argument that says, it's coal. Truth is that, I mean, yes, coal is dirty. No one disputes that. But planet Earth runs on coal. It probably really is a lot harder for the fund manager in terms of deciding where those principles are. In one sense, it's easy and say, you know what, we won't touch any combustion, no hydrocarbons whatsoever. Yes, but how do you handle it internally at Canon?
I think Craig touches on an important point. The governance leg is easy.
Sure. Yeah, that's easy.
The hardest of the ESG components to incorporate into your investment philosophy is the social aspect, because there isn't necessarily a formalized framework to discern how companies interact with their social environment and how that translates into long-term profitability. So it's hard to price that in. In terms of overall assessment of coal, really it goes back to not necessarily our view, but reading the policies of each individual country to assess where regulation is going to go. And if regulation allows for continual development of coal and selling of coal, then it warrants an investment in the space. If legislation is likely to result in a narrowing of that, such as we've seen in the UK as an example, then that has a material impact. And I think this is one benefit of the formalized structure of ESG, is it's forced investors to think about it and to think about the investment implications of each individual company, certainly from an environmental consideration.
We've got a couple of minutes left, Craig. Poor performers, it's going to happen to all of us at some point. In an ideal world, you've done your filter, you've done the effort, you've got your 35 funds. Some of them will have periods of lower performance and some better because that's the design of the fund. Does there come a point where you say, you know what, we tried and it hasn't worked? And I suppose the question is, how much rope do you give them? I mean, in terms of time or in terms of performance?
Yes, I read a study a few years ago, and I've tried to find it again so I can get the details. But it was a disaggregation of the returns of the Russell 3000. So quite a large number of shares. And what they found is that the average share underperformed the index, and in fact, 2/3 of the shares in the index underperformed the index. And so what that tells me is that your chances of having underperformance is greater than your chances of having outperformers. And it also shows the importance of letting your winners run, because ultimately they impact your total return a lot more over time. And the study was done over an extended period of time. So I think there's a lot of lessons in that for investors, is that accepting that having losers is part of the game. And in fact, you're going to have a lot more losers than winners. For our side, from a fund selection perspective, we don't choose sector-specific funds, for example. We'd have equity funds, broad-based equity funds, asset allocation funds, and ultimately leave it up to the manager. We look for structural changes as well. So where philosophy we think would break down. And we did have that with one of the funds where COVID was a perfect storm for that particular fund. So we put it on watch, and we haven't allocated new money to it, but it remains on watch, and because the environment will change again, and we need to see how that impacts that particular fund.
In the last minute, Seppo, I imagine in your example, you're at the stock. You go back and revisit your thinking around it, revisit your research, reinterrogate it, check for blind spots, and truthfully to see if perhaps who's wrong here. Is it you or is it the market? Which is a big question.
It's an important point. We can't control what the market does, but we can assess whether we were right or wrong in terms of our underlying investment thesis. If we were right in terms of the operational performance of the company, then we're comfortable holding. If we were wrong, then we need to relook at the thesis.
Yeah, and it's that being comfortable with saying I'm wrong. But that's what the market does. It's a taskmaster of note. We've come to the end of the first session with Craig Gradich from Gradich Moore Investments, Seppo Modiba from Cannon Asset Managers. For me, I think that the takeaway from this session, it's having that plan, having that strategy, and understanding the benefit and the effort of time. Time is perhaps your biggest asset as an investor. The more you have, the easier it is. And then both Craig and Seppo, who operate in different sides of the equation, what comes through, it's about doing that homework, doing that digging, doing that filtering, using your skill set. This doesn't need to be rocket science, but starting with the giant universe and narrowing it down to a much more smaller, investable universe. My name is Simon Brown. You'll find me every morning 6:30 at Moneyweb Now. And that is it for this session. Thanks for your time today. I'm Simon Brown, still here with the second session this morning. I'm going to be chatting with Carla Duval, Multi-Management and Manager Selection Head at FNB Wealth and Investments. Carla's got some 20 years in the industry, so what we're seeing right now with weak markets, certainly she has seen that before, and is a CFA charter holder. Carla, thanks very much for joining us virtually today from Cape Town. I'm going to kick off with you. You've got a presentation that you're going to do for us quickly. Then we've got some Q&A. Folks, as always, if you've got questions, events@moneyweb.co.za, you can send them through. I'll put them to Carla over the next half hour while we're chatting here. But Carla, appreciate the time this morning. Let's start with your presentation.
Good morning, Simon, and also a warm welcome to each and everybody that joined us this morning. This is a first step in becoming a better investor, and I hope to be sharing today some strategies that I believe will help you to become a better investor. Now, the first couple of slides, I think if we can go to the next slide, as everybody is well aware, we have seen a very volatile period since the start of this year. And yes, inflation seems to be threat. This slide shows the VIX and the South African Volatility Index. We haven't reached those levels of volatility that we saw during the COVID crash, but if you look at how volatility has crept higher, it has definitely been one of those things that had rocked the boat a bit. If you look at a fear and greed index, we are firmly in the territory of extreme fear. And also, if you look at the next slide, what we've been observing over recent years in the market, if you look at the constituents on the next slide of the top 40 index and how those individual stocks have exhibited higher levels of volatility. This slide just shows us the daily moves and how the daily moves of those top 40 stocks before the COVID crash have been the type of experience that investors have had during that period, and how that daily moves have jumped up materially in the period after COVID. So I think as an investor, we are here now in almost at the end of June. We see global equities down more than 20%, global bonds also down double digits, local equities almost 10% down, local property also over 10% down. Local bonds have kept up relatively well, even though it's been underperforming cash, so not an easy ride for investors. And it is never to see those negative returns. And I think this is the time where we need to help our investors to become better investors and give them a strategy to do so that will help them through these volatile times. So what I wanted to present today is what I call the best investment strategy. It's an acronym that will be easy to remember, BEST, and I believe that will help you to become a better investor. The B standing for behavior. That is your behavior as an investor that will be a main determinant of whether your investment strategy will be successful or not. The E in the word BEST, or the acronym BEST, stands for experts. And this is where I think there are people like a multi-manager or a financial planner or a financial coach to help you on this journey. And then S is something that I, as a multi-manager, is very passionate about, and that stands for spread. So the idea of diversification in these type of market conditions. In fact, in all market conditions, spreading your investments across multiple different sources of risk and return will be a good strategy to help you sleep better at night. And then lastly, but not least, is the T. And the T stands for time. Time in the markets, and not trying to time the markets and try to call those peaks and troughs. I believe that this best investment strategy will help you to become a better investor. If we can go to the next slide. This is something that we've been observing. It is interesting to see how some of the correlations earlier this year between equities and bonds have become more correlated, and I think that is, if you see what's been happening in the markets over the last few years, that would be why we are seeing this type of thing. So the question is always, how do you build a more robust portfolio, a more diversified portfolio, that even in times like this, when your equities, that is normally a growth engine in your portfolio, and then traditionally you've used bonds to balance some of that exposure in your portfolio, but now that correlations have become closer together and both are in drawdown territory. If we can move on, I think what we'll present is that you need to think about additional potential sources of return in your portfolio, a more robust portfolio. It is always then good for investors to try and understand what's been happening in markets, what has been driving this volatility, inflation being a main culprit, and where this inflation has come from. I think we can. There's a lot of things happening at the same time in markets, and a lot of this came from. Yes, a lot of this is still a resultant of what we were observing and seeing during the COVID crash. If you think about the supply chains and the energy crisis, that has definitely still spillover effects that the markets and the global economies are currently dealing with. But I think the roots of some of these issues you can even trace back a bit earlier to the global financial crisis, and what central banks had to do in those periods to try and get economies out of those slumps. In this, we can dig into those details perhaps a bit later, but I think what we just try to show in this slide is that this diversification between different types of asset classes can still be a good strategy in your portfolio, especially for crisis times. And because we are all human and none of us has a crystal ball to try and predict what's going to be happening in markets, the best strategy still remains to have a balanced approach in all periods. It's because of that inherent uncertainty that we need diversification. Yes, that does mean might be giving up upside when markets are rallying, when growth assets are doing well, but there's just no way to predict and to know when those markets are going to turn around, and then you already, by the time that happens, you want to already be in diversifying assets that will have a stabilizing effect on your portfolio.
Carl, I appreciate that. And I got to say, I really liked your best analogy there: behavior, expert, spread, and time. And if we come to the behavior part, you and I have both been in the markets. We've seen these types of markets before. We don't like them, but they happen. A lot of investors, before January of 2020, you'd had a decade of really great returns, particularly in developed markets, offshore, thinking tech, but the US markets generally. I think it's come as quite a surprise to see that collapse in early 2020 and to now have another sell-off experiencing. And it really is that ability to have the right behavior, which is, in a nutshell, almost do nothing if you possibly can.
Yes, it is a very uncomfortable place, and it always feels like you need to do something, or even your financial advisor need to do something now to justify the fees that they earn. But often doing nothing is a good strategy. Because it is impossible to predict the future, we believe a solid approach is to always have some safe haven assets in the portfolio. And then in times like this, you need to trust your investment advisor. You need to trust your experts that you've appointed to help you on this journey. And you need to behave. You need to continue with your investment plan. The only time that your investment plan needs to change is if your personal circumstances change, if you get married, if you have those type of big structural shifts in your personal life, that warrants a real look at your investment plan. But your investment plan is set up to give you an outcome sometime in the future. And if you are now trying to double guess and try to make emotional driven decisions, follow the herd in that sense, and when everybody is fearful, you pull out of the market, there is absolutely no way that you can participate in the recovery. In all of the previous periods when there were pullbacks in the market, there has been a recovery. What we don't know is how deep that drawdown will be before the recovery starts, then how quickly that recovery will take place. The COVID crash was very deep, very steep, very quick. But the recovery out of that was even quicker, and I think that took a lot of market participants by surprise, how quickly markets recovered from that, even to the extent that many areas in the world or markets actually overheated in the United States, perhaps. And I think that is also just making the whole system much more volatile. So even though we don't know what's going to happen in the future, I believe that we are going to see this persistent higher volatility with big moves up and down within stocks, within different sectors. We see it in different managers and how they perform. And again, this is why we would say it won't help you to try and time when to be in the market, when to be out of the market. There's no way that anybody can get right. Rather, at all times, have a balanced exposure with multiple different levers that can perform in these type of market conditions, or at least be a cushion for other areas of the market.
I want to touch more on diversity. Before I do, there's a question that's come through from Andrea, which I think in some senses really hits it on the nail. He makes the point. He says he's already invested in the US. He's got offshore funds. Is this a good time to invest more? I mean, do we look at something like the sell-off in the US and say, well, maybe it's time for a little more allocation there? Or do we take the view that carry on doing what you were doing ahead of this? In other words, you had the plan and keep that in place. Or is there some wiggle room, particularly I'm thinking tech stocks, which are markedly cheaper? Now, we don't know, they might get still cheaper still, but nonetheless, they're off around a third, in some cases, a whole lot more.
Yes, so again, the first thing would be that you need to stick with your plan. There's just no way to know how all of this is going to play out. We don't know whether the Fed is going to make policy errors. We don't know how much this fears of inflation in the system is going to create further volatility. Those tech stocks, even after the sell-offs, still make up quite a large portion of the S&P 500. I would again go back to the best investment strategy and see this is maybe the time where your expert can identify some tactical or shifts or areas, not changing the investment plan, but they will be able to identify areas in the market that provide some potential for better returns or lower volatility going forward. Just one example here is that everybody has shunned some of the emerging markets and China in particular last year. And perhaps there are a case to be made now to start adding a little bit to that, not to go overweight equities, but there might be some opportunity there now to start adding a little bit of China exposure. It is an uncomfortable trade now, given what has been happening and all the pain that investors felt recently about that. But again, there are teams of experts that can help you along this way, that you are not alone in making those decisions. The question around your exposure, I think, came much more to the fore earlier this year, with National Treasury increasing the allowed offshore allocation for institutional investors. We believe it is a good thing to be able to be more flexible in where you take your allocations and your exposures. Um, Having that ability to have more offshore will increase the potential universe for better diversification in your portfolio. But this also could lead to more differentiated outcomes. There are more places where you can make errors as a result of this. And again, why I would advise that the expert part in your best strategy could help you with that. A multi-manager that can analyze all of these different skill sets of the managers and identify which one would complement your existing portfolio to keep you on track.
I like that, and I like the expert part. I like your point in China being perhaps uncomfortable, and from my experience is that that's often the time to be doing it. When everybody else is in the trade and it's more about FOMO and fear of missing out, you've probably missed out already. A small bit of discomfort. I want to come to the S and best, which is the spread part, which is that diversification. You made the point that back in the days, you would find equities and particularly bonds often sort of inverse to each other. You showed the slide of 2008 where equities gave negative return, but bonds gave positive return. We sit here in 2022 and those correlations are so much tighter. We're seeing sell-off across the different asset classes. That, in a sense, some folks would say, well, then why diversify? But we're looking at it for that longer part of the process. We're looking at it for the different characteristics, not just in 2022 during a market sell-off, but broader in terms of the longer term, in terms of the volatility within the portfolio. And that spread, that diversification is still, as Warren Buffett would say, the only free lunch we get in the market.
Absolutely. And I think all of these things are linked together and interrelated. Your expert can help you with the behavior part. If your portfolio is not suitably diversified or spread, then there will be too little levers to create a robust portfolio. Time being of the essence. I normally use the analogy of baking a cake. You might have the recipe to a T. You might even have roped in some ideas from master chefs, and then that batter needs to go into the oven. And if you open that oven before the time is up, your cake will flop. Now, sometimes life happens. Can interrupt, for example, the baking time. And what do you now need to do? You might need to extend the time that cake sits in the oven to increase your chances of getting a successful outcome. So again, all of these things work together, but at least if you follow this best strategy, that will help you sleep better at night.
Yeah, I like that absolutely. A question coming through, which again ties into the being diverse, having that spread of investment. And the question was, is there a safe haven right now? A lot of folks would traditionally say, well, it's about cash. But except that inflation is eating away at your cash. Is this almost a case of that there are going to be points in an investment cycle, and perhaps we're in one of those now, I think we could say we probably are, where there almost isn't a safe haven, and we kind of just need to revisit our behavior, to revisit our strategy, perhaps go and have a cup of tea or coffee with your expert, and hold on, because it's tough out there, and there is nowhere to hide almost.
That is true, but like insurance, diversification is an uncomfortable thing that to have, because if you could perfectly predict the future, you didn't need diversification. If you knew for a fact what asset class would be performing well, then why give up some of that upside returns? So diversification is a necessary compromise. And now, if you think about a safe haven asset, that is similar to having insurance, short-term insurance, a bit of a grudge purchase most of the time, but you just simply don't know if and when your car is going to be in an accident. So you insure it all the time. And I think that is why you need to think about a safe haven asset. And that is why in our analysis and how if we when we build outcomes-based portfolios for our investors, we always include things like cash as a strategic asset allocation. Small, because if you want to keep up with inflation, you you can't have all of your assets in cash. That is the one asset class. And I think if we can bring up the slide again, the slide pack again, the last slide there shows that you have very little chance of outperforming inflation if you sit in cash.
Yeah.
Now, the other safe haven asset that we really like to have a strategic asset allocation to is gold. Gold is not on this particular slide, but if in a changing world like this, gold is still a good component to consider to have a small strategic asset allocation because it is so difficult to time all of these things. And in our analysis, we've seen it doesn't really help to try and when things become sour in the markets now to start increasing your gold allocation. Some questions are always coming through around, okay, cryptocurrencies, that's something to consider. The problem is that gold is still considered to be by central banks a store of value, and cryptocurrency not yet. With cryptocurrency being so extremely volatile, it comes it doesn't a large allocation, but it will take so much cost to and time to try and research that it's almost not worth it. So we still prefer gold as to play a big role as a safe haven asset in such a diversified portfolio.
Yeah, I hold gold. I was criticizing it the other week and saying it hasn't done anything. And then I realized it was flat year to date. And I realized, actually, you know what, flat year to date is the new winning because I don't think there's much else in my portfolio that is, that is flat year to date. So we'll absolutely take it. What about, and there's some questions coming through around the ETF and ETN. And in many cases, we look at that and it's passive. But that's not always the case. F&B's got those ETNs that are listed on individual stocks. But the question coming through is some of them, and again, let's stay with F&B, there's the clean energy ETN that is available on the JSE. And of course, we can buy the same underlying ETN in New York in dollars. Is there a logic to one or the other? Is there a process to say we're better off buying the one in rands on the JSE or we're better off buying the dollar denominated in New York?
Again, those decisions will your expert or your financial advisor or financial planner will be able to look at your individual circumstances and how all of these different instruments would fit into your plan to help reach your investment journey. I think what is exciting about these instruments is how easy it makes for anybody to participate in markets, to very quickly get efficient access to different areas that was previously perhaps a bit more difficult to get access to. So yes, they can play a fantastic role in the portfolio. And if you just think about how popular ETFs and other passive products have become, at FNB, we don't believe you need to go either one way or the other. We believe there's a lot of value that you can get in your total portfolio when you blend active and passive in your investment solution. It's not either or, it is both. You need a lot of beta in your portfolio to deliver that growth over time, and ETFs and passive products can be a very efficient and cost effective way to get that beta exposure. And then around such a core of the portfolio, it would make sense if you want alpha or performance that's different from the markets, to add some active investment managers that follow active strategies to help build a more robust portfolio. And that ties back to the idea of spread diversification.
Question coming from Ray asking if there are fee-based advisors available, and certainly there are, who will charge flat fees. No names come to me right now, but I mean, if you Google around, you will find a bunch of them out there. Be warned, you're going to look at that fee and think it's a chunk, but if you run the numbers, often it's worthwhile if you want a one-off. Carla, coming back to you, we're talking diversification, and in a sense, some folks will say, but hang on, I've got myself a diversified portfolio, I've got sector diversification, I've got asset class diversification, I've got currency and geography, and I've got everything, and I'm still losing money. It's not a silver bullet. I mean, that's not what we're promising here. We're not saying that this is the secret to not losing money. What we're saying is it's the secret to sustainable long-term, because the inverse of diversification is putting 100% of everything you've got in one single stock. It doesn't matter what the stock is. That's going to be scary.
Absolutely. And again, we are all humans. We feel pain far more than what we feel the opposite of pain. And diversification is of a risk management strategy. It is there to help you sleep better at night. And then to get back to the best acronym and the best approach, you need to trust your investment advisor. Then you need to trust your investment managers who have been through multiple market cycles to navigate your portfolio through this. It won't help if you now try to double guess and second guess them. You are likely at an information disadvantage against a lot of other players in the market. And the best thing that you can do is look after your behavior and rather stick with your investment plan. Don't try to make emotionally based decisions. Enjoy your time with your family and let your investment expert make these difficult decisions when they are required. And sometimes doing nothing is what is the best approach at that point in time. If you then have a diversified portfolio that are appropriately spread between different sources of risk and return, and if you then sit in the markets all the time and can sit through all of this volatility, then we believe that is a solid foundation by which you increase your probability of reaching investment success.
Yeah, I like that. And it comes back to, one of the questions I wanted to ask was around weightings, because the question is, how much should I have in gold? What about all the best? And it comes back to that expert, because it's going to be slightly different for everyone. It's going to depend where I am in my part of the process. We're going to leave that there. That's Carla Duval from FNB Wealth and Investments. Carla, really appreciate the time. Really like that acronym. BEST, which stands for behavior, manage your behavior. E for expert. Find an expert who can help you. Spread. You've got to be diversified. There's different ways of doing it, but we have to be diversified. And then, of course, the T in BEST is for time. Time is I said it in the first session, it's the biggest asset we have when we're investing. Give it time, and don't panic when markets do what they're doing right now. This is what they do sometimes. Trust me, seen it, been here before. We'll get out of it, and there will be another one. Carla Duval, really appreciate on the line virtually from Cape Town. Ladies and gents, that's me for today, but there are, of course, more sessions coming in just a few minutes.
The Moneyweb Frequently Asked Questions series. Part 1, all about shares.
Hello, I'm Simon Brown. Welcome to part 1 of Moneyweb's FAQ video series. In this series, we're going to give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I'll take you through all you need to know about shares and more. The most popular question, what are shares? Shares are listed slices of a company. Each share gives you the right to a share in the profit and a vote at the annual general meeting. They trade in an exchange, such as the JSE, whereby investors can buy and sell. Another popular question, why do shares exist and how do they work? In order for a company to raise money rather than a loan, they sell part of the company to new shareholders who essentially give the company a permanent loan. What are the different ways I can buy and sell shares? You buy them through a stockbroker or within a fund, such as a unit trust, an exchange-traded fund, or a pension scheme. Will I be taxed on my shares? If you make a profit, you will indeed be taxed, but only when you sell. Dividends, your slice of those profits every 6 months or year, will be taxed at a flat 20%. In the next video, I will highlight important information to consider before investing. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Our next guest is our first keynote speaker of the day. Rish Tandapani is a strategic leader with extensive experience in developing and leading organizations and functions to maximize their potential. He has over 16 years' experience in investment banking, data brokerage, commodities, foreign exchange, and security tradings. It's my honor to introduce to you Rish Tandapani, Chief Operating Officer of the Purple Group and Easy Equities.
Good morning, everybody, and welcome to the Better Investor Conference hosted by Moneyweb. My name is Rish Tandapani, Group COO of the Purple Group and Easy Equities. Usually when I start these type of talks, I give everyone a bit of an overview as to who I am, where I've come from, and what I've done. But today I'm going to try something a bit different. I'm going to tell you guys a bit about a story that happened to me quite recently. I was on a plane ride back to Singapore, where I reside, from Johannesburg. And in that typical type of airplane environment, someone asked me who I am and what do I do. Now, usually dreading these type of conversations, I usually keep my answers quite brief and don't really go into much details. I usually just explain to people how I'm a COO. I help manage operations of the company I'm working for and do bits of work on strategy and people management. However, this time I was a bit flustered, and the reason being that the person asking the question to me was an 11-year-old girl. So how do I go about answering to her? What do I do? Who I am? What do I actually do on a day-to-day basis from a job perspective? It was interesting. Now, I thought about two different approaches to this. Do I tell her what I just told you guys about what I do? Or do I tell her actually what my company and I do to enhance her lifestyle? Now, as you can imagine, an 11-year-old girl can be quite daunting. She's in that typical Gen Alpha, and yes, that is a real word, age group. And it was something that I thought I owed her a better explanation towards. So I told her, I help build tools that make growing your money easier and faster. And straight away, in her eyes, I could see that resonates. I could see her percolating, thinking about how her pocket money can somewhat double or triple or quadruple. Now, why do we never think about that from an investing community? Why do we never think about how we portray ourselves and how we're portraying the wider investment arena? There's two options again. There's the bad news. Do we talk about inflation, oil prices, impending recessions? All terms that an 11-year-old won't necessarily understand. Or do you try to sum it up in a more positive and flamboyant way? So I told her, how would you feel if today you gave me $1,000 and in 40 years' time, I gave you something northward of $70,000? Again, her eyes lit up, and I could see there was somewhat more of an interest in her listening to me. So let's just take a minute and talk about the bad news. Why is the market so currently bad? We can talk about sharp corrections from COVID when the markets were high, the economic hangover that we're all thinking about. High energy prices is something I discuss with people on a day-to-day basis. Rising interest rates, Ukraine. We're seeing unprecedented inflation, probably higher than it has been since the 1980s. Lower consumer spending, which I think all of us can empathize with. But the net impact of all of those factors means that the businesses we're investing in essentially are making less profits. And as a result, our view on the market changes. But how does that look in the eyes of an 11-year-old girl? Well, it doesn't look anyway. It just looks like bad news, let alone anyone else. So we need to start thinking about how we're projecting ourselves in our arena. We need to start thinking about how do we talk to those 11-year-old girls, those 21-year-old men, those 75-year-old retirees. Take a step back for a minute. Look at something like the JSE 40 index or the FTSE 100 from a pure graphical standpoint. You'll see peaks and troughs. You'll see the 2002 dot-com bubble. You'll see the 2008 mortgage crisis. You'll see the recent pandemic sell-off that we've all experienced. These cycles are normal. And ironically enough, explaining those cycles in the grand scheme of the 30 to 40 year graph actually resonates more with a child or someone younger than it does with someone my age or someone older. And why is that? Maybe generally, younger people are more positive. Maybe they see more of a stronger resonating outlook with regards to their money. Or maybe, as an industry, we've just sat ourselves in that seat of negativity for so long. So, corrections or cycles, they have to happen. That's what keeps things in order. And we all know that, but that doesn't necessarily stop us from becoming anxious investors. And I think this is one of the properties that we can learn from the younger generations, millennials and youngers, even the Gen Alphas who I was sat next to, where there's an aura of positivity and there's an aura of positive outlook generally in the way they approach their money and the way they approach investing. And I think that's critical going forward. Once again, I use the example. How do we turn $1,000 into something northward of $70,000? Simple. We just stick in the market. It's not complicated, and we all know it. But critical to that is looking past the volatility. It's an opportunity for us. And especially now, in the middle of June, we're seeing huge problems with the market. We're seeing huge amounts of negative news on a day-to-day basis. But actually, if we step ourselves out of that equation, we can actually understand things in a much more coherent and concise fashion. And we know the answers already. It's nothing new. We've all experienced it before. Volatility goes both ways. The larger the red candles, the larger the green ones. We need to stop approaching investing and investors on a cliche level. Markets do well, growth stocks do well. Markets are turbulent, so we'd be better off sitting safely with ETFs and indexes. Yes, all factually true comments, but ultimately don't really change anything from our investing outlook. We know that, we've committed to the program, we should stick with it. And that's where we can learn a lot from others. So why am I telling you this story? 3 reasons actually. 1, that actually an investor can be anyone. And do we all really believe that? Are we still all living in that 1980s, 90s demographic of what an investor is or are? Well, actually, to me, and everyone within my team at Easy Equities, an investor can be anyone. We don't discriminate by age, we don't discriminate by gender or by wealth. We actively try to target everyone. And an investor can take any shape and form. And that 11-year-old girl really pushed that message across with me. I think the other thing to consider is rethinking our roles within this process. So what am I? Am I a COO of a financial services institution? Probably yes, on paper. But what do I actually do? 2 key things. I educate and I provide technology. Who do I educate? I educate my own teams. Teach them what I know about the market. Teach them what I know about what clients want. Teach them what I know about technological provision. And externally, I have a commitment as a financial institution personnel to help grow their database, grow their knowledge and the facts that go out to them. So I'm much more of an educator, and somehow that sits a lot better with me than just that quintessential COO title. The third reason why I told you this story is pretty simple. Maybe it's time we reassess how we approach the idea of helping people invest and why we want them to be embedded within that process. There's always been a distance between financial institutions and the consumer and retail investors. Well, that distance needs to narrow. And the reasons for that are pretty simple. One, maybe consumers are smarter than we actually think. Maybe the retail investors are the ones who actually can provide a lot of the answers that we crave. I'll give you an example. Crypto recently, or in the last 5 to 10 years, taken a big step into the game. And it's been seen as the principal means to democratizing finance. In fact, it's coined the term DeFi. I'm not so sure about that, but I do agree, and we can take the lessons of crypto, that consumer input will define the financial services industry more now than ever. So maybe it's time we, as investment professionals, listen more and speak less. I think that's a critical message I would give to any of you. A lot of the answers are already out there, whether it's in a different geography, with a different demographic, or with different partners. And maybe now is the time to start that collaboration exercise. Let's just take a step back and look at South Africa for a moment. In recent weeks, we've seen large bond outflows, the falling appetite for local debt, and price hikes that have hit unprecedented levels. Well, okay, 3 huge pieces of negative or bad news. But we've heard little in terms of diversification. We've heard little in terms of property, emerging markets funds, or crypto. We've heard nothing, or next to nothing, in terms of international and regional opportunities. Let's take a look at the recent Sanlam Alliance joint venture. That's a huge pivotal movement in East Africa. It comes with opportunity, both in the alternate investment space and from an innovation perspective. And if you group those words together, what do you have? Potential. So we can't always get bogged down at a micro level on the acute details that are just spawned from negative news and negative feeds. It's time to look a bit broader, and it's time to look at investment and investing as a slightly more broader concept. And we'll get onto that later. Let's think about things from a slightly wider market perspective. I would say we're probably going to see another 20 to 40% drawdown in the market over the next 6 months. That isn't necessarily anything new. It isn't necessarily time to fear. It's probably a time to get your ducks in order and ensure that when things do turn, you've made the right, sensible decisions to continue your investment strategy and the path with which you started many, many months or many, many years ago. And all these factors come together into what I call coherent investing. Clear, concise, ideal investing that allows you to understand your situation now, in the past, and in the future. And that's a key takeaway for all of you guys here today. So how do we go about understanding our investment mindset or our behaviors? Critical to this is understanding your risk appetite. How much are you actually willing to spend at a given time to make the money that you want to achieve at a given point in the future? Well, key to this is sticking to an investment plan. Now, your advisors can come up with this, but you need to know the underlying logic and realities behind that plan. Plan your trade and trade your plan. It's like every walk of life. You try to approach it with a sense of sensibility and also a sense of routine. And an investment plan is exactly that. So whether you're getting advice from a third party or you're taking the advice that you're giving yourself, execute that investment plan in the way that you want to execute it. What likely was good for you 6 months ago is likely still good now. Just don't let that shroud of negativity necessarily outweigh your decision-making on your portfolio. Don't emotionally trade. Critical, and probably one of the number one things I see on a day-to-day basis that impacts people's portfolios. I'll give you a bit of a side story on this that helps me explain emotional trading. I came to Singapore about 14 years ago. And when I first joined the bank I was working with at the time, someone came to me with this idea of time trading, which I automatically assumed meant timing the market, which we all know we shouldn't be doing. But actually, that person said to me, well, no, it's more about understanding how your mood dictates your trading behavior. And he brought in factors like the moon and its gravitational pull with the earth and how it affects water, waxing crescent movements, things like that. All in all, and to cut a long story short, it explained to me that people are still being overly sentimental and overly emotional with the way they trade. Now, there is a part of you that can include that within your investment plan, and we'll get onto that later when we talk about values. But on a day-to-day basis, the more emotionally invested you are in making those decisions, the likely your trading is going to be effective. And your investment plan as a whole will be effective. As I mentioned earlier, don't time the market. Try to understand from an education and logic standpoint what your behavior actually means. A good example is dollar cost averaging. See the meaning behind it, understand the logic, and understand how that fits into a more realistic, wholesome, likely to succeed plan. So I guess all this comes down to discipline. So let's take a look at some micro habits that can help you with discipline. The principle of which is probably staging your investment over time. A lot of people make the critical mistake of just plunging all their money into a hot stock or into a particular investment strategy immediately. They don't necessarily think about staging. But think about your children. You don't necessarily take plunges with them. Your relationships, you don't necessarily take plunges with those also. When you're buying a property, you don't necessarily go on day one and say, well, that's it. It's a thought out process, which can be done over various stages. So let me give you some use case examples, which I think will be very, very helpful. Let's take crypto as for the first one, which hopefully illustrates the market and investing in very simple terms. We've always treated crypto as a trading product, which has always not sat really well with me. It's an investment product. And for those of you who know the markets, either from a technical standpoint or just generally, you will admit that it's an investment product. Essentially, what we're trying to do with crypto is to see it develop and mature into something like gold, which takes time. It takes time to become that pure, mature investment product. The reason the Bitcoin fluctuations have happened over recent weeks and months is purely because new investors are selling and older buying.
Cool.
So why are we not listening to the older investors, or those who have been in the crypto game for slightly longer?
Okay, perfect.
Essentially, crypto is going to be dictated by when companies hold it on their balance sheet.
Sounds good.
As soon as we see that movement, volatility is going to come down, and we're going to be looking at the new gold. Now we just call crypto or Bitcoin a financial technology. Soon, it's going to be more associated with store value, and everything's going to be a bit more mature. Now, you wouldn't know that unless you knew and educated yourself on the product and how the market works. And I think that's critical. An immersion factor into understanding what it is you're getting involved in. The second use case I'd like to tell you guys about revolves around impact investing. To me, this is critical and probably the most important thing that I speak to you about today. The alignment of personal values and financial performance is key. It has been key since the millennials and is definitely going to be more and more key the more and more generations come on board. I can see it with the Gen Alpha who was sitting next to me. She wants her money to be associated with the values, missions, and ethics that she lives and prides herself on a day-to-day basis. And the critical to understanding this is the idea that value isn't just a measure of profit anymore. It's much more than that. It's a measure of meaning. And for all of us in the investment space, either as investors or investment professionals, we need to understand about how we're generating value. And that necessarily isn't always a financial number. The idea of personal value investors, those who want to align their personal values with their investments, is going to be critical and represent a huge proportion and probably a majority of the client base that all of us are going to see over the next months. So think about your personal value investment proposition. As mentioned earlier, some micro habits on what we can and can't do, or what we should and shouldn't do when it comes to our investments. These are what I would call more grounded pieces of advice. Don't always check your stock prices. If you're doing that, you're looking more for validation than logic. Think of the fundamentals more than the day-to-day news. A good example of this is Apple. Apple don't release phones or tidbits about their phones on a day-to-day basis. They do it in 6-month chunks, maybe 5 or 4-month chunks. And as a result, we see peaks and troughs in their stock prices according to that. So why are we looking at stock prices on a day-to-day basis? It's an investment product, not a trading product. It's important to understand that. Think of your interests and align them to your values. Is the company that you want to invest listed? Is it not? Make your decisions based on those type of factors. And the thing that I mentioned earlier, immersion. Immersion from an education standpoint is paramount to any successful strategy. Financial, technical, geopolitical, sociological immersion is critical. And that's one of the key factors that I drive at Easy Equities. So how do I come into this? How does a COO of Easy Equities actually play a role in this? Well, principally is to tell you that our job at Easy Equities isn't to advise you. It's to equip you to advise yourself. A paramount part of our mission and a key driver of our value proposition is the idea of education and technological facilitation. How are we immersing our clients with as much data and information to make their investment decision-making tree robust, strong, valid, and more importantly, successful? And what technology are we putting out there to ensure that that journey is both easy, yes, the clue is in the name, low cost, we obviously want to squeeze on margins, flexible, and more importantly, built in with a sense of community. If your investment strategy is pretty much part of a community strategy, or at least being bounced off eyes and ears within that community, there's more chance it's going to be successful. And so we take an outlook that education and technological facilitation is absolutely key. And how do we achieve that? Well, we talk to our clients, but not just them. We talk to our fintech partners. We talk to our distribution channels, our regulators. There will be much significantly more chance of success working together than working separately. And for all of those of you in the room, not everything should be seen as a combative, competing relationship. We need to understand how that can be symbiotic. How can we get the best out of each other and help the wider investment community? And it goes back to the point I made earlier, which was, do we understand our roles within investing? Yes, we're essentially part of a capitalist industry, but it doesn't necessarily mean we always have to be at loggerheads with each other. There's a greater requirement for sharing, partnerships, and cohesion. Shared distribution channels is pivotal, especially as some of our entities go global and our product offering increases. And more importantly, from a technological standpoint, we need to collaborate. We need to ensure that we're leveraging off the best technology out there. Now, Easy Equities may not always produce that, but we're quick to identify who will, and we join forces. And it's very important to see this from a collaboration standpoint. In essence, what are we doing? We're building a community. And why is that important? Well, essentially, the community dictates whether the market goes up or goes down. It dictates whether we succeed or whether we fail. Our goal at Easy Equities isn't just to be a stockbroker or your quintessential brokerage. Our goal is to offer a holistic view of any of our clients' finances. Imagine your balance sheet online with Easy Equities, where you can see your life insurance, your lending portfolio, your crypto portfolio, your stocks, your children's education loans. That's where we're aiming for. Now, granted, we haven't achieved much of that as yet, but we're getting there. And the way we're getting there is by talking to our clients, our partners, our distribution channels, and ensuring we're all working in that same direction. You've probably all heard about the creator economy that's coming our way. Well, I think that's here to stay. It's driven by community. It's driven by a sense of decentralization as well. And Easy Equities aims to invest and embrace in it, not to go up against it. And if our clients, principal players in that creative economy, we'd be silly not to listen to them. Now, imagine a world where everything is easy. That's what I want as COO of Easy Equities. I want everything to be easy, both in functionality and in name. I'll leave you with a piece of advice that someone gave me a few years ago. They said to me, Rish, well, always seek help, even in times when you don't necessarily need it. I never really listened to that until recently. But now, with my arena, with partners, regulators, distribution channels, I think it's always important to engage those people. And I can see that on a day-to-day basis, me having those conversations adds significantly more value than me not having those conversations. A lot of people ask me, well, what does the future hold? I'm not so sure. I'm not a genius, so I don't know the answer to that. But I do know that the future is easy. Thank you, and enjoy the rest of the Better Investor Conference.
I'm Kieran Ryan, and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, This is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.coza, the Moneyweb app, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
Welcome to everybody to the Better Investment Conference session on cryptos. Crypto bubbles are being popped everywhere, and some of the more speculative cryptos are down 80% in the last few months. My name is Kieran Ryan. I'm the host of the Moneyweb Crypto podcast, and we're going to be talking about some of the reasons behind the drop in cryptos, and are there opportunities in this? Bitcoin and Ethereum are down, but the die-hard Bitcoin supporters say we've been here before. Remember back in 2017 when Bitcoin dropped 84% from its high before it started recovering. Now, the proximate cause of this was the collapse of the Terra Luna ecosystem, which wiped out a reported 40 billion in value. For crypto skeptics, and there are plenty of them, this was an I told you so moment. What does this tell us about cryptos generally, and what can we expect from here? Well, joining me to discuss this are Brett Hope Robertson, who joins us virtually from Cape Town. He's head of investments at Revix. And Stephen Sidley, who is co-author of Beyond Bitcoin. He's also a partner at Bridge Capital. And Stephen is here in the studio. Welcome to both of you.
Thank you.
Cheers, thanks.
Just a little quick bio there. Brett, you were a derivatives analyst and dealer for many years, and during your time as a derivatives analyst you also helped build a derivatives hedge fund strategy, but you found yourself drifting into the crypto space, as I understand it, and you enrolled on a course at Harvard Extension School where you learned about Bitcoin and blockchain coding, and you've graduated from UCT with a master's in investment management, and you're also level 2 CFA.
Yeah.
And Stephen Sidley in the studio. He's an award-winning and multi-shortlisted author of 5 novels, 1 non-fiction book, Beyond Bitcoin, Decentralized Finance and the End of Banks. That's a very provocative title. And that you co-wrote with Simon Dingle. And we've had you before on the Moneyweb Crypto podcast. Good to have you back again. You're also a playwright and a regular contributing columnist to outlets like Daily Maverick and Business Day. You have an MSc in computer science from University of California, Los Angeles. You lived there for many years before coming back to South Africa. And you spent decades working as CTO for a lot of global listed companies, including Anglo American. And currently you are a professor at the Joburg Business School, University of Joburg, right?
That's right. Yeah.
Good. Well, let's get into this. It's a question I'm going to direct at both of you. What have we learned from this Terra Luna collapse? I'm going to start with you, Stephen, first. Everybody has understood, well, getting to understand what a stable coin is, but that we would have something which is supposed to be backed by real assets, which just disappeared completely. What do we learn from this, and what does that tell us about cryptos generally?
Okay, so there are kind of 2 questions embedded in there, Garan. The first one is the Terra Luna system, which was spotted by some crypto analysts early on as being architecturally unsound, because in fact it was not backed by any real assets. Terra was supposed to be backed by $1, 1 Terra equals $1, but in fact Terra was backed by a token called Luna, which had no particular backing other than public perception. So some people said earlier on, this is unsound, this is going to collapse. And it was pretty much ignored, and it was ignored quite loudly by the architects of the Terra system. When it finally did crash, it crashed into, and this is the second part of the question, into a perfect storm of bad news. And the perfect storm of bad news included inflation, included regulation, included the leverage that had taken place within the crypto ecosystem. So when Terra Luna started collapsing, those people who were exposed to Terra Luna started collapsing as well, and there was a domino effect, which has now included a big project called Celsius, a big investment company called 3 Arrows Capital. So there was this perfect storm of bad news, and it brought the whole crypto market down. Before Terra Luna, it was sinking anyway, along with NASDAQ and all the other stock markets. When Terra happened, it's accelerated. Its downward trajectory accelerated. All of this means, in my view, absolutely nothing to the future value proposition that crypto represents. And that value proposition is both in terms of the good that crypto is doing around the world and also in terms of the pricing of the assets. So you are looking at one person here who is entirely unconcerned about the price of crypto. I'll remind the audience that crypto, Bitcoin particularly, its price has dropped far in excess of the current bear market 3 times in its history from 2011 onwards. I held Bitcoin when it went from 19,000 to 3,000, which is a bigger drop than this. I was unconcerned then, and I'm unconcerned now.
Right, Brett, same question to you. Just tell us what you think the Terra Luna collapse has done. And Stephen did mention Celsius, which is a decentralized finance lending platform. They suspended withdrawals. So there's something going on here because the returns that are being offered on some of these lending platforms did seem to be unsustainable, 17% per annum. Is this the end of the good days?
No, much the same as Stephen. I don't really worry about this crash. I think it's actually something quite needed. You know, we needed this deleveraging to happen in the system. There was far too much leverage in there already. But the kind of takeaways I've learned from this Luna UST kind of collapse, right? As you said, it's pretty historic. It's two top 10 cryptocurrencies kind of disappearing off the face of the map within a week. And I think what we can see is one, you know, the crypto market is still very immature. And the one thing that happens with that is these immature markets experience really high volatilities, more than, you know, traditional markets, and they have really strong correlations between assets. And that's exactly kind of what we saw with this Terra collapse, right? You saw UST and Luna obviously fall off the map. Then you saw the Luna Foundation kind of step in and have to sell their $1.5 billion worth of Bitcoin reserves to try to defend this peg, right? And when you have a big sale like that in an immature market, as kicked in also with this contagion around the peg, contagion around Anchor disappearing, bad macro outlook, you kind of get this correlation falling to one, right? And the whole market pulls back. But what we kind of learned from this is, you know, you got to understand that this market is still very immature. And you've got to be mindful of this when you're going into these kind of panic situations. There is a couple of positives I did see from this. You know, Anchor itself is meant to be this decentralized bank, right? And it actually kind of showed that it could probably handle a bank run a little bit better than we possibly thought, and actually a bit better than a bank. So if you think about it, a bank holds about 10% of its reserves, its deposits as reserves, right? So that kind of means if 10% of depositors pull their cash, the bank kind of closes its door. Anchor handled the 55% pull on deposits within 4 days and still kind of held its peg at around 0.91-ish. That's pretty impressive, eh? So there's some kind of pros to this DeFi that could actually probably solve a kind of bank run issue. But I think the main thing we kind of seen from this is that, you know, diversification always wins. And the simple fact that you don't want to have all your eggs in one basket. You know, there's that saying by Mark Twain, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And I think we've seen, you know, some terrible stories of some companies, some funds, some exchanges that were really severely hurt by this. And I think, you know, they thought that UST on Anchor was a no-brainer and a risk-free trade to get a lot of yield. And it just wasn't so, and they got burnt. So I think the main reason for diversification kind of plays into this kind of market at the moment. It's in these times of panic, diversification is worth its weight in gold, and spreading your risk across multiple assets, whether it be through a bundle or you do it yourself, is something so important, so you don't lose everything in one hit or lose a business in one hit like we're seeing, you know, 3 Arrows Capital kind of doing. So yeah, there's a couple of takeaways from there, but I do think what we have learned is that the crypto market is one of the most adaptive and progressive sectors, and this kind of deleveraging we're seeing is just going to make it come back stronger, I think.
So you're not concerned about the drop in price that we've seen over the last few months? You're expecting a rebound from this. And talk about that for a minute. Is, you know, could we see it go lower? Because back in 2018, the price dropped to about $3,300.
Yeah, I mean, look, it can definitely go low. There's a lot of contagion. There's a lot of, as I said, deleveraging. And obviously the macro backlook isn't the best, right? There's no reason saying it can't go low, but there's a lot of long-term kind of deep value metrics that are starting to scream a little bit, right? We've seen the 200 weekly moving average for Bitcoin. We've seen Bitcoin kind of drop below that for the first time, or the second time ever in its history. And the last time was March 2020 in the liquidity crisis, right? We've seen Bitcoin drop below its production cost, which is the first time since March 2020 as well. And the basic idea there is that Bitcoin shouldn't really trade below the cost of the energy used to produce it. That's a very much a value metric. We've also seen, you know, Bitcoin's price is trading below its realized price, for example, which is basically the whack of the whole market. the average cost that everyone paid for Bitcoin. That kind of tells you that the whole market, on average, is underwater. These are deep value signs, and you're also seeing the futures market in Bitcoin kind of reset. It's the lowest it's been since December 2020, and that was just before Bitcoin kind of went on its run from 20 to 65K. So yeah, there's a deep reset, and who's not saying it can't go lower? There's some structural bases at around 12,000. If it gets there, it gets there. But these value metrics are starting to scream. Start buying in a little bit of DCAing. I think here would be a reasonable assumption. I mean, if you look at Bitcoin itself, something that survived 8 separate 50% corrections with no bailout, and kind of exits it and goes on to all-time highs is something seriously you need to look at as an investment opportunity.
Stephen, same question to you. You said that you're not worried about this, and Brett brought up some of the metrics that he's looking at. The cost of Bitcoin production, it's, if I'm not mistaken, it's about 24,000, 24,500. So we're now today trading at about $20,000. It did touch a low recently of $17,700, went back up again. The other thing which hasn't happened much in history is the fact that it broke the 200-week moving average and then has sort of come back up to that or close to it. And it's only got a decade of history, but that history does tell us something, that Bitcoin doesn't very easily break these patterns. What do you think of that?
Okay, so I would agree that there are a bunch of investment metrics, which Brett points to, which is screaming undervalued. But we all know that anybody who's been foolish enough to try and apply traditional technical analysis to the Bitcoin price over the past 10 years has ended up at some stage with egg on their faces. So if one is to believe in Bitcoin, one is believing in the long-term value proposition. Whether it will go down to 12,000 or 18,000 or suddenly take a rally from here is just about unknown to anybody. What one needs to look at is whether there is fundamental value in the technology and the magic that it shows to the concept of self-owned money, secure self-owned money. And that is a long-term view. And so from my perspective, the price of Bitcoin, number one, is irrelevant. Bitcoin and what its blockchain does has not changed at all during these price crashes and rallies. And if you believe that there is an underlying value in the blockchain and this particular cryptocurrencies, there are others, of course, but Bitcoin is the original gangster, then one just holds on and waits for it to go up to the value which will, in my mind, certainly increase in the long term, and not to panic and get out every time the price moves. What Brett alluded to, I strongly agree with. Two things have happened within the cryptoverse over the past 4 or 5 weeks. There have been a couple of mutants in the gene pool, and one of those mutants was Terra Luna, and that mutant finally is getting snuffed out by evolution. But what it does, it's infected a whole bunch of other creatures that were exposed to it. The second one, probably as unfortunately, or there were a great deal of speculators in the market who leveraged up to a point that was unsustainable, and they got liquidated on the way down. So the mutants will continue to be flushed out by evolution. The speculators will continue to be whipsawed by price movements. But meanwhile, the Bitcoin blockchain runs and does exactly the same thing that it was doing when it was $68,000.
Okay. Brett, let me ask you this question. Are we going to start to see the beginnings of a flushing out of non-viable projects in the crypto space? I mean, there are 15,000 different cryptos. Most of these are just not going to survive. Is this the start of that process of flushing them out?
Yeah, so I think, look, in any market, not just crypto, especially when you go through a big downturn like this, right? You know, as Warren Buffett would call it, as the tide goes out, you kind of discover you're swimming naked. And I think you're seeing this kind of take place right now, right? Not only alternative coins or altcoins are getting hurt badly. We've been seeing, you know, really poorly risk-managed lenders and hedge funds also coming under huge pressure. As Stephen alluded to, there was a lot of leverage in this market where, you know, you had Three Arrows Capital, one of the biggest hedge funds, getting put under huge liquidity pressure because basically they got a bit greedy. They got caught on Luna. I think they had $560 million locked in Luna that's currently at a value of $600. I mean, that's a big drawdown. And they had borrowed against a lot of their assets that they had. They either went leverage long or deposited into Anchor to earn a yield. And when you are leverage long and things like the news of Celsius comes out, or there's a pressure on the staked ETH versus ETH peg, the market starts to panic, drives lower, and you get margin called. And if your assets are locked up, you can't actually get the liquidity to get out of those margin calls, and you actually get liquidated. So we've seen this whole deleveraging. I think there's going to be a lot of coins that go to zero, a lot of underdeveloped coins that go to zero. Much like the internet bubble in the time, I think 99% probably go to zero. But you're going to be left with the OGs and the strong bases and the strong communities and the strong kind of network effects that'll last on. But as we said, when there's huge financial pressure, there's a pull on credit. Credit leaves the system. Overall money in the system leaves. So now think about basic math says we have less credit and less money in the system, but the same amount of coin price goes down. And that's kind of what we're seeing here. But these retests are needed. I mean, we need to flush out the bad actors. We need to flush out the systems that aren't working so that the stronger systems can come back.
Stephen, the stable coins were the fastest growing subset within the crypto space. And they're supposed to be backed by real assets such as the US dollar. So people may be a little bit confused that you have something like Terra Luna, which was an algorithmic coin. And what they were trying to do, evidently, was to not have a fully backed stable asset, but to do it programmatically. And this, of course, resulted in their unwinding. Now, how is this collapse going to affect the stablecoin environment? Because I think a lot of people are confused and they're going to associate one with the other. For example, Tether, they're audited. We know that they are backed by real assets. It's not that they're backed by dollars, but they're dollars and dollar equivalents. What does that tell us about this space, and what changes can we expect going forward?
Okay, I just wanted to pause and perhaps for some of the people who are listening, explain why there is such a thing as a stablecoin in the first place. The stablecoins' prices are not supposed to move. They're supposed to be tied to a hard currency. Most of them are tied to the dollar. Why do these things exist in the first place? The reason why stablecoins were invented, and they were invented in 2017 by Rune Christensen in a project called MakerDAO, was that when you wanted to trade in and out of crypto, you kept having to go back to your bank. So you went to the crypto world and you bought Bitcoin and you sold Ether and you did a bunch of stuff, but you kept having to go back to the traditional fiat system, which was onerous and it was heavy friction and there were bank fees you had to charge. So what Rune Christensen did in MakerDAO is he invented a thing called DAI, which is the name of his stable coins, so that you could remain in the crypto world when you were on pause. You didn't have to go back to your bank. You could sell your Bitcoin and put it in DAI, and it was still there in the crypto world, and you could instantaneously, a couple of days later, decide to buy or sell something else without going back to your bank. That was the reason for the stable coin. It turned out that there was an astonishing demand for the stable coin. So when DAI was launched in 2017, money poured into this thing so people could have this stable crypto assets as a home base and a safe base to leave their stuff when they weren't trading. That stablecoin got copied, or the concept of a stablecoin got, I don't want to say copied, it got rebirthed in a number of different guises. And there were two guises which sort of arose. One was, as you mentioned, the collateralized backed stablecoin, where there was $1 sitting in a bank account, a real bank, a traditional bank, for every one stablecoin, and USDC is an example of that. Tether is not quite the same. Tether's assets are backed not by 100% cash, but by short-term commercial paper and other safe assets. And then there was the other guise of stablecoins, so those stablecoins that were ingeniously constructed so that it would keep its peg to the dollar via basically arbitrage, algorithmic arbitrage. And those have not fared as well, although DAI, which is partially collateralized, and they're hybrid models, and DAI is one of the hybrid models. The problem in stable coins And by the way, stablecoins are an enormous part of this market now. I think that today Tether was 67 billion was floating around, and I think USDC there's over 80 billion floating around today. There's a lot of money in stablecoins. There's systemic risk to financial systems. The reason why stablecoins will change or will come under pressure will not be because of their performance. It will be because of regulation. The worldwide regulation, and the US, everybody looks to the US for regulation no matter what anybody else does, is taking the position that stablecoins need to be backed one-to-one to a real dollar sitting in a bank. Now, the maximalists and zealots who live in the crypto world, of which I am partially one of them, are screaming bloody murder about this because the whole point of crypto is to be non-regulated. But we live in the real world, and those sort of regulations, from my perspective, are rational. So I think what you will see in the future is stablecoins will survive, private stablecoins, blockchain stablecoins, and they will survive with the regulatory diktat that they have to be backed one-to-one to the dollar.
Okay, just to mention that please send in your questions to clients@moneyweb.coza. Now we have got a few coming in. We'll get to them in a minute, but I just wanted to follow that up with Brett about this stablecoin issue. Do stablecoins have a future, Brett? Given what we've seen, I mean, they really have a utility because you can now have a dollar or a rand that is virtually backed, not virtually backed, is backed by real currency, and can be transferred anywhere in the world at very low cost. And that's the thing. I think what Stephen was talking about there is what people wanted. They didn't want to be exiting the crypto space and paying all the bank charges that they would have to pay when they converted back to fiat. So do they have a future?
Yeah, I mean, of course they do. I think, as Stephen said, they're also the biggest probably systemic risk to crypto at the moment. They're massive. But yeah, they took huge form because, as Stephen was saying, people wanted a place to park their cash when they were getting in and out of Bitcoin or crypto, whatever it was, right? Instead of going back to the bank system itself. So that was the main thing for it. And it was pegged to a dollar, which is, a fiat system that was very relatable to a lot of people. So they didn't have to go, if they were trading in a altcoin, for example, if they want to go park it back in Bitcoin, that was kind of a hard thing to denominate your wealth in at the time. People were still struggling with the whole maxi Bitcoin, let's denominate our wealth in Bitcoin rather than actually a dollar. So that kind of helped it a lot. There's going to be a massive space for this. I think it'll always be there because human beings will always associate kind of, value and a metric to something that can count in a dollar form. So that's why I think it'll be there. And as we've seen now with this algo crash, anything with algo stablecoin attached to it is pretty much gone the way of the clog and disappeared. But people are kind of running to safety. And as we said, USDC is kind of the most safe stablecoin at the time, fully backed by reserves and obviously in cash and short-dated US government obligations, etc. And they get audited and they show that they have more cash than they have circulation, so they're over-collateralized. And that's a huge thing. And I think that's something that we need to see from this whole crash is that we need transparency in this crypto market. I mean, the last few months have shown us anything. It's kind of that we need to assure customers that their assets are safe and accounted for. I mean, that has to be the base market. That has to be the base market for these people. We've seen a lot of regulation coming offshore, but it's quite focused on AML and KYC regulation. And I think they're kind of missing a big trick here is that you should be kind of focusing more on accounting for customers' assets. Instead of this anti-money laundering, maybe the crux of the matter should be, are companies holding the assets that they say they're holding? That's the most important for the end customer, right? So that's got to be the best case.
I'm going to stay with you, Brett. By the way, I think I gave the wrong email address there. I'm going to correct that. It's events@moneyweb.coza if you want to send any questions through. Events@moneyweb.coza. It's a question from Joseph coming in on this very topic, Brett. He's asking, for stable coins, are these algorithm-based stablecoins possibly the future of the crypto space? What do you think? Do they have a future?
It's a tough one. Look, I think there might be a space for them, but with this latest attack, they've got a bit of mud on their face at the moment, and I think it's going to take a while for them to come back stronger. If you can think about it, the algo stablecoin was held together by an arbitrage, basically, right? And that works when the peg sways from 1 to 1.1 and 1 to 0.9. That kind of works. You can picture it as take a bowl and put it upside down. The ball on the top kind of works around here, right? It works in this range, but as soon as it falls off the edge, it's gone. So these algos and arbitrages, as soon as it goes past 0.9 or 1.1, it's not worth their risk to back that it's coming back to its peg. And that kind of is what we saw with this lunar terror cycle, is that people just wanted out, they didn't back that the peg was coming back, and you end up printing a whole bunch of lunar, it becomes a hyperinflationary asset, and the peg kind of never recovers. So if they can fix that part, maybe that, it's partly algorithmic and 70 or 80% backed by USDC or something like that, then you can kind of see a place for it. But at the moment, I think a fully algorithmic stablecoin is a long way away from being something that people will trust again.
Stephen, this is a question that's also from Joseph. What would you recommend, investing outright in ownership of cryptos or transacting, in other words, trading? And what would be the pros and cons of both in the short and long term? You want to pick that one up?
I would, with all the caveats that I'm not trying to give financial advice over here, Joseph. Thanks for that question. I have my own preference in this regard. My own preference in this regard is buy and hold. It's the Warren Buffett view of investing in the crypto world. The only two safe assets that I would recommend, literally the only two safe assets that I would recommend are Bitcoin and Ether. They have the most mature ecosystems. They have the most interesting things going on. They're the most hardened. They're the most unlikely ever to be hacked. And by the way, neither of them have ever been hacked. There are other interesting ones over there. This is terms of straight investment. There's Cardano and Solana and Avalanche and Phantom. They have their own risk profiles, which are too high for me. So in terms of an investment strategy, just like Warren Buffett would stick to the big companies that have certain ratios, I stick to Bitcoin and Ether. In terms of the second part of your question, should one trade? And whether that is trading in non-cryptocurrencies, in other words, trading in tokens that belong to big DeFi initiatives, or using those DeFi initiatives to try and get yield. The space is very noisy right now. There are a lot of sharks in the water, as we know. Those are grifters and scammers, which one has to look out for. And in addition to that, the people who are really good at trading, the 150 PhDs sitting at Goldman Sachs in America, who are looking to get an edge in the trading, probably are going to do a better job at finding edges than an individual would. So for me, I would stay away from trading. That being said, I do have friends who go in there. They call degens in the industry. They do all sorts of training and swapping in and out of very risky assets and do very well for themselves. It would not cause me to sleep well at night.
Okay, Stephen, staying with you, a question from Andre. He says, I'm a novice at crypto. Why should I invest in something that is in the ether? And I don't think he's talking about the crypto ether. It has nothing other than belief that drives its value.
The answer is not whether, Andre, I'm sorry, this is a standard answer which I give to this question, is basically what backs Bitcoin, and people say nothing backs Bitcoin. The question isn't what backs Bitcoin, the question is what backs fiat currency. There is nothing that backs fiat currency. There used to be gold when it was tied to gold, but if you live in Argentina, where you have seen your wealth drop by 40% because of mismanagement by the government, or Turkey, or Venezuela, or Zimbabwe, or a number of other countries, you'll know that fiat is as much backed by something as Bitcoin is backed by something. Bitcoin has numerous advantages over fiat currency, and I'm going to give you the most obvious one. It ticks all the boxes of non-counterfeitability and durability and divisibility and all those other nice things about money. But the most important thing that determines the value of an asset is scarcity. The reason why gold was considered an asset of value is that it was difficult to mine and difficult to find. It separated from money in 1971 in the United States. It's not tied to money anymore. Governments will tell you that they will not debase your money by printing it. It turns out that every single nation state, we did this research for the book, every single nation state that has gone bankrupt in the past 3,000 years has gone bankrupt because the government printed money. They salted the gold coins in the Roman Empire so that they could defend they could invade the next country. The hyperinflations of Austria was the same issue, and it is the same issue now in America, where 70% of dollars that are now in existence were printed in the last 2 years. There is nothing backing fiat currency. There is only public perception, and worse, you don't have a say in how much of that perception, how much of that value is going to be debased by your government. In the case of Bitcoin, there is a finite amount of Bitcoin. Nobody can print more Bitcoin. It is not under the control of a government who may make ill-informed decisions like that. So the answer to your question is there is more backing Bitcoin than there is fiat currency.
Brett, do you want to add something to that?
I think he's covered it all, really. Those are all kind of the checklists that we were saying. I mean, it's literally the power of having control of your own hard-earned money, right? And as you were saying, we've seen it now. 70% of all money in the US has been printed in the last 2 years. I mean, that's crazy. You think of someone who's worked their whole life and now all of a sudden their money is just getting printed away. It's kind of the same thing, you know, why we see quite a big kind of adoption or so in South Africa is our country's kind of got the perfect storm of looking for an alternative money. I mean, we've got kind of sovereign risks, we've got a weak currency, we've got a highly unbanked, a high number of unbanked people, we've got a bit of high inflation as well. So all of these things, you know, Bitcoin kind of steps in and kind of ticks all the boxes of fixing.
Right. I mean, I think we did this exercise at Moneyweb. We looked at the value of the rand since it came into being in, I think it was 1961, and it had lost more than 90% of its value since then. In other words, you know, if you were earning 200 Rand a month back then, you were probably in a lot better position than you are today. I want to talk about regulation here because we know that regulation is coming, Stephen. Now, Bitcoin was born as a kind of a revolutionary initiative. It really was a rebellion against this kind of recklessness of financial management that we've seen worldwide by central banks and the overprinting of money and the debasement of fiat currency. When you talk to the people who are involved in this business, they do welcome regulation because it provides some sort of legal certainty to institutions, to pension funds, and so on. You say, okay, well, now we're dealing with a financial services provider, however they will be licensed, and therefore it's probably safe to put some of our money in there, and we'll treat it as an alternative investment, and there will be caps on that, how much they can put in there. But this does seem to be a deviation from the original founding philosophy of Bitcoin, does it not?
It does, and you're correct. The original founders, I want to say inventors of the blockchain. And by the way, when Satoshi wrote his 9-page white paper, and I urge everybody to go read it, it's not that complicated, and it's quite epiphanal. The original founders of the crypto revolution were not specifically zealots to that extent. What they wanted to do, first of all, was a hobby at the time. They were trying to find a way to solve a whole bunch of problems that had bedeviled researchers since the invention of the internet, which is how to make internet money. So part of it was hobbyists, part of it was mathematicians, cryptographers who were having fun playing with the stuff. And part of it became, how do you build a system that is inflation-proof? There was some expectation among some of those people, Hal Finney and some of the others, that this may become worth something one day. But none of them had any idea that it would have any value until one of the programmer's fathers offered 2 pizzas for 10,000 Bitcoin. It's, by the way, celebrated as Pizza Day every year in the crypto community. And from that beginning, a whole bunch of zealots and evangelists sort of saw the light. They became obsessed, had got a religious fervor in their eyes. We are going to build a parallel system of money which is going to be outside of the control of anybody. That vision still exists among many, and that vision, from my perspective, is unachievable. because we live in a world in which there is a parallel system run by nation states, and those nation states are not going away. And so one has to find a regulatory middle ground which allows people to continue innovating in the space, but allows the world of crypto to meet in the center, and that's where the regulation happens. The regulation happens at the on-ramp, which is your bank, to put money into the crypto world and to sell crypto and to get it back into the real place so you can walk into a store and buy something. There is some gray areas, like what is happening in El Salvador, where you can actually go and buy a loaf of bread from the El Salvadoran equivalent of a spaza shop using your cell phone, and they're doing it. But it is my expectation that it is childish to believe that the entire crypto space will take over the entire fiat space. Because if that is going to be the case, then you have to look at nation states giving up control. And nation states are not going to give up control without a fight. Sorry, just to end this point over here, very important. There are 3 things that a nation state absolutely has to have to control its economy. It's got to collect taxes. Yeah. It's got to make sure that money is not given to bad guys, terrorists or some other country that wants to hurt you. And number 3, it has to see the movement of money through the economy so they can pull the levers of interest rates and capital injection and liquidity in order to keep prices and employment stable. That is the job of a central bank. A nation state cannot do that if the money is hidden in a private system. That is why they are so obsessed about control, and for good reason.
All right, just a reminder, the email address, if you want to send in questions, is events@moneyweb.coza, events@moneyweb.coza, and we have got quite a few questions coming in. This one is quite a follow-up here. It's got to do with central bank digital currencies, and it's a question from Anne. She's asking how these government-issued virtual coins would impact the crypto sphere. Brett, do you want to take that one up?
It's an interesting one, and one we're gonna figure out.
We've lost Brett's audio.
Hello?
Audio's gone.
Hello?
Okay, can we switch to Stephen? Right. Stephen, do you want to take that one,
Right.
please?
So
central bank digital currencies.
Sure.
Tell us.
One of the reasons that my co-writer, by the way, is a Simon Dingle, who is very well known in the crypto community, and I love it when this question's asked when he's sitting in the seat with me, because smoke comes out of his ears and he rises off his seat. The central bank digital currencies are not stable coins, and they are sort of an insult to what a blockchain is supposed to do. First of all, they are permissioned. The bank gives the permission to release these coins out, which are equivalent to the digital equivalent to the dollar. Banks already have digital currencies. They move digital currencies around all the time. You know, they don't actually move cash around all the time. They have things that change entries and ledgers. Their interest in the blockchain is it makes things easy to track, but what it does not do is make it permissionless. It is not decentralized. It is centralized in the government. So they're taking the parts of the blockchain which are technologically powerful and they make things easy to track, they get things to settle fast, but it is a very, very long way to the permissionless blockchain that was invented by the powers of this technology. There will be central currencies, digital central currencies. The problem with them is they range from China's digital one. China's digital is not necessarily a digital currency. Yes, it is, but what it really is a way to surveil your citizens. That's why they want it. They can tell what their citizens spend, and they can say, you did a bad thing, you posted something we don't like, you can't travel on the public transport anymore. All the way to El Salvador, who says, come and have fun, or the Central African Republic, who says, come and have fun. Somewhere in the middle there's going to be some central currencies which act exactly like cash, but one has to remember they will never be permissionless, and they can always be retracted by the government.
Brett, have we got you back?
Testing. You got me?
No sound for Brett. Okay.
No sound.
It looks like you can hear me, but I can't hear him. Okay, we'll go on. Okay, there's a question from Matt here, Steve, while we try to sort out Brett's sound. What's the best way to start or to buy Bitcoin and Ether in South Africa?
So there are a number of centralized exchanges, they're called. The two biggest are luno.coza, Luno.coza, and valor.coza. There are a few other ones, and actually Brett is probably better suited to answer this than me. Is to open
Revix as well.
And Revix as well, of course. To open an account at one of those crypto exchanges, South African crypto exchanges, the ones that are legitimate and the ones that we've talked about are legitimate, is exactly the same as opening an account at a stock exchange. You've got to show your ID, you've got to do the whole KYC thing, is you transfer money in your bank in, and then you will see a choice of cryptocurrencies that you can buy, and then finally, after being terrified, you press the button that says, please buy me 1,000 rands worth of Bitcoin, and you're in. It's very, very simple to do with the centralized exchanges. If you do it in a non-centralized way or a decentralized way, and there are ways to do that, it's a more terrifying experience. It's more flexible for many reasons. But my suggestion to the questioner is go to one of those exchanges, Revix or Luno or Vela, and there are a couple of others. Try to choose one that you read a lot about in the press, because it means that they have a lot of liquidity. Open an account, buy 500 rands worth of Bitcoin, and you will fall down that rabbit hole and have a wonderful time doing it.
That's right. People ask me that. I say buy Bitcoin and don't pay too much attention to price, because it'll just get you interested in the space, and you will start studying more about it. Brett, are you back?
How's it, guys? Can you hear me?
Okay. There's a bit of contradictory information that's coming out about Bitcoin. The price tells us that the enthusiasm is waning. That's the one indicator. But there are surveys suggesting that people who are buying for the long term. There was a study came out a little bit earlier this year called Bitcoin Knowledge and Perception by Block Inc. And what is interesting about that survey is that South Africa is way ahead of other countries when it comes to the optimism for crypto. Okay, that survey probably needs to be redone in light of what's happened in the last few months. But why do you think that is? I mean, people are, the rate of adoption of Bitcoin is rising, and Bitcoin is the granddaddy of them all, as you mentioned earlier, and when it rises, everything else rises. So what does that tell us about crypto generally?
Well, if you want me to answer the question about why there seems to be more optimism in South Africa than anywhere else, it tells a sort of a sad and unfortunate story. Is the places where there's the most optimism for crypto are the places that have the least faith in their governments, which is why you will find an enormous amount of crypto trading in places like Turkey and Venezuela and Colombia, and those places that are being hyperinflated, or at least partially hyperinflated. I think there is a lack of confidence among some in the future of the country, or at least the future of the rand, and that's why there's a lot of optimism here. I don't want to call it optimism. There's a lot of interest in being able to trade outside of the regulations, or outside of the eyes of the government. As a general answer to your question is that there are only 150 million people in the world, somewhere between 150 million and 200 million if you include, depending on whose studies you follow, who dabble in Bitcoin. It's very small compared to the 7 or 8 billion people that are out there. There are 50 million Americans, which is quite large. 23% of millennials have dabbled in the crypto world, NFTs and cryptocurrencies. This thing is growing very, very fast. If there is a lack of enthusiasm, or if you're pointing to a study that shows a drop-off in enthusiasm, it is only because of the volatility we're now seeing. And our expectation is, in the studies I've seen, is that the growth in interest and the growth activity in the cryptoverse will grow exponentially over the next 5 years.
A question here from Anne. She says, both your speakers quote Warren Buffett, but hasn't he shunned crypto? You seem to apply his learnings from equities to crypto, which may be direct advice. Please comment and clarify. I think Warren Buffett's partner, Charlie Munger.
Charlie Munger, yes.
I think he did clarify that by saying he didn't really understand much about crypto. What's your answer to that?
Yeah, Charlie Munger and Warren Buffett are wrong. That's my quite simple answer. I'm applying the Warren Buffett methodology of only investing in solid growing assets. Obviously, there are no cash flows in Bitcoin, and he's quite strong about investing in cash flows. But they're wrong about cryptos. They have admitted they don't fully understand that space. It's a little bit disingenuous because Warren Buffett has now invested in a company in Argentina who is in the crypto space, so he is dipping his toe into that water. I will give some leash here by saying that the world of crypto is fairly complex, very new, and very sudden. I mean, spectacularly sudden. The first modern bank was the Medicis in the 1100s. There's been 1,200 years to build a financial system. This world has been around for 13 years. It's just in the blink of an eye. And I don't have a particular objection to somebody saying, this stuff is never going to work. It's a fair reaction from somebody from the traditional world to say that. It's only if you look into this more deeply do you see some of the sparkles and diamonds that are hiding in the blockchain. And Charlie Munger and Warren Buffett are just simply not going to do that.
All right, Brett, are you back? No, I don't think so. Okay.
Hello? Hello?
Yep,
Hello?
he's back.
Hello?
You're back,
There we
Brett.
go.
Okay. Well, welcome back. All right, Brett, I want to, because I think did you mention Warren Buffett? Warren Buffett, you want to talk about that? Transposing his ideas from equities to crypto. What's the story there?
Yeah, look, I think I did hear that. So I think there's definitely lessons you can take from Warren Buffett's way of investing, right? He's a long-term investor. And that's with regards to, anything, whether it be stocks, bonds, whatever it is. And yes, he's not a big fan of crypto because there's no cash flow or value metric that he can attach to it. But this is also a guy who missed the internet bubble as well, and joined it a bit late. So he's not very good at understanding new tech, and he's very good at understanding value. That's not to say he's not great at what he does, but he has missed out on a couple of key trends. And as Stephen was saying, I mean, this is a very young class, right? Investment asset class. And yes, maybe it doesn't work, but the way it's growing, I mean, we've seen, in 2021, over 300 million people were using crypto worldwide, I think, roughly. I mean, its growth rates around like 150% a year. If you kind of extrapolate this kind of out, you're looking at like 1 billion users in 2024. I mean, that's around the corner. So it's not far away. And I have this weird and kind of idea that, much like the effect that baby boomers had on the stocks, powering a 20-year bull market in the 1980s and the 1990s when Warren Buffett made all his money, I think millennials favor digital investments over stocks, right? And therefore, it could echo the same kind of dynamic that the baby boomers did on the stock market. I mean, millennial generation, their earning potential kind of caps out in 2038. That's a lot more future earnings coming into a market where I think people would buy, Bitcoin over Costco, for example. And I think just owning a part of this market, whether it be through owning Bitcoin itself or owning a top 10 bundle or something that gives you exposure to the whole market, is something that's definitely prominent if you believe that a millennial generation would prefer to own a digital asset over a stock, which I can't see why that wouldn't be the case.
I just wanted to add to what Brett said about Warren Buffett. Warren Buffett, obviously, I'm never going to have a conversation with Warren Buffett, but if I were to have a conversation with Warren Buffett, there would be an obvious question to ask. This has been the fastest and largest movement of human wealth from one asset class to another in history. It has been the best performing asset in the world by orders of magnitude over the last 11 years. Warren, how could you have missed this?
Mm. Okay, Brett,
I'd second
here's a question on that topic, and this is from Maratori. He's asking, will Bitcoin and Ethereum recover in the future?
Yeah, look, I think it's not a question of if, it's a question of when, right? We go through these cycles all the time. I mean, this isn't even the worst that we've seen Bitcoin go through. And I always kind of revert back to a simple kind of study I looked at, right? And that was, I looked at Bitcoin throughout its whole life. So from 2010 to now. And if you had bought Bitcoin on any single day in its existence, right? Say market top, market bottom, bear market, bull market, increasing interest rates, cutting interest rates, whatever you have around the world. If you had bought it on its single worst day, So say you bought the 2017 market top and you held it for a 5-year period. History has showed that the worst return you would get holding Bitcoin for 5 years was 27% a year, year on year for 5 years. That probably outperforms 99.99% of fund managers around the world. And that's the minimum. On average, it's been about 150% per year for 5 years. I mean, that's kind of the power of this asset class and how quickly it's being adopted. So do I think it's going to come back? I mean, 100%, basically. I mean, how many times have we heard crypto is dead echoed across news platforms all the time, and it seems to come back every time stronger? I think this is a natural cycle. Yes, there's the argument that Bitcoin hasn't gone through a economic bear market that we're seeing now with regards to the normal world. But I don't see how this asset doesn't come through the same it's done for the last 4 or 5 cycles.
Okay, we are running out of time. I want a couple of quick-fire questions here, and this is a fairly meaty one. Cryptocurrencies, Stephen, are the public face of crypto. But the important stuff is below the surface: Web3, digital property rights, fractional ownership of art or property or whatever it is. You've got the metaverse, you've got GameFi, you've got DAOs, which are decentralized autonomous organizations, all operating off the blockchain. And in some ways, they're more interesting than cryptocurrencies. Which of these offer the most interesting use cases for blockchain, in your opinion?
Yeah, there's a bunch of threads or a bunch of, let's say, evolution of new creatures that came out of the blockchain. The one that we read about daily is cryptocurrencies. It's the one that people know best. And only because it's sexy. The prices go up and down. You hear fortunes made and fortunes lost. But just let me talk very briefly about the other threads. One of them is NFTs, which you've heard about, and most people think of NFTs about paying large amounts of money for questionable pieces of art. It's not. It's a new way of defining ownership, which fundamentally changes the way that things can be owned, seeded, sold, shared. It is transformative. It hasn't happened in the history of economics before that the ownership of something can be as elastic. I'll give you an example. A title deed is a document of possession. The registration to your car is a document of possession. Your receipt from the internet connection for your PC is a document of possession. Those documents of possession are formatted in very ossified and inflexible ways. An NFT, which is a document of ownership, it's a receipt, is infinitely elastic, and it completely changes the groundwork of what it means to own somebody. And what is something, and what has come out of that is the metaverse, is Web3. For those of you who don't know about Web3, Web 1 is when we could read stuff off our website. Web 2 is where we could write stuff to the website, like cat videos and, the picture of our flat that we wanted to put on Airbnb. And Web 3 is where you can read, write, and own on the internet. There is decentralized autonomous organizations, which is a huge subject, but it takes over where corporations and partnership and limited liability companies come from. So there are a whole bunch of very deep silos that have sprung from the blockchain, of which cryptocurrency is only one, and an important one, and a sexy one, and fun to watch if you're not losing money. But all these other ones will be just as important in the future.
All right, Brett, do you want to take that up? Which of these themes are the ones that we should really be watching? I've mentioned Web3. We've got digital property rights and so on. Which ones are you looking at?
Yeah, so I mean, obviously at Revix, we enjoy the idea of sectors over individual cryptocurrencies. And we built obviously bundles to kind of track performance of these sectors. And I think the way to look for investments in sectors is kind of to look at what problem are these sectors solving, and do these problems that they're solving create value, right? And from that kind of outlook, we see DeFi, Web3, and smart contracts pretty much as the sectors that kind of solve the most issues and create the most value going forward, right? We have DeFi, which helps out with attacking the unbanked and helps them. There's over 2 billion people unbanked. Helps remittance, which I mean is supposedly a $1 trillion industry that's it costs people to send back money into Africa between 15 to 25%. It's like scary amounts. Then, as you were saying earlier with tokenization or part ownership, you can kind of see millennials as the kind of ninja generation that have low income, high expenses, and they couldn't really afford these big ticket assets like real estate to buy as an investment. Tokenization really does solve that, to let you own a part of something. And then obviously they're taking on the lending and borrowing basically the bank, where these DeFi protocols supposedly can streamline and give more yield to the end consumer than the bank taking its clip. And as you also mentioned, Web3 is for me just an area that's attacking, a multi-trillion-dollar addressable market. You got things like Arweave trying to take on decentralized web storage, right? So they're trying to take on Amazon Web Services. You've got Helium, which is taking on telecommunications. I mean, these are massive addressable markets. And as Stephen was saying, Web 2 very much focused on the seamless transfer of information, but that information was stored in centralized servers with your Microsofts, your Amazons, your Googles, etc. And ultimately, the value of that web kind of accrued to the corporation and not the end user, right? Whereas Web3 kind of steps in here and says, well, centralized services will be created on a decentralized network, transfer the same value, and ultimately the value will then accrue to the actual user and the token holder of the protocol rather than the corporation itself. And then you kind of have smart contracts, as obviously the other two sectors can't function without it. It's kind of the picks and shovels play on Web3 and DeFi.
All right. A very quick answer, please, Stephen, on this one. A question from David. Blockchain technology is wonderful, but does that equate to enthusiasm for funny money tokens built on top of the blockchain?
The short answer is the enthusiasm for funny money tokens is an unfortunate but probably unavoidable consequence of scamsters and grifters.
Okay. Brett, a quick one from you. Why would an institution go to invest in cryptocurrency?
Why would sorry, you broke up there.
Why would an institution invest in cryptocurrency?
Well, you've seen a lot of institutions kind of look at this now, putting on Bitcoin onto a balance sheet, right? They're saying that what's happening to dollars, for example, what's happening to their fiat currency losing value for a corporation, this is a very good hedge against the devaluation of your currency.
Okay. And Brett, to stay with you, how does the NFT and DAO case impact Bitcoin as a long-term investment?
How does the NFT and DAO space impact Bitcoin as a long-term investment? Look, the NFT space has attracted a lot of hype. I agree with Stephen that the fundamentals behind it is amazing, and it's something that's going to transform ownership rights. But with that, obviously, you get a lot of hype coming around. I would say probably 99% of people do think that NFT is basically buying an average piece of art for an exorbitant amount. So with that, you obviously get your scamsters and everything coming around. But I think once that ultimately filters out, and we'll probably see that through this deleveraging now, with everyone pulling back, people will understand what an NFT actually means, and that will only help the case for Bitcoin, because it'll help the case for cryptocurrencies in general, and it'll help adoption grow.
Okay, we're going to leave it there. I want to thank you both, Brett Hope Robertson from Cape Town, Stephen Sidley here in Johannesburg with me in the studio. And I think that was very informative. I think what we learned was crypto is not a passing fad. I think it's going to be around for a while. We've seen this before, and we're probably going to see it again, maybe to a lesser extent, these dips and these fantastic rises that we've had. But on the back of that, of course, there's some amazing new technologies which we should keep an eye on, which is NFTs and Web3 and so on. So great discussion. Thank you both.
Thank you very much.
Cheers. Thanks so much.
A fund manager determines what investment strategy is used to invest your money. Their function also includes overseeing a unit trust and managing trading activities. Ultimately, their decisions impact the overall returns of a unit trust. Puseletso Mbele has a BCom in risk management, and she joins me right now in the studio. Her career began in 2005 as a foreign exchange consultant at First National Bank, and she went on to NOAA Financial Innovation, where she was employed as a research sales assistant, responsible for data research. In 2010, she joined Investec Asset Management as a direct desk investment consultant. Later that year, she was promoted to client services consultant. Mbele was appointed as portfolio manager assistant at Sasfin Securities in 2014, and she joined Riskura in November 2014, that same year, as client services manager. Her responsibilities included investment manager research and reporting on client performance. She joined Novare in October 2015 as a fund manager, and in January 2020 was appointed as head of investment consulting and is responsible for overall client fund management and relations. She's based in Johannesburg with 17 years experience in the industry. That's quite an intro, Puseletso. So tell us, I think the obvious question is, why do we need professional teams to help us select fund managers?
Thank you so much, Kieran. So, I mean, I think you'll appreciate that when you look at the universe, right? There's so many asset managers out there. They all, say they do different things. They give you returns. They promise returns, but how they go about doing so is quite different. So even themselves, they're quite different, So I think when you are, as an investor, in understanding your investment goals and what you want to achieve, it's quite important that you then pick a fund manager that's actually going to help you in doing so. So it's then very important that you have people like ourselves or companies like ourselves as Novare that actually help you navigate the whole investment landscape when it comes to choosing an investment manager, because obviously it makes to make sure that it takes your risk appetite. It also takes everything else that you consider when you want to invest.
Okay, let's drill down a little bit on this in the selection of a fund manager. If you look at passive investment funds, why would you need somebody to help you select a fund manager? Because I understand that that's pretty much an automated process. I can understand it for an active fund manager, but I'm less sure about a passive fund manager. Maybe answer that one.
Okay, so yeah, that's very true. I mean, the process is automated, right? But it's also important to then understand how that automation is actually happening. What is the investment approach that is actually being employed in replicating that index? So, and as you know, a lot of these houses that actually do index funds, they use different tools. So the replication of it and the optimization strategies are quite different. So it's very important that you understand the nuances alongside that. So, for example, the rebalancing. How often do they rebalance? If the fund manager does rebalance quite frequently, that's not really what you want, because that rebalancing can lead to higher costs. So you also then want to then be able to say, well, how often do they provide you with daily reporting? And that's also important as well, because if it's done daily, then it means there's more transparency. And then you also look at the tracking error, that the fund manager actually has when you check the tracking error relative to the excessive returns. So you actually want to see how do they really deviate from that. From that. And I think another important thing that people don't actually pay in mind is that the assets under management matter on a passive component, because obviously if the fund manager is quite big, even though they're running a passive house, if it's quite big, then it's easier for you to actually get in and out. So liquidity is then important again. So as much as it might be a passive component where you think actually you can just close your eyes and dump your money there and get out, like sit back and relax, doesn't really quite work like that, because all these other nuances you need to really think about. So even the reputation of the house that you're going to be investing in then does, it's quite something that you can't not take into account. So the size, I would definitely say the AUM is very, very important. I need to know that actually if I invest and then maybe 2 days later I need to do a redemption, it's quite easy for me to do so. So yes, I would say that it's as much as it's passive, and I know with like active, it's more high conviction, and you really have to apply yourself. I do believe that also with passive investing, you just have to follow the same process, because even then the systems as well that they use to rebalance and replicate and all of that, they need to be well resourced and researched systems, and the team needs to be capable in doing that.
Okay, talk about some of the specialities that we're seeing coming out in the investment field. I'm talking specifically about transformation, ESG, which is environmental social governance. Climate change is another one. How important are these in the selection of a fund manager, and how much emphasis are your clients putting on those aspects?
Okay, so I think, like for me, so as an investment consultant, consulting to institutional clients, they are governed a lot by the investment policy statement. And, you also then have the regulator, which has also had certain circulars where it basically tells them that how they need to think about the environment when they invest. So climate change has gained momentum, and rightfully so, because obviously when we, how fund managers invest have an impact. So, and we outsource our responsibilities to the fund manager. So we give them our funds, and then we then say, go buy us a Cecil, go buy us a ShopRite. But what are the nuances? They need to engage with management. So we need to actually hold them accountable to make sure that they engage with management in addressing some of the inequality issues, in addressing diversity, and just like gender parity, that's very important, like the environment as well. I'm not going to drill too much on Cecil, but like all those things need to be factored into. So therefore, having an asset manager that really thinks about those things is very important, because there's been so many research papers that actually prove that having a fund manager that selects or invests in good quality companies does lead to sustainable, good adjusted risk returns. So, they actually go hand in hand. And that transformation and the climate change and the governance does not only extend, or I suppose it's not only limited to how the fund manager allocates or invests, but also the business of the fund manager itself. When you look at the fund manager, the team, how diverse is the team? And I think, with the work that we do, we always interview a lot of asset managers as part of our manager due diligence process. So I've seen that there's actually a strength in diversity. There's different idea generation comes from that, actually having women. It adds a different dynamic to the team. So all of those things are important. You want a team that's quite diverse. You want a team that's really representative to the demographics of this country. You want a team that has a very good track record, that really works well together, and that also adheres to the portfolio and construction process. And even when they deviate from actually maybe a certain stock, you actually want to understand why they're deviating and what are they going to do about it. Because if you look at South Africa, especially our JSE universe, we're quite limited. I think there's like probably 150 investable stocks, so it's not as if like we have a lot of pool to choose from. So if someone really decides to have a Cecil in the portfolio, then they say, okay, fine, I'll have a Cecil, but what is my engagement with Cecil going forward? What do I understand about them actually transitioning the company into a more sustainable house, even for ShopRite, even for Capitec, so there's all those conversations. You need to make sure that your fund manager is actually able to be your activist on your behalf, because you outsource and then you go about your daily life, but you need to actually trust that they're able to do that for you.
It does raise an interesting question as to why these companies that are more transformed and that do incorporate policies for climate change and ESG, why they are more highly valued. Is it because people are prepared to pay a premium for those companies, or is it because they better run, the management internally is better quality?
I think it's better run, it's better quality. But I think you've seen that, if you look at the King 4 report, right? If you really invest and think about or run your business with that kind of mindset, where you not only actually just think about your profits, but also around your communities that you operate in, it will definitely have a spillover effect. So it's not just only you benefiting, but your community benefits as well. And I think that's why you sort of then get those companies that's how they end up doing so well. And I think a lot of that is also starting to change here in South Africa, especially around like the platinum belt in terms of how, your mining companies are investing. They're also starting to think differently to say, what impact are we having in our communities? So it's not just about mining and, taking the profits out, but how do we then give back? And I think then that's more sustainable.
Right. Talk about the due diligence that you do, because you've got a tremendous number of fund managers, both locally and offshore. That's a lot of ground to cover. How deep do you go into each of these fund managers, and how broad is that universe? How many do you cover?
So, obviously I'm going to be speaking about Novare here, but we do a full-scale due diligence, and I think what is great for us is that we've got a proper manager research team. So we have over 9 investment professionals that do manager research due diligence every day, and we cover all asset classes. So South African equities, fixed income, property, as well as offshore. And offshore as well, we cover the same asset classes. And we're also not limited to that. So we do unlisted as well. So hedge fund, private equity, venture. So our manager due diligence really starts from a high level where we look at the survey, the returns components, how are the managers performing relative to their peers, and then from then on we then also scale it down to then narrow it down to your manager research questionnaire, where they have to complete our manager research document, which is always continuously enhanced. And then from that process we then discuss it internally with the team, and then from there, if you like what we see, we then invite the manager for further on engagements. We'll have like a presentation, and from that standpoint, we then after we've had the presentation, we then do the operational due diligence, because a fund manager is going to tell you that, oh yes, we've got offices in Cape Town, I've got offices in Joburg, I've got a team of 6 people, I've got these systems that I use, but really, how do you know? So it's actually important to actually now go there and test what they say and actually verify all of that, and it's quite interesting as well. People would say, you think that a fund manager is supposed to be, regulated. Some, they are so interested in starting the business, they forget all the legal aspects. So we have to make sure we take all of those boxes, and also then we interrogate the portfolio construction further. And once the manager, we've done the operational due diligence, we've actually engaged the team in depth. We then also have a manager scoring committee in-house at Novare. And that manager research scoring committee, based on all the papers that we have submitted, we then put the manager on our buy list. And then from then on, now there's actually active monitoring, because it's also good to have, you can select a fund manager, but now you need to monitor to actually make sure that are they actually sticking to what they had said they'll stick to? Are they investing according to investment philosophy and process, the portfolio construction, the tracking error, what other things are they actually, are they sticking to the mandate in essence? So that's like the monitoring aspect is very, very, very much important, because also things can go wrong. And I think I would like to maybe emphasize on Steinhoff. With Steinhoff, now we had to actually say, what was an investment case? How did you hold this share? And did you not see this coming? Because there's certain valuations. And so those are all the things that I suppose we take into account when we conduct our full-on due diligence. And we apply the same principles locally for local managers and offshore managers.
That's an interesting question, is what did you find on Steinhoff that, because it was being supported very broadly in this country, right up to the point it collapsed.
Right, and that's an interesting thing, because, there were actually, I remember at that time there was a fund manager that was not performing. And I think because, obviously client engagements and client pressures, they found themselves buying Steinhoff. And then this happens, and you're then saying, but for you, that's even worse, because this was not in your portfolio. So how do you then actually how did you come to that decision as a house? And I think that's where the investment philosophy and portfolio construction themes then come in, to then actually say, your fund manager, when they're under pressure, how do they stay to the course? And not get distracted, understanding that the investment objectives are long-term in nature, understanding that also for them, the investment themes that play out are also long-term in nature. So it's also important that you have a fund manager that actually doesn't deviate too much. And even when they deviate, they can actually account on why they deviated.
I want to pursue that one with you. The due diligence, the number of investment teams that you have to cover. I think you told me when we spoke yesterday, you do 150 offshore teams. How do you manage to do that? Because, I mean, they would be all over the world. And how many in South Africa?
So as I said, we've got 9 investment professionals on our side. And I think what the benefits with COVID is that now, embracing the virtual platform. So we still apply the screening process. We do have systems that actually allow us to get returns, see how the managers are actually performing. But in addition to that, we meet with the managers, and then when we are interested, we apply the same principles in that they will complete a due diligence questionnaire, and only when we think that there's actually an appetite for our clients to actually appoint this asset, the fund manager, will we then actually go and do our regular offshore visits. So, recently my colleague, Mr. Jacobus Brink, who's our head of offshore, was actually in London, and I think in the US, where he saw all the different asset managers that are actually on our buy list. So that basically happens, and I think the beauty with the pandemic is that it's actually allowed us to do more, because before you'd only see maybe, you will still get the universe, but you wouldn't be able to maybe have 10 or 9 meetings or 12 meetings in a week. So actually with the us embracing the virtual world, it's actually assisted us in enhancing our processes and strengthening engagements with asset managers.
Right, and in doing your due diligence, what are the typical red flags that would come up? Is it got to do with the balance sheet of the fund manager, or has it got to do with their processes and the way that they report?
I think the process is very much important, because the process is what we would rely on for the manager to generate investment returns for our clients. So we really look at the investment process. Obviously, the manager has to satisfy regulatory requirements as per, with South Africa with the FSCA, and I think with the offshore managers would be where they domiciled at. So that's also important. And I think the team as well is a very important component of our investment manager research due diligence that we follow, because we really want a team that is cohesive, that works well together. And we think the more time that the team is actually in, being together, we think then everyone has immersed themselves in the investment philosophy and process that they are actually trying to live by and generate the returns. And in addition to that, obviously you do want a business that is able to break even. So in understanding that, yes, you might have an asset manager that is starting out, but the sustainability is quite important to then say, at what AUM are you able to be breaking even? Are you comfortable with that number? If you don't break even in 3 or 4 or 5 years, what then? So we actually have to interrogate all of that. And that interrogation is really done on emerging managers who are actually starting out, because the guys who've got a longer track record than more than 10 years, you'd also expect that the AUM is also quite substantial. You expect that, after 10 years, you are actually able to break even, and you're able to compensate your team quite well. We want alignment between your team and the investment team and the client, because when investment team does do well, we as a client also do well. So those are the things that we would look into.
All right, if anybody's got questions, please send them through by email to events@moneyweb.coza. events@moneyweb.coza. And we have got a question in here from Andre. I don't know if this is something you can answer. It seems a little bit specific. But anyway, during COVID times, Andre says, I terminated monthly contributions to a collection of funds via an investment platform. I then noticed that units are being sold monthly to cover fees. Although it was tough to see fees eroding away my retirement funds, I accept this. I have now also become aware of the fact that this approach raises personal capital gains tax. Is it normal for the investor to be responsible for capital gains tax due to activities required to cover fees? That's a good question.
It's a good question. And my focus really is on the institutional side. So I can't really speak too much about, the capital gains tax. But what I can say is that obviously when you do sell, and you have to pay your dividends withholding tax, you have to pay your capital gains tax. But I think also maybe Andre during COVID, I don't think it was also the best time for Andre to have actually exited the market. I mean, the market was quite flat at that time, and I think maybe Andre should have actually stayed the course and stayed invested. Obviously, I don't know the circumstances that led to the decision to actually terminate the portfolio, but I think capital gains tax comes with
Comes with the territory.
It comes with the territory.
Right. Okay, talk about costs for a moment. I mean, as an investor, you have a particular strategy in mind and you have a certain time horizon in mind as well. And if you're in an actively managed fund, you would expect to pay higher fees. But if you're in a passive fund, you expect it to be it's a very commoditized type product, so you'd expect to pay quite low fees. Are investors prepared to pay more for better management, do you think?
Yes, they are. I mean, I think it also depends on the risk budget of the client, the risk appetite that they're willing to take. So some clients do actually understand that actually, for active, it does cost a little bit more. And there's certain asset classes, if you look at infrastructure, the element of work involved, like private equity, it's quite onerous. It's not as simple as in the listed space. And so the understanding is that the private equity manager has to do a lot more, from the due diligence when investing in the investing companies, the legal fees for due diligence purposes that they need to run before they actually buy that company. So, but the returns, on the other hand, could also be substantial. So if the return component is actually quite compelling, clients can pay. Clients are really willing to pay. And I think the challenge on the listed side is that we haven't really seen, there's been a very few active managers actually outperforming the index. And hence the conversation around passive then starts gaining that traction. So until, clients will pay if they see value for it. They'll definitely pay for it. But I think, it needs to be compelling. So if the investment case is quite compelling, I do believe that clients are willing to pay for it.
Notwithstanding the fact that numerous studies show that passive investment funds that track the index or the benchmark are, over the long term, more likely to outperform actively managed funds.
Yes, that's very true. I mean, I think there's been so many journals and papers written about that. But I also think it depends where, So if you look at maybe an emerging market index, maybe investing there, you'd want an emerging market manager that is actually going to be picking the right stocks for you in Brazil. Because you might say, well, Brazil's not looking good right now. Yes, on a macro level, it might not, but there's little germs that a manager can find there. So, then that's very compelling. So I definitely think one needs to look at which index are we referring to. And I don't think it's, you can't really generalize. Obviously, your CapSwix, your S&Ps, your Dow Jones, yes, that's very true. But for some, you might actually need that active component if you really want to get more bang for your buck.
All right, tell us who would be your typical client. Is it the big institutions, the pension funds?
Yes, so our clients is more your pension funds, and I think obviously with them they've got the risk budget, so they actually outsource their responsibility to us. Some of the responsibility in terms of assisting them in choosing, number one, in formulating the investment strategy, assisting them with manager due diligence research, and then obviously assisting with the active monitoring of the asset manager. And in addition to that, I mean, the work then actually extends, so you touched on the ESG components, so drafting your active ownership policies for clients. That is part of the responsibilities that we actually do. And that is also now client specific because one client might have a very different risk appetite to another, and so how they see things is quite different. So we also have to take that into account.
Okay, and one of the things that has, of course, happened in the last few years is the growing sophistication of the investment market, where you have specialities like hedge funds, private equity, venture capital, property, fixed income. Well, that's been around for a long time. But you get this very diverse investment field. That requires a lot of specialization, particularly where you're looking at non-correlated returns, which would be private equity, venture capital, and that sort of thing. How would you look at those differently to investment teams that are looking at stock market and equities particularly?
Okay. So I think, with private equity, deal origination of the private equity manager is important. You would want a manager that has actually maybe had over a 10-year track record where they're able to actually originate a deal and manage and be able to exit the deal. So those are the things that we will then look for in a private equity manager. And that's quite similar to venture capital as well, because, they might be different, but there's similarities in that they would invest in unlisted private companies. So those are the key components that are actually very important for us, because we really rely on the skill set and the integrity of the private equity manager, and then experience then becomes really, really, really important. And even for them, we understand that maybe certain advantages might have been different, in terms of like the performance-wise, and understanding that yes, the performance is not an indicator of future performance, but it gives us a base to actually and understand a thought process in how they go about this. So when we conduct operational due diligence for private equity managers, what we also then do on our side is actually engage with the investee companies to understand what other value set or skill set does a private equity manager bring to the table other than a check, for you to either do your growth expansion that you want to do, So we also then interrogate even the ESG, governance, sustainability, environment. We interrogate all of that. And even with private equity, there's a portfolio construction process that needs to be followed. So that is also then, interrogated robustly before we actually decide to go ahead with that manager. Same with property and venture. I do think that, with especially for institutional clients, and I think investors in general, the risk or thinking about investing is no longer as simple. There's a lot of nuances that one needs to be cognizant of, and I think that's where companies like ourselves, like Novare, come in. Because we're actually able to bridge that gap for clients.
Okay, final question. We're just about out of time. What trends have you seen in terms of fund managers and investment styles over the last 5 or 6 years?
Oh, so I think on the listed side, it's really been your value and growth, and then the momentum has also come into play. But I think really largely because of what happened in the pandemic, you then started seeing a lot of value managers doing quite well. So that's been the most trendy, and I think that deep quality style has come through. And I think in South Africa it hasn't really filtered much because our universe is quite small. So you'll find that a lot of the asset managers who do deep quality and follow that deep quality investment style haven't really fared as well from a performance perspective, because the selection isn't right there, especially if you're going to be really by the book about it. Yeah, so I'll say those are sort of the trends that I've seen on the listed. On unlisted, I think, I suppose it's not really a trend per the style of investing, but I think infrastructure investment is really gaining traction. Venture capital, it's a new asset class to us, and that is really gaining traction, and private equity as well.
Okay, Puseletso, thanks very much for that. We're out of time. Thanks for joining us.
Thank you.
Okay.
Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from credit-worthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
Welcome, my name is Kieran Ryan for Moneyweb, and we're going to be talking alternative investments. Given the drubbing of stock markets around the world, alternative investments are back in favor. These are investments that are not correlated to markets, but they do require a certain patience and a certain tolerance for risk. To explore this, we are joined by Langa Madonko, who is co-founder of Summit Africa, and Lucretia Chopera, Senior Investment Associate at Nice Capital. Just a very quick bio for both of you. Langa is responsible for investor relations, capital raising, and training at niche alternative investment manager Summit Africa. He has over 14 years' experience in financial services and management consulting, and he's deputy president of the Association of Black Security and Investment Professionals, as well as being a member of the Southern Africa Venture Capital and Private Equity Association, or SAVCA. That's quite a mouthful. Langa, welcome.
Thank you.
Lucretia is a CFA Level 2 candidate with a BSc Honours in Economics from the University of Zimbabwe. And she has an MBA from Wits Business School. She's collaborated with over 60 venture capital early stage businesses in the SADC region, originating 14 private equity deals totaling over $80 million, and successfully led 9 exits with a combined $150 million in value. Welcome to both of you.
Thank you. Nice to be here.
Okay, so let's start. Langa, if I can start with you. Give us a sense, because I know SAVCA does this research every year, how big the private equity and venture capital market is. Can you give us a sense of the industry in numbers?
So, thank you very much for that question, Karen. I think in terms of active funds that are members of SAVCA, currently we have a membership of about almost 190 members. And in total managing just over 210 billion rands, most of which is from DFIs, international investors, and then there's a growing trend in terms of investments that is coming from the retirement funds within the South African retirement fund industry. I think as of last year's survey, about 40% of that was existing dry powder available for investments, and there were a couple of exits that were done, which will probably increase the amount of capital that is available for investment into private equity.
Are we seeing an increase in those funds that are available for investment?
So I think with regards to investment by local investors, there's a growing appetite from the pension fund space. I think historically you'd have heard that retirement funds were under less than 1% in terms of their investment into private equity at about 0.3. That number has steadily picked up, and we're seeing a lot more pension funds starting to make inquiries about investment into private equity infrastructure, and some are trying to now start figuring out how they play a role in terms of venture capital. But if we look at it from international investments into the space, I think gradually that has come down somewhat, mainly because I think there have been more attractive opportunities historically that have emerged within their local economies. And then also I think we've suddenly found ourselves, from a South African perspective anyway, being a lot more favorable also, and a few DFIs are starting to, international DFIs in particular, are starting to look at South Africa as a potential investment destination through private equity as an instrument to deliver the capital to the investments.
Okay, Lucretia, from your position, are you seeing increased flows into the space?
Yes, yes, and like as Langa pointed out, the market has turned somewhat in more recent months, but overall, if we look at where the industry was, particularly for VC 5 years ago, we're seeing a lot more flow into unlisted space, not just in South Africa, but across Africa, mostly driven by, I think there's a general realization globally that VC and innovation has a critical role to play in terms of driving the financial inclusion, which is critical for economic growth in Africa. So we saw over 2 billion, for example, coming into African VC space, 50% of which was from fintech, for fintech related investments.
There used to be a kind of a theory, I don't know if that still exists in the venture capital space, is that if you make 10 investments, 2 of them will be blowouts, they'll be fantastic. 5 of those will probably be okay, and 3 of them will be washouts. Is that still true?
Yes, I think VC definitely is a portfolio play. It's also a long play. So I think that's where the reluctance was. It's not very liquid. You have to look to between 5 and 10 year horizon, and depending on where the market was, sometimes you have to hold your positions a little bit longer to avoid fire selling. So yes, that's still kind of the metrics, but every fund, depending on the fund, measures their performance. Some are more impact funds, so they are measuring not just the bottom line, they're also measuring impact in terms of job creation, in terms of innovation. So it does depend, but generally that's on a portfolio basis. That's kind of the game that you're playing.
Okay, a question for both of you, and it's just what sectors is this money going into? Are there certain sectors that are attracting more money than others? I'll ask you first, Lucretia.
Yes, I think just in terms of the unique challenges faced by African economies, you find that most of the money that came through into the VC space in particular was for fintech or tech-based businesses. But I would say on the private equity side, we're still seeing other strategic plays from private equity players where they invest into more traditional spaces, energy, for example. But a lot of the funding, I think, was driven by tech-enabled businesses, whether it's into healthcare, into any SaaS-driven opportunities, I think drove most of the investments.
Lango, what's your experience?
Yeah, I think in my experience, a lot of capital, yes, is being formed within the energy space. I think, yeah, as Lucretia has said, everybody's trying to take advantage of the demographic dividend in the African landscape and the potential for those sectors. I think you are also seeing a big investment into what are impact sectors. So we're seeing the formation of funds that are focusing on food security. We're seeing the formation of funds that are focused on delivery of healthcare, education. Thematically now, there's also a growth in funds that are focused on water, sanitation, and that entire value chain. And then also, I think we're also seeing, again, continued investment into fintech, financial services, everybody understanding the importance of being able to move money and to transact and what that does. And I think we're also seeing a greater emphasis amongst investors on saying, don't just show us the bottom line that comes with these businesses, but show us the social uplift, show us the jobs, show us the impact that you're having in the communities and how these businesses are benefiting them, show us how we are also being an enabler for other small businesses to benefit within those communities. And those are the spaces where the greatest amount of capital is flowing to.
Yeah, and if I may just add also, just in the logistical space, I think infrastructure investment, whether it's digital on the telecom side or just, delivery, enabling delivery and fulfillment, there's also been a lot of investment in that across Africa, not just South Africa.
All right, so this great infrastructure boom that has been talked about all over the planet, it's not just in Africa, that's attracting a lot of investment. And I guess healthcare and food security, you mentioned that. Mm-hmm. Those are three of the big themes?
Definitely they are, and I think it's more out of necessity than anything else. I think COVID and the need for social distancing required that fulfillment be done in a way that wasn't sort of necessary before in Africa. And we are also seeing a lot of the informal sector being brought in because of financial inclusion and more investment in that space. The cost of processing financial payments has come down, and so that's bringing in a lot more players from the informal sector. But I think what's still lagging behind, in a sense, is just enabling that fulfillment and making sure there's supportive infrastructure to allow for that. So we are expecting that trend to continue in terms of building up of the infrastructure, because there's still a lot of opportunities in that space.
All right. Langa, I mentioned in the intro that it requires a certain patience and risk tolerance in this particular field of investment. In many cases, you've got to wait 5, 7, even 10 years to get a return, right? Yeah. So this is not for the person who's a trader and he wants to go in and out quickly and make a quick profit. Is that changing? Are the time horizons still pretty much the same? Are they getting a little bit shorter? What's the experience there?
So I think from an experience perspective in terms of time horizons, I think actually the timelines are getting longer. I think the global trend is a movement from closed-ended funds to open-ended funds, because I guess the majority of the capital that you're actually managing, if you're a private equity manager, is generally retirement funds, endowment funds who have a longer term horizon in terms of what they're looking for in terms of investments, right? They're always looking to match their assets and liabilities. So if you can find an investment that has longevity, that has growth, that can deliver a consistent yield to the investors while at the same time achieving capital appreciation, those are the type of investments that they like. I think from a South African perspective and an African perspective though, there is a need for longer tenured investments, because I think time to maturity of some of the investments that we make is actually longer in Africa, because many of the industries that we're investing in real terms compared to the developed world, are nascent, and there's more that you can do to gear up the type of returns. And definitely if you're someone who's trading, this is not necessarily the space for you, because liquidity is one of the constraints that they speak about, and ultimately for that inherent illiquidity is where you get the additional uplift in value that one is looking for from an investment perspective.
Right, just a reminder to people who are listening in, if you want to send questions, send them to events@moneyweb.coza. That's events@moneyweb.coza. Langa, I want to stay with you for a minute and just talk about the type of due diligence that you would typically do when you're evaluating a company. I mean, particularly with a VC company which hasn't got a trading record. You know, you're dealing with a spreadsheet which is entirely hypothetical, and these spreadsheets can be made to show anything. How do you make a decision on a project? Is it you looking at the people involved, the management, or the technology, let's say, if it's technology-based?
So I think in our due diligence, the first consideration is always going to be people. I think you're always more than the horse backing the jockey. And an ability for management to show that they've got a grasp of what is their primary and core focus in terms of what they're trying to deliver is always going to be significant. An appreciation from the founders that they might not have all the core competencies, so that capacity to start to build teams that complement their skill set is also going to be something that is fundamental in terms of the due diligence. Then after that, I think it's an assessment of the market and the market opportunity. You also want to understand that the product that is being built, the solution that is being devised actually has a market that it serves, and what is the potential size of that market, and then you're also assessing, I think, time to market. How long does it take you to have something that is viable, scalable, and something that actually makes sense for you to take into that? And I think in many instances we do look at the financials, and then we don't take them with a pinch of salt, we take them with a whole bag of salt. Because I think entrepreneurs,
yeah. A good game.
Yeah.
Lucretia, is it the same for you? What's your due diligence process?
Yeah, due diligence is definitely a critical part of our investment process. What we do is, during the first conversation, you are definitely assessing who you are backing, and there needs to be alignment with the founder's vision. We need to also buy into the vision, particularly for us in VC, because it's very early stage. So sometimes it's difficult to actually know with certainty whether something's going to pan out the way it planned. Where we struggle, where we find sometimes we struggle, we might love the tech, and the tech DD report might come back great, but valuation, sometimes there's a discrepancy, and that's where the financial modeling comes in, and where, you know, there's often a bit of a tug of war with founders to make them understand which multiples we can enter the investment with, because with us, we always look at the potential exits during the DD part of the process. So the exit multiple is a part of the consideration. We begin with the end in mind, essentially. And that's sometimes very difficult for founders to understand. But we actually also do it with the consideration that there might be need for them to raise additional series in the near future, because sometimes part of it is actually looking at the gaps, making sure that they've raised adequately for their go-to-market strategy. You find that when you look at the South African economy in terms of maybe the marketing team that you need, the sales team, even the dev team, it might be cheaper than, for example, an opportunity that's now looking to break into US markets or European markets. So you do need to then raise additional funding if you're going to go global with the opportunity. So sometimes there is that tag, but what we do, by the time we finish the DD, we have an agreed a cash flow projection. Obviously, it won't pan out most of the time the way you planned it, but we sort of use it as a base, just to say, okay, actual versus planned, how we doing? So we kind of peg ourselves with that agreed financial model with the founding team.
Langa, I mean, it's often been remarked that entrepreneurs don't often make the best administrators or the best managers for a company. They are the people, the dreamers. They come up with the idea or the product. How do you view that? I mean, would you want to bring in, when you're assessing a project, would you want to bring in professional management?
So I think we found that the bulk of the entrepreneurs are grand dreamers, visionaries who, if left alone, would just be chasing their tails all day with multiple dreams that they're trying to make come true. And I think we're always very cognizant to speak to the entrepreneurs, to let them understand what is the importance of bringing alongside them people who are administrators, operational, people who can support the vision and actually create the infrastructure that is required for it. And we also then spend a significant amount of time trying to also talk to them about how is it that we create a framework that makes sense in terms of an incremental approach to growing the business. Because like Lucretia was saying, you get there and this person tells you that my business is worth R1 billion and you can't see where the R1 billion comes from. But incrementally, you start to tell them that, look, we need to make sure that we have a governance framework that makes sense. How are we constituting your board? Who are we putting in place to do the financial management so that you can focus on what you're good at, which is the ideation, which is growing the product? Who do we put into a position of sales and marketing? How do we manage the people around you? What are we thinking about from a legal framework in terms of where are we setting up and domiciling the business? How are we thinking about issues like tax? And many times, I think the entrepreneurs are reluctant in the beginning, but they start to see the value uplift that comes from being able to put in place that framework around them to enable them to actually be the superstars and rock stars that they actually want to be.
Right. And I mean, I guess that, by the way, anybody sending questions, send it to events@moneyweb.coza. We welcome your questions. Lucretia, I see that you've been involved in 14 private equity deals across the subcontinent, total value $80 million. Tell us a little bit about that. Were the investors local, foreign? Was it a combination of both? And is there an appetite amongst foreign investors for African investments particularly?
Yeah, so I worked for a regional fund. It was a USAID fund, so it just had the one investor in it. Typically, you do see a lot of appetite from DFIs, from internationally, but we're also seeing a lot of interest from family offices, from angel investors, and like Langa pointed out, also from our pension funds locally. We even have a bank that's backing us up for our most recent Series B fundraise now, which is exciting. I think there is an understanding that each segment across the funding from VC to P in the middle to listed companies plays a critical role for that space, and entrepreneurs need support to go through the different stages of their entrepreneurial journeys. So we're seeing a lot more interest from different types of LPs now, which is very exciting.
Right, and so the sovereign risk of investing in South Africa or Zimbabwe or wherever is not so much of a concern in that particular area.
It is. I think economic policy is always important. That's why SAFCA are always knocking at the president's doors. There's a SA Startup Act now that we're pestering the president about for a reason, because investors do follow where policy supports better returns. So in terms of the countries that we focused on during my time with that SADC regional fund, it definitely, there was a good relationship between the US, for example, and the local government. So that's critical, that's important. I think money does follow sensible policy.
Which countries in Africa would you say have got the best policies to attract investment? I know that's a very difficult question because it's very sector specific, but you know, take mining, for example. We see that Zambia was very hostile towards mining at one point, and they now have a new president, a new government that is very friendly and is calling for investment. We're also hearing talk about Zimbabwe attracting investments for the first time in probably in decades. In Harare, there's a lot of building going on.
I think that's the biggest challenge with investing in Africa. It's policy consistent. So the idea for administration is to make sure that it carries over progressively from one president to the next, not the policy reversals that we typically see with African, with typical African political parties. I think the idea is to progressively making sure that your policies are consistent, because obviously international investors are looking out for that. Luckily, I think for Africa, there is a market that almost exists separately from the politics, from just all the other dynamics. For example, we saw Nigeria leading in terms of capital flows over a very difficult COVID period. We saw flows into Nairobi, into Egypt, Senegal also last year. South Africa, thankfully, was also in there. So, that's what you want to see. You want to make sure that as much as possible, you're lobbying your governments to actually just implement policies that attract investment, not the reversal.
Langer, did you want to add to that?
Yeah, I think if I am brutal about it, people will do business anyway. They will sometimes do business in a place where there's war because of certainty. It's not necessary that anyone is looking for policy that is always pro-business. They're just looking for certainty. You want to know the rules by which you're playing. And I think that has been one of the things that has hampered particularly investment into our country, that consistently we come up with great policy. The implementation is what everybody struggles with. And the frequency of change is also what everybody struggles with. So I echo the same sentiment that Krisha was making, that we do want to go to the places where business is incentivized, but we do want to go to the places where we know that this is the rules along which we're playing. I think it's always one of the things that we bring up when we talk about transformation in South Africa, that many times investors are uncertain about what the BEE framework is. And everybody has always argued that it's because people don't want to cooperate. But China came out with a policy and said all businesses shall be 51% owned. There's no room for compromise, there's nothing. And the certainty allows international giants that have grappled with whether or not to come to South Africa to participate in that economy. So I think ultimately all everyone is looking for is certainty.
Yeah, even if you have to give up 51% of your ownership, companies are prepared to do that if they know that's fixed and it's not going to change.
Yeah, exactly.
All right. There's a question coming in here from Joseph. He asks, do you see VC investments, given developments in a specific industry, being prone to becoming public, in other words, listed on an exchange, or in the longer term, given the time horizons of 10 years, will they remain private? Where the founders remain involved, there's a low employee count and interactions with investors. Yeah, I think that's a critical question.
Yeah, that's a very good question, Joseph. So I think by its very nature, VC and listed markets don't go hand in hand because, first of all, it's a long play. So it cannot be driven by market sentiment. So you find that sometimes there will be failures. Like you said earlier on, sometimes out of a portfolio of 10 businesses, 5 might not make it because it's early stage, it's very high risk by its very nature. So if it's on a listed market where value is driven by market sentiment, that's going to cause a lot of volatility. So by its very nature, I think because it's early stage, it requires very patient capital. So no, I wouldn't support VC. Maybe it's been tried with private equity, but it also didn't quite work because, initially the private equity funds that listed on the JSE where, the valuations were even at a premium to book. But that quickly got reversed, not because there was a problem with the underlying asset, because of just market sentiment. And overall, that's really not how you want to balance your portfolio in private equity funds and in VC. So I would say I think it's unlikely, but you don't want to say never. People are becoming very innovative these days. But particularly for VC, I don't know, Langa, what do you think? It's, yeah.
Yeah, so I think the global trends, and even in a South African perspective, companies are staying private longer. Amongst the numerous constraints that people speak about is the burden of listing, from everything from reporting to the fees that are charged, the number of service providers that you require to remain listed. The second aspect I think many people are discussing about whether or not to list is also on, as Lucretia said, market sentiment versus time to, can I call it, fruition. So most of the businesses don't necessarily need the additional pressure of having to benchmark themselves on quarterly performance when actually it's a 5, 7, 10, maybe even 15-year play. And founders, private equity practitioners alike are seeing that in the unlisted space, you do have the patience, you do have, for lack of a better term, the privacy to be able to implement all the things that you need to do in order for you to build the entity and the enterprise of the future that you're trying to build. I think ultimately, though, one must always be cognizant of the fact that the stock markets themselves offer a very attractive route for exit for private equity and also in some instances for venture capital alongside things like trade sales and so forth and so on. And I think there will always be room for it, but it's always going to be about the right time to do it. And I think we're also seeing in the local context, a lot of the businesses that listed are delisting because there's also a growing pool of capital in the unlisted space, and that's becoming a lot more attractive to them. Also, there's the active participation of the private equity and venture capital managers in assisting you to grow. That is more attractive than the, shall we call it, passive capital that you get from the listed exchanges.
Lucretia, a question for you. How do you scout for deals? Do you have a network of scouts, or do they come to you because they know that you've got money and they're looking for money?
So I think we do scout for, you can't just sit back as a VC. There's now increased competition. So the reason why we do this, you network, you're out there and making sure, the knife name is known and recognized in the market. Your track record speaks for yourself. Sometimes we're invited to cap tables where there are other investors that know us, that are friends of Knife, that will invite us to co-invest with them. So your track record is a good deal flow source. We get a lot of pitches yet, but because typically a VC is a small team, you don't actually have capacity to sift through the hundreds of applications that you receive on a monthly basis. So I think typically you tend to focus on the deals that are referred to you. We've got strong networks, not just in South Africa, across Africa, but you want to be out there. So there's several ways that you source. You don't just want deals, you want also a good deal flow. For Knife, we do have Grindstone and Grindstone Ventures as well, which also is an entrepreneurship program where we train our own entrepreneurs. We help them with creating a properly structured data room. We educate them about fundraising because there's need for that, especially with first-time fundraising founders. Then we also have Grindstone Ventures, which actually gives, it's limited amount, but it's still seed capital for founders. So that's our other source of deal pipeline. So there are various ways that we create our pipeline.
Same question for you, Langa. How do you scout for deals?
So I think with us, part of it is, yes, We want people to know we have money and come to us with the opportunities that they're looking at. But we also have relationships with professional service providers, the audit firms, the law firms, people, the banks who are advising some of these businesses across different segments and for different reasons. And because of those networks, we're able to receive referrals. But also there are instances where we are the ones who are looking at what's the market segments that we're looking at and actually approaching the entrepreneurs because we see a potential alignment of interest in terms of how we can work together towards a particular outcome. In some instances, we are also talking to, as Lucretia said, to other private equity fund managers to understand what are they doing, where are they seeing opportunities, and how we can collaborate with them. And I think of late, a lot of private equity funds are also looking at the JSE as a source of potential deal flow, because I think there still will be some movement in terms of the smaller cap businesses delisting in order for them to come into this environment where there seems to be a lot more capital and a lot more room for innovation and growth without the constraints of being listed.
Right, and of course the cost of being on the stock exchange are one of the common reasons cited by companies that delist wanting to go private. Lucretia, this whole question about what does the entrepreneur get? You know, somebody's got a bright idea, he's got a product, he's a developer, he's a techie, and you know, he comes to you. Why would he be interested in approaching a Knife Capital, for example? I mean, if you look at the Bidvest model, which is really quite ingenious, the way that they would plug in, they would buy out a business, and they could immediately expand the network, the number of clients for that new business. It becomes, when you reach a critical mass, it becomes a lot easier. That, of course, is one of the things, no doubt, you can provide because you have investee companies so that you can plug them into those companies and give them a bigger market almost straight away.
Yes, so then the DD that I spoke to earlier also applies to the founders. You also need to understand the motivation of the people that you're bringing into your business. Because remember, this is a long-term relationship. So alignment is important. You need to really understand the motivation and what value add the VC fund that you're partnering will bring for you. For us at Knife, we always put it in our KNF values, which is our knowledge, which is also funding, and most importantly, the networks that we bring to that founding team. So that's really the value of Knife to you. When you come, it's not just about us providing funding, it's opening doors in terms of your go-to-market strategy and you know, making sure that we open doors, we facilitate meetings with potential key customers, for example, if that's what needed. At DD stage, we are very mindful about gap analysis to actually, you know, diagnose what each and every opportunity, because each and every opportunity kind of takes a life of its own. So we kind of, you know, make sure we have conversations around what we see and how we interpret where the business is. And then we come up with a 12-month strategy for the business to say, this is where we see you are. These are the milestones that we think we can achieve in the next 12 months. And so there is that agreement with the founding team to say this is, you know, the gaps that we see. And if we are aligned, then we go ahead. We don't just come and say we're going to give you funding, because they definitely, in terms of support, especially in volatile markets, they need more than just funding.
I would imagine that valuing a business which hasn't really been tested in the market or hasn't grown is quite difficult. It's a bit like the Shark Tank process, where somebody does a 10-minute pitch, and you know, the billionaires behind the desk, they say, yeah, we'll buy 15% of that for $150,000. I mean, how would you value something that hasn't been tested?
So if it's pre-seed, I think we do encourage, first of all, entrepreneurs to bootstrap as much as possible. And then we also use other instruments like safe agreements that delay the actual valuation process where we are not too sure we can come to an agreement. Because sometimes we do like the opportunity, we do like the team, we see where we can add value. But in terms of actually coming up with a valuation, sometimes it's just too early. So we use safe agreements. We use convertible notes sometimes just to make sure we're delaying that until we have more visibility.
Right. Langa, I would imagine one of the reasons people would be interested in this sector is that they're going to get superior returns. Can you give us a sense historically what those returns have been for private equity and venture capital?
So I think generally private equity in the South African context also benchmarks its performance against the JSE and listed investments. And I think in many instances it's been benchmarked against the Capswix, it's been benchmarked against all the benchmarks. And I think from performance perspective, it has, even in the periods where there's been a lull in terms of economic performance in South Africa, it has always managed to run between 3 and 5% above those benchmarks. And I think it has also been a driver for our performance. And I think if you also then look at some of the new segments that continue to emerge on the JSE. So for example, if you look at the top performing asset class within the real estate segment of the JSE would be industrials. Industrials started out with majority of the portfolios being unlisted property portfolios that then went on to list. If you look at now one of the fastest growing segments, I think some of the listed entities are now starting to play in that space, which is hospital property or hospital infrastructure. It started out with the majority of the portfolios being held privately, and now there's an opportunity to list them because everybody's starting to see the outperformance that they're able to give. And so traditionally, I think whether you measure it over a 5-year, 10-year period, private markets have generally been 3 to 5% above. And part of that is also, it would have been better, but I think the slow economic growth in the South African context has somewhat contributed to that lag. From an international perspective, if you look at the same numbers, you'll find that if you look at some of the international private equity investments that have been made by entities such as CalPERS, CalPERS has about 20% of its, at about 18% of its book in private markets. But private equity being 18% is delivering almost 40% of the growth of the fund because of the significance of the lack of correlation to the listed markets.
Right, I mean, that is a point that we mentioned in the intro, that the lack of correlation is something that makes this very attractive. You talk about CalPERS, which is the Californian, is it pension fund or a public pension fund? Yeah. Look, we are running out of time here, but just a point on that. The fact that this is a non-correlated market is one of the reasons that investors are looking at this sector, correct?
Yeah, precisely. I think also the fact that you are off market, it just relieves the pressure of, looking at your performance on a quarterly basis. So it's more long term in terms of go-to-market strategies. It's very unlikely that you're going to see results within a quarter or within 6 months. So the long-term nature is critical.
Okay, we're going to wrap it up there. I want to thank you both, Langa and Lucretia, for coming in here and giving us your very insightful view of what's happening in this quite interesting sector of the market. And I'm sure people will start to look at it a little bit more thoroughly as a result of that, particularly the fact that it's not correlated to the market, that there is growing attraction from outside South Africa. And there are sectors here which are that we've been talking about, where infrastructure, healthcare, food security, which are very attractive for investors. But you've got to be in it for the long term and be patient, because it's not going to be a quick return, right?
Yeah. Thank you so much, Kieran.
Thank you both.
It's been a pleasure.
I'm ready. Welcome. I'm Kieran Ryan, host of the Moneyweb Crypto Podcast, and we're going to talk about crypto arbitrage this afternoon. It's become a very popular alternative to any other kind of investment because it promises returns that are not correlated to the market, or indeed to the prices of cryptos generally. It involves buying cryptos on overseas exchanges and selling them in South Africa at a higher price. That's what arbitrage means. Now, there's a lot of questions around this. Is it legal? Are the returns sustainable? What are the risks? How does one get involved? Well, joining us to discuss this is Harry Scherzer, who is CEO and co-founder of Future Forex. Harry is a qualified actuary. That's a good thing to have in a crypto arbitrage business. He's got a background in finance and risk management, and he's been involved in arbitrage in a variety of forms over the years. Given his technical background as an actuary and his interpersonal skills as a business development director, it was inevitable he would go on to form Future Forex as a vehicle for automating crypto arbitrage, and that is exactly what you do. You make this as seamless and automated as possible. And I suppose it should be mentioned that Future Forex is a licensed financial services provider for currency remittances. So we'll come to that in a minute, because I think that's one of the issues that people have questions. Are you regulated? Do you have to be licensed and all that kind of thing? Harry, perhaps a good place to start is to explain what is crypto arbitrage, what kind of returns have historically been achieved? And let me just add the disclaimer that historical returns are no guarantee of future returns, right? So, but anyway, pick up that question about the historical returns.
Yeah, Kieran, firstly, thanks so much for the very warm and welcome introduction. And I was very excited to be invited here, not only because this is such a high-profile event, but also because it gives me the chance to educate your audience and South Africans in general on an investment opportunity that, in my view, has been largely under the radar. And I've picked up two key reasons why it's gone under the radar. The first is because the returns tend to seem to be too good to be true. And the second is because it involves cryptocurrencies, which are notoriously, number one, extremely volatile, but number two, have been associated with some foul play and notoriously negative affairs in the past. And my aim for the talk today is to simply debunk these two concerns in the context of crypto arbitrage in particular, and argue that every South African investor should have at least a portion of their investment portfolio in crypto arbitrage. So I'll start on the idea of this being too good to be true. And before I do, you have to understand what the returns are. But before I get there, maybe it's worth actually quickly taking a step back and discussing what is crypto arbitrage. And crypto arbitrage, very simply, is the process of buying cryptocurrencies abroad and simultaneously selling them in South Africa at a profit. And the reason that this is possible is because cryptocurrencies like Bitcoin in South Africa trade at a 2 to 3% premium compared to those abroad. So effectively, all Future Forex does is it provides a vehicle to take investors' rands, send them to dollars, buy cryptocurrencies with dollars, send the cryptocurrency to South Africa and sell them again for more rands. And because you start with rands and end with rands, you can do the same process over and over again as a loop, which is where these exceptional returns come from. And while each loop might only yield a 1 to maybe 1.5% return per trade, because trades take only a couple of days, people can trade 50 or 100 times in a year, and that's how these extremely high and lucrative returns are possible. And in fact, our average annualized return as Future Forex for clients exceeds 80% per annum. And maybe this is quite difficult to comprehend using numbers. So instead, I think it's better to use a graph, which, if you guys don't mind pulling up the graph over here. While we're waiting for that, the graph effectively shows the return of Future Forex, of putting 200,000 Rand in Future Forex and comparing it to putting 200,000 Rand in, here it is, in any other investment, in the S&P, in the JSE, in an 8% earning bond, and in Bitcoin. And you can see the blue line shows Future Forex's returns, which are chalk and cheese with any other investment of 200,000 Rand. As we know, the JSE kind of goes in a straight line, but the best of the bunch, of the alternative bunch, would have been the JSE, the S&P, whereby you would have ended on around 233,000 Rand compared to 550,000 Rand through Future Forex.
And that's over 1 year.
This is since the beginning of last year, so so it's over an 18-month period. And what's even more staggering in my view is not just the difference in returns, but the consistency of returns of Future Forex's.
Yeah, the beta, the smoothness of that graph is quite unmistakable. So you go on from 200,000 up to 550,000 with not much risk. Now, people might have a little bit of difficulty understanding that because, you know, we've seen Bitcoin drop since November last year, you know, close to 70% at one point, and Ethereum even more. So maybe explain why this looks so smooth, and yet you're doing crypto arbitrage.
Yeah, so what it comes down to is because we have a fully hedged solution, the risks which are typically involved with crypto arbitrage, the market risks, for example, the Forex risk in that you send your money abroad, what if the dollar tanks over that time, the crypto risk in that when you buy crypto might go the wrong way, those have been completely eliminated from our product by holding floats abroad and in South Africa. So effectively, as we send clients money abroad, we're able to action the purchase from dollars to cryptocurrency abroad, and at exactly the same time, sell cryptocurrency to rands in South Africa. And then it's simply a matter of waiting for clients' funds to arrive to replenish our floats. But the clients are therefore not affected by any market risks. This isn't to say, Kieran, that this is risk-free. No investment in the world is risk-free. And the remaining risk which investors take on is third-party risk. So we deal with a set of third parties when performing our process. An example of which is Mercantile Bank, which are the business division of Capitec Bank, who we do Forex through. So when sending money offshore, we lock in a rate with Mercantile, and if for whatever reason Mercantile didn't fulfill their obligation and didn't send the money through at that rate, we'd have to probably send it through at a later date and be exposed to some fluctuation. But because we handpick our third parties and do significant due diligence on those third parties, this has never been an issue. We've never had a third party default on anything they've promised, and for that reason, we see it as a relatively minor risk. So the risks in general are relatively minor.
Okay. Now, I think the question of legality and regulation comes up a lot with crypto arbitrage. Cryptos are not regulated in South Africa at the moment. So explain that. And, you know, when regulation comes in, will it be beneficial for this market? Or, as some people have suggested, might it kill the arbitrage opportunity completely?
Yeah, so let's start off with the legality point. The short answer is yes, crypto arbitrage is fully legal. Firstly, the Reserve Bank have put an FAQ on their site where it has to do with the purchase of Bitcoin abroad, which is exactly what we do. And it quite clearly states that using your FIA or SDA, which are the 11 million Rand allowance, which I'll touch on in a bit as to why this isn't too good to be true, when using your allowance, you may purchase cryptocurrencies abroad. And on top of this, when we apply for FIA applications, because you need to apply to the...
Just explain FIA.
So an FIA is, of the 11 million, 10 million of it has to be approved by SARS. And you need to, our team internally, our tax team does that for clients. We do this approval. And in doing the approval, when it says the reason for sending excess funds offshore, we always say crypto arbitrage. We're completely transparent with them, in line with our ethos of transparency with clients and regulators. We're completely transparent with them and tell them that this is for crypto arbitrage. And as a result, the SARS approves these applications, which shows both the SARB and SARS are fully on board with crypto arbitrage as a investment mechanism.
Right. So there are two components to your foreign currency allowance. The first being your special discretionary allowance, SDA, which is 1 million. You need no approvals for that.
No approvals.
The second one is your FIA, your foreign investment allowance, is 10 million. For that, you have to have tax clearance.
Correct. You have to have tax clearance, which we do free of charge as a complimentary service.
You do that No charge?
No charge.
Okay. So a person would have 11 million a year that he could cycle through. He can start with what, 100,000?
100,000 is our minimum. The more you invest, the better you tend to do because of fixed costs, which reduce as the amount invested increases. But 100,000 is the minimum, and you'd have to do, with 100,000, you'd have to do 110 cycles over a year to get through that 11 million.
And are there people doing that?
Yeah, people typically start with 100,000 and end up increasing it because they gain trust in the process.
Right.
And yeah, lots of people are investing 200,000 plus and have got through their 11 million already, and it's only June.
And of course, if you're a couple, you've got 22 million.
Correct.
If you're a married couple, right?
Correct. Each person has their own 11 million, so the couple has 22 million combined.
Okay, and I mean, you can blow all of that on crypto arbitrage. And looking at those returns seems like not a bad idea.
Yeah, Kieran, maybe it's a good time for me to say why it's not too good to be true, because we're at a point now where this seems incredible, where the returns speak for themselves. And it is quite important to realize that because of this, these allowances, so the same reason that the arbitrage exists in the first place is the biggest limiting factor of what you can earn off it. So this isn't some get-rich-quick scheme where you can stop investing in everything else, quit your job, and just make exceptional returns of this. There is an upper limit. Because of that 11 million, the upper limit on what you can earn tends to sit between 100,000 and 200,000 Rand per person per annum. So it's a great kicker in your portfolio, but it's not something to retire off. And that's why, in my view, I argue every South African should have at least a portion of their portfolio invested in arbitrage. So if they do get through their full allowance, they can make an extra 100 to 200K with high returns and low risk.
Okay, so 100,000 is your minimum to start. What is your typical size of investor?
Our typical investor is 200,000 Rand plus. Guys go up to 1 million. We typically don't recommend more than that because even with 1 million, you're only going to do 11 cycles through the year. But typically, guys are putting in 200 to 400,000 Rand.
And we talked about risks, and third-party risk being the biggest one. You know, the bank or the exchange that you're buying from, or, you know, they go bust, that would be a risk, or they fail to execute. What about future forex? Is there, you know, do you at any point have, you know, are you bulking up the assets at a certain point and having control over them? Would that be a risk?
Yeah, so as being in the crypto space, of course, our credibility is extremely important and a key component to getting this opportunity out to the mass market. And because of that, we've tackled regulators head on. We've been chatting to them for years, and we've said, please regulate crypto, because we'd love to have regulations to have a stamp of approval that everything's going correctly. Unfortunately, we're still waiting for them to regulate that. But what we've done in the meantime is we have become an FSP, so we're regulated by the FSCA. We've done that optionally. It wasn't required of us at the time. And in the process, we've been audited by Mazars. Now, the reason we chose Mazars and not some backdoor auditor who were, number one, far cheaper, and number two, probably would have been an easier audit, is because, again, the credibility of Mazars, who are the experts in this, the expert auditors in South Africa in the cryptocurrency space, was to prove that there's no hidden agenda going on here. Everything we say we're doing, we are doing. So within the means of the law, we've regulated ourselves as far as we can to be as credible as possible. And that touches on that second concern I find from people, which is this is in the crypto space. Where's the credibility in that? And that's why we've taken every avenue we can to be as credible as we possibly can be.
Yeah, I mean, it's rather similar to having stocks, as used to happen in the old days, Anglo-American listed in London and in Johannesburg, and the prices would be slightly different. And people would, you know, get information about the price mismatches and be able to arbitrage that, and that was going on decades ago. So this is not something new.
No, it's not a novel concept at all. It's just in a space which is so new and novel, being the crypto space, that it hasn't equalized itself due to these foreign exchange allowances. And it could have been avocados, it could have been anything, but it just happens to be cryptocurrencies that we've seen a price difference with.
I mean, if you go back a couple of years, this arbitrage gap, this mismatch in price, was as high as 25%. And then even more recently, we've had the gap, the arbitrage gap, go to 6-8%. And if I remember correctly, that was on a Sunday. Now, markets, you know, exchange, you can't buy foreign currency on a Sunday because you've got to deal with the banking system. You can, however, buy cryptos. Can you grab that 6 to 8% profit if it appears momentarily on a Sunday?
Yeah, so Kieran, our only restriction is when the bank is open, and the bank, Mercantile, are open from around 7:30 a.m. until 5:30 p.m. every Monday to Friday. So if this occurs on a Sunday, unfortunately, we wouldn't be able to grab it. However, we have a trading team sitting and watching for those momentary spikes during the weekdays, and they'll be able to grab it as and when it happens. Even if it's for a momentary second, we see a spike, we'll be able to grab that.
And I mean, can you grab, multiple times?
Yeah, we can grab as many times as we as it comes up. The only issue is volumes in South Africa. So if there aren't volumes at that level, we'll grab for however much volume there is. But that's the real limitation, is how many people are selling at or buying at a certain price in South Africa.
Okay, so let's talk about costs. I mean, you mentioned this arbitrage gap or premium is about 2 to 3%, but that's not what the customer is seeing. The customer is seeing between 1 and 1.5%, right? So there's a cost component there. Just break that down for us.
Yeah, no, typically customers are seeing between 1 and 1.5%, and the reason for that is the third-party costs of sending money offshore, buying cryptocurrency, sending the cryptocurrency to South Africa, selling it in South Africa. Those third-party costs, depending on what you invest, range between around 0.3% and call it 0.7% is what is taken by the third party. And then we thereafter take a percentage of profits after costs. We take a percentage of profits to ensure that we're perfectly aligned with our clients so that whatever they earn, we earn in proportion. And that ensures that we're really going to try and target those spikes because it benefits us as well as our clients.
So is it a sliding scale of profit share?
Correct.
And what is the extent of that scale?
Yeah, the sliding scale is the less you invest, the higher the profit share we take. So it encourages people to invest more per cycle, which is just better for everyone. Everyone makes more money. But and it goes from, on 100,000, we take 35% of profits, and it goes down to 25% of profits for 400,000 plus, and there's a sliding scale in between that. So the more you invest, the lower our fee, the lower the third-party fees, and essentially the better you do.
I mean, crypto arbitrage has really become quite something. It's excited a lot of debate in South Africa, in the investment community, and some people are very skeptical. But I think people have seen it and they've tried it, and it's been around long enough, so they're beginning to trust it. There have been some players who've exited the market. I think there's a few of you left standing, probably 3, maybe 4. Why is that? I mean, you've obviously brought something to it which is fairly unique, the way that you're hedging the risk. And maybe just talk about exactly how you do that, how you hedge that risk, and why this is becoming popular. I mean, if one looks at that graph, I think it does become fairly obvious why people are doing it.
Yeah, so I think, in my view, crypto arbitrage is a full-time business. There's so much to do, as you were talking about, the hedging, the getting of appropriate rates, the deals with banks and reducing of third-party costs. It effectively is a full-time business. And it's difficult to focus only some of your attention on it, because then you're just going to be overrun by better players who are focusing all their energy on it. So this might have been one of the reasons that people stepped out. But another is that they focused, typically the ones that stepped out, focused on crypto in general. They went into a crypto market. Whereas for us, we're not actually interested in buying and selling crypto. We're more interested in this market inefficiency that exists and really exploiting that to its fullest and capitalizing on it for clients to its fullest. And it's for that reason that we believe we have the furthest, the highest or most sophisticated system in the market by quite a mile. And that's why we continue to perfect this while other companies sort of diversified what they did. We thought this is too good to pass up on. We need to really perfect this for clients.
Okay, if you want to send in questions about this, send it to events@moneyweb.coza. That's events@moneyweb.coza. We do have a question here from Darren. He says, how sustainable is the business model based on arbitrage, which traditionally is a short-term gain on price differences which naturally converge over the medium long run? So, I mean, that's a little question you and I previously have discussed, is how sustainable is it going to die at some point?
It's a fantastic question. And like you mentioned earlier, Kieran, when this sprouted this opportunity, it was 25% price gaps initially, which is insane. And that slowly decreased over time as more players came into the market, but it's found a new equilibrium at between 2 and 3%, as I said, and it's been there for almost a year. And the reason that I see this as a natural equilibrium, in that I don't think it's going away anytime soon, is because of these capital controls. South Africans are willing to pay more for crypto than they are abroad, because of these capital controls, because it's a way of diversifying out of rands without using your capital by buying on one of the local exchanges. And so I believe that there is a reason that that it's hit this new equilibrium. That said, the regulator is looking to regulate this in such a way that they eventually potentially want businesses to be able to do this. Now, if they allowed businesses to do this, you'd have the local exchanges snapping up abroad, selling locally, and it would probably be gone overnight. But we have it on good authority, having spoken to the regulators, that this is probably still a long way away. I mean, it's first going to have to be regulated by the FIC, then by the FSCA, and only then by the Reserve Bank. And the Reserve Bank is the one which would create this change. So while this opportunity isn't evergreen, it's not going to be around probably in 20 years, I'd imagine. It might be, but I doubt it. It will be around, hopefully, for the next couple or few years. So this is a really good time to exercise it make hay while the sun shines, effectively.
Well, I think an interesting point on this is that there are times when the arbitrage gap goes negative. In other words, it's cheaper to buy in South Africa than it is overseas. It's a momentary sort of mispricing. And the gap can disappear for days and then all of a sudden reappear. So I would imagine going forward, one could expect something like that. Even as you get more participants, there'll be some event, like now, what has happened recently in the last month, the drop in the Bitcoin price has created an actually wider gap for arbitrage. So tell us about that.
Yeah, no, it's fantastic marketing for us that Bitcoin has sunk to all-time lows, and our clients continue to make extremely healthy profits. It basically justifies what I propose all along, that we are not correlated with the Bitcoin price. This is an alternative to investing in any other investment, not only to investing in cryptocurrency, in that it really has no correlation to any other investment class. Rather than that, it simply continues to make money. And on the premise of what happens when it closes or goes negative and comes back positive, that's also perfect for us, because we're able to only execute as and when the gap is high enough to allow us to execute. I'll say for the past year or so, it hasn't gone negative. It's sat between 2 and 3 pretty much consistently, sometimes maybe dropping to 1.5%, maybe to 1% at a push, but we simply won't trade at those levels. We'll only trade as and when we require it. And because the process is fully hedged, we have predictable profits for clients up front. We know what they're going to earn when trading, so we'll only trade when that is high enough.
Okay. I think one of the questions that comes up about crypto arbitrage is, and you did touch on it a little bit earlier, the fact of regulation, and all of a sudden you get this institutional money seeing an opportunity like this, it would just knock it out overnight. You don't see that happening. You think it'll be very much a retail thing. It won't be properly regulated by all 3 branches, the Reserve Bank, SARS, FSCA, and so on. So you see this existing still for some years to come?
Yeah, to clarify, I do see that happening eventually. I see the regulation coming in, but I see it taking another at least couple of years for that to, and that's optimistic, a couple of years. I think it will be longer than that. So while it will come into play, it's still a while away, and there's still some real good money to be made in the interim.
And what will you do as a business when that day comes, if it does? Will you find something else to arbitrage?
Yeah, so it's a fascinating situation whereby our clients will be completely fine in that we simply won't trade for them, and they'll take their money back if that ever happens. But as a business, we need to think about what does this mean for us? And that's why we're looking at multiple other products in the interim, which are in the pipeline, so that we're able to pivot effectively to something else which is exceptional. We want to keep offering exceptional opportunities to South Africans. So that's very much in the pipeline at present, but right now a lot of our focus has been on the arbitrage because of how amazing it is in the interim.
Okay, I think another point to bear in mind is that clients are allowed to nominate their desired return. I mean, this seems a little bit crazy, but you get within the bounds of what the market's prepared to give, right? So a guy comes to you as a client and he's got maybe $500,000. He says, I want only trade for me when the gap is 4%. What will you say to him?
Well, he's absolutely allowed to say that, but firstly, each client has their own relationship manager who's their personal port of call for anything they want. So they'll speak to their relationship manager and say, listen, only trade for me when it hits 4%. And that relationship manager will probably say to them, listen, I think that will probably happen 3 or 4 times over the year because it's been equalizing around 2 to 3. So you're welcome to do that, but your returns over the year won't be that strong. Even though each cycle you'll make great returns, it won't be enough to get through your 11 million rand allowance. So we'd probably propose to set your net return after all costs to around 1.5% in that case, which is still pretty high, but ensures that you only, when it hits those targets, will you be traded. Yeah.
Okay, we are running out of time. A quick answer to this one, please, from Bruce. I don't know if this is something that you can answer, but what's the advantage between trading Forex on the Forex market, I presume using CFDs, or doing it through the crypto channel, which is now becoming a possibility that you can trade Forex using stablecoin pairs, right?
Yeah, so I can't speak on the Forex side particularly deeply, but I can say that where our profit is coming from is not through Forex, it's actually through the difference in crypto prices. So we're simply utilizing Forex to get the money abroad so that we can buy cryptocurrency abroad because it's cheaper there, so that we can send it to South Africa and sell it in South Africa at a profit. So we are not Forex providers, we use Forex to facilitate the arbitrage of buying that side, selling in South Africa.
Right, and your website is futureforex.coza.
That's it, futureforex.coza. There are 2 buttons you can click on. There's either get in touch if you want to hear more and you can speak to one of our representatives, or there's a register button where we'll take care of you from there.
And you've got a relationship manager that can answer any of these questions and basically hold your hand. But once you're up and running and you're onboarded, it's an automatic process.
It's as passive as we can make it because we don't want to hassle our clients. We'd rather just get them to be trading at the correct level, at the optimal level to maximize profits over the year.
Okay, Harry Scherzer, we're going to leave it there. That was fascinating. Thanks for joining us and coming all the way from Cape Town.
Thanks, Karen.
To talk about crypto arbitrage. I'm sure a lot of people will find it interesting.
Yeah, thanks, Karen. It was great to be here.
Thank you.
Hi, I'm Bitumelo Nzoko and I host the Money Savvy podcast. Managing your money while also trying to figure out how to save and invest for the future can be overwhelming, especially when you're new to financial planning. The Money Savvy podcast aims to make personal finance easy by exploring themes such as budgeting, saving, investing, retirement planning, and so much more with Moneyweb's trusted Click and Advisor community that includes certified financial planners and wealth managers. Advisors share their expert tips without the jargon with the aim of empowering but not confusing you. So join me and my guests every second Friday on the Money Savvy podcast. You can listen to it on moneyweb.co.za, the Moneyweb app, Apple Podcasts, or Spotify.
The Money Savvy podcast. Money Savvy. Moneyweb, your trusted source for business and investment insights.
Yeah, good afternoon and welcome to this first afternoon or second afternoon session, and we're going to talk about risk, how to marry risk and yield, because there's a perception that the higher the risk you take, the bigger your return will be, and that's not always the case. It's not always correlated because, for example, if you receive a return of, say, 8% on an investment for a particular year, that return can be significantly better than a 10% return on another investment because the 8% was achieved at lower risk. So we're going to talk about how to look at risk in a portfolio, how to look at it in an investment strategy, and I think not too many people think about risk enough before they take investment decisions. And I've got a very esteemed panel, Anthea Gardner, she's from Cartesian Capital, Jeanette Marais, CEO of Momentum Investments, two absolute experts in this field. You've also been in trenches for many, many years. And let's just start off with risk. How do you think investors, Jeanette, should look at risk when they start to plan, they want to build a portfolio, they want to get started in the investment world?
Ryk, I think they should only worry about one thing, and it's actually the risk of losing capital. Because actually, I think sometimes when people look at funds and think whether to invest in them or not, they look back at kind of past returns. But it means absolutely nothing, even if you get those exact returns, if you cannot stay in that fund. And therefore, I mean, my recommendation would be look at the fund fact sheet of the unit trust fund. Let's say it's a unit trust fund that you're thinking of investing in. And look at, there's something that we put on that's called a drawdown rate. The drawdown rate actually is an indication of, over a period of time, what the maximum drawdown, the maximum losses were that fund experienced. And forget about that past return. Look at that drawdown rate. And if you cannot stomach to lose that much of your capital, it's not the fund for you.
But if you look at a fund and you evaluate whether you want to invest in it, that's not the first thing you look at. So is the risk the potential drawdown of the fund, or is it the underlying investment?
Well, I think the point is this, that, and actually I brought some numbers, so I'll look at my notes just to, kind of highlight it and get it, specifically right. 3 types of funds that we know very well. SA equity funds, I'll compare that to what we call a multi-asset low equity fund. It's kind of a stable fund if you want. And then the last one is an income fund. And I looked at numbers right from just before COVID to now. Now, here are the fascinating numbers. SA equity on average, and these are the ASISA unit trust funds in South Africa, on average returned 6.7% from pre-COVID to now. Multi-asset low equity returned 5.3%. That's only a 1.4% difference over this almost 3 years. And income funds returned 6%. But the maximum drawdown of SA equity funds was 33%, multi-asset 13%, and income funds only 4%. So on the one hand, if you were to look back at past returns, you might have been tempted to pick the SA equity because it had like almost a 1% better return. But what you would have missed is that the drawdown was in an equity fund over the same period. You could have lost 33% of your money. If you stayed in, it recovered. Took 270 days to recover. But can you stomach to wait 270 days for the recovery? So what did people do? That severe kind of fall in the market came, they took their money out and they never came back. So not only did they put that kind of capital loss into a permanent loss, they've also not managed to be part of the recovery. And I think that for me is the definition of risk.
Some interesting numbers, and I think it's to the point. The fixed income return may be slightly lower than the equity return over a 3-year period, but and it's at a lot less risk.
Yeah.
Anthea?
So I definitely can't disagree with Jeanette. I think your primary risk is the risk of losing your money. So if you invest your money and that investment goes to zero, that's your primary risk, which just nobody wants to stomach. And then the second one really is about volatility, and it's personal risk. So when the market drops, have you got the temperament or the capacity to stay in that fund and wait for the recovery? So can you sit out the 270 days that Jeanette quoted? And that's risk, and that's about everybody in a personal sense. So you can't generalize and say, well, everybody should look at exactly one risk number and that's it. I think it's very personal. And it really goes around your personal cash flow, right? Also your desired versus your required return and your time horizon of investments. And so for me, it's kind of, you'd have to look, when you're investing for yourself or even a group of people, what the ability to stomach volatility is, really more than anything else. So there's no point in saying, okay, well, my required return is an equity-like return, but if the market falls 30% in March 2020 like it did, then I have to get out of it. If you can't stomach that, then you should be expecting possibly a lower return, the money market return maybe, which is less volatile, consistently yielding.
But does volatility impact risk?
So if you're talking about personal risk and the ability to sit through volatility, then absolutely yes, risk. Then you would look at it that way, right? So so in hedge funds, for example, when we manage hedge funds, we look through kind of what are the ratios, what are the Sharpe ratios, where is the volatility versus the risk? What are you paying in peace of mind, quite frankly, because volatility is lack of peace of mind, I'll tell you that, for the risk or the return that you're getting. So is volatility risk? Yes, I would say pretty much yes.
I just want to quickly go through the asset classes and my perceived risk element attached to those. Cash bonds, fixed income investments, low risk, your money is safe in the bank. The only risk is whether the bank goes bust. Then property, good income. There are fixed assets, tangible assets behind fixed property. That is still conservative, maybe slightly more risky than equities, high risk. And I think many asset managers and especially also financial advisors, when they say, listen, you need to be in risky assets, they refer to equities as an asset class because you can have different risk profiles within that asset class. And then commodities, crypto, commodities maybe not, it depends on how you invest in those. Gold, for example, can be very volatile, doesn't provide with the income, but it's a perception. I see you frown at me, Anthea. So how cast in stone are those perceptions of risk attached to those asset classes? Is risk attached to fixed investments, cash investments? Is it so much less risky than the others?
No. So again, I think it's about volatility and how volatile these are, and that's what you use to measure your risk return profiles, right? So what we do in investment circles is we use the efficient frontier, and that basically measures exactly what you're talking about, the volatility versus the return. And how much volatility or sleepless nights are you getting for the return you're getting, and what would your optimal return be for the amount of risk, in inverted commas, that you want to take. So for I want to sleep easy at night, and I don't want to worry that tomorrow I'll wake up and my portfolio is down 10% because I may need the cash immediately. That's what it's all about. Now, what's interesting about kind of the risk metrics or the risk number that you've put on each of the asset classes is that it's historic. So as asset managers, you have to manage forward because you have to know what's coming, but you have a rear view mirror. You don't have a crystal ball. So all you have to do is take the historic returns and the volatility of those asset classes and build the best portfolio you can. So I think the great thing kind of about what we do or our industry is that we have built lots of different portfolios. So you can look at a money market or a growth or an aggressive or Reg 28 or a pure equity or pure commodities portfolio, and you can combine your risk according to your risk profile. What is your term horizon? What is your asset base versus your liabilities? And that's quite an important one. I think people forget that because you can only make money when you're investing. You can't give me nothing and say, please make a return for me. It's kind of, that's how it is. And also, what are your future liabilities? So for a pension fund, that's a big liability in future because you've stopped working, you're going to draw down, you're going to stop investing money. And that's risk, right? So your asset base to generate enough returns or to grow your pool of assets to cover those future cash outflow liabilities is all part of kind of what you should be thinking about in your risk equation. So when back to the efficient frontier and talking about these risk assets and how you build your personal portfolio is very important to understanding your personal situation and where you want to be and how you want to be.
But that's difficult to do because it's based on perception.
It's your perception. It's your understanding of your cash flow requirements. So you know that you want money next year, for example, to put down a deposit on a house. You need an asset base which you can easily access. You need that cash. You need to be able to access the cash in a year's time. What you cannot afford to do is then put it in a portfolio or an asset class that is very volatile because next year could be exactly when you need it. The market could be down 30%.
Time horizon is a critical component of risk. Yeah.
But I want to take it one step further. And I think this is what for me is so fascinating. And you know, Ryk, we've had so many conversations about this. It's the richest topic. I now have a team at Momentum. It's all they do. And that is that lots of people will look at it and say, my time horizon is 20 years to get to retirement. But nobody put their money in and then stick to that for 20 years. Because tomorrow the market fall by 33%. And that's where behavioral finance, that personality comes in. Certain people, I suppose, could look at that and say, been there before, leave it, it will come back. 90% of investors will get out because they cannot handle the emotional stress of that. So yes, I'm still invested for 20 years, but I make short-term decisions that is actually based on the emotional kind of stress I'm experiencing because I see my hard-earned money slip away from me. And that is the worst time ever to make, you know, that kind of a decision. So yes, we have plans, we have dreams, but those dreams turn into nightmares if things happen to us and the volatility causes us to then make almost counterintuitive type decisions. You know me, I will always say, I listened to what Anthea said here and I was like, I'm in this industry every day of my life. I need someone to advise me on that combination of risk and volatility and efficient frontier. How does a normal person know that? And then that kind of behavioral coach, advisor on the way to say, stop. Your plan haven't changed, therefore let's not make any kind of rash decisions, get in, get out, try and time the markets and all of that.
What are your views on risk perception? That is what when you evaluate an opportunity, there's not a tangible risk indicator you can use, a measure you can use. So how do you look at risk and how do you attach that risk? You used the term risk formula, risk equation. How do you implement that? How do you attach the risk factor to that?
Well, look, maybe I'm simplifying it too much, but you know, my world is with retail investors, normal people out there every day, and you try and almost get away from jargon and so on. So my investment team would be able to have those formulas, and they call it the risk premium that they're willing to pay, which is that kind of balance between risk and return and so on. A normal person like me with my own money, I can't do that. And I think for that is where, firstly, the normal things we say, get an advisor to help you, make sure that your portfolio is diversified. All of those asset classes that you started off with, I think a proper long-term personal portfolio should have combinations of those in, so that when the one does fall 33, there's another one that actually doesn't fall. And eventually it does balance out to at least just help you. So for me, risk is not how these things fall. Risk is whether my client have the ability to stay committed to that portfolio and can emotionally handle to stay in, because that's over time how they're going to get the returns.
Yeah, it's like a fun fact sheet. There's always that risk
drawdown.
Yes, and then in the green, yes, this if it's equity-based fund, it's in the red, and if it's more cash-based, it's in the green. Do you attach value to that?
Oh, absolutely. I do, because even though, as you say, it's difficult to find an absolute risk number. So what is my risk number versus your risk number, right?
Yeah.
But I think you have to look at it, you have to attach something to it. You have to understand that the volatility of the fund is much higher in an equity fund or a commodities fund than it would be in a money market yielding or flexible income or some sort of income fund, right? The other risk, of course, is what you then have to look like once you've decided I am a high risk taker because I can sit through the volatility, right? That's kind of really, in essence, what we're saying, is that I can handle risk if I can sit through volatility. Then the next question is desired versus required return. Now, a lot of people, I forget the number, Rake, but a couple of years ago, I looked at the Financial Planning Institute kind of article, and it was a crazy number, like 97% of South Africans retire without enough money to get through retirement. And so they then said, if I'm not mistaken, that you need 11 times your final salary to retire comfortably. So, sorry, I know I'm saying this live streaming, but my numbers might be a bit wrong. But think about that, just as an example even. So your required return is that you need to know that if you are making R1 million at the end of your working life, you need 11 million rand to get through your retirement. That is a required return, right? Now, a desired return is a whole different story because we all want 100 and odd %, right, per annum. so that's kind of what it. So I think part of what Jeanette is trying to say is that you understand these drawdowns and you understand maybe you can't sit through the volatility, but maybe teach yourself to. So maybe understand that if you are going to take, and historically, again, equity returns have been higher, or private equity returns have been higher than, say, a low risk, low volatility, maybe I should start saying that rather, low volatility fund. And maybe you need to take that risk. Maybe you need to understand or train yourself to sit through the volatility and increase your risk number. So I don't know, maybe Jeanette will know better, if there is a perfect risk number that you can use to calculate it. And I've seen some financial planners go and sit through it, and they'll sit with questionnaires and they'll sit down and score you accordingly. And I don't think there is, but that is why I would say the best way to probably overcome or to understand your risk is to know that down the line I am going to need X amount of money for a house, X amount of money for education for the kids, for retirement, for holidays, for repairs if my cylinder bursts. So just, and be very realistic about, I can't say quantifying because we're just right now saying that it's not quantifiable, but understanding what your cash flow is going to look like in future.
Yeah. I want to implore people, send an email to events@moneyweb.co.za, ask questions. I see there already a few has come through. But before I get to those, risk is not homogeneous. There are different types of risk. And you get risk related to companies. If you invest in equities, the company can go bust. Steinhoff, Tongaat, there are a few examples of those. You get opportunity cost, which is actually one I don't think many people think. So you invest in Fund A, but it does really poorly compared to Fund B. Volatility we've spoken about, and then also liquidity risk. You have an asset, but you can't sell it because just no one wants to buy it, and that also poses a risk. How do you think you should approach all these risks? How do you take them into account?
I want to respond to the one you mentioned last, that kind of liquidity risk, but I want to add another one. The liquidity risk is, for instance, Drake, you get this all the time. I listen to you Friday nights on the radio, and like just about every week, someone will ask you, should I invest in property or should I invest, in unit trust funds or whatever? EFTs, whatever, or ETFs, anything like that. That's liquidity risk, is that if you buy property and you need the money, you are dependent on finding a willing buyer. The time in the market might not be right. So that's liquidity risk, is that you have capital, but it's tied up somewhere. And I mean, it's much wider than just property, but I think it's such a good example because we often get those questions. There's another big risk that people often forget about. It's the risk of inflation. If inflation risk is a very real risk, for the last, 10 years or so, on average inflation, let's say, and then there's arguments about what's real inflation and whatnot, but let's just use the official number, was just over 5%. Now, the point is that you need to get at least a constant 5% return over a period of time to protect your capital. Otherwise, the buying power of your capital goes back. And I want to share with you a very interesting number. I've looked at, so we have an investment platform, we've got over 300,000 clients on it. So we used that as the data to do this study. And over the last 10 years, 88% of our clients invested on this platform got less than CPI plus 4% return. CPI plus 4, okay, so let's say that's 9. If it was 5% over the period, it's 9%.
Just say that again.
88% of clients on our platform, on average. So of course, you know how the world of averages work. Some got more, some got less. But on average, got CPI plus 4 or less. Only inflation plus 4%. Only 12% of our clients actually had returns of CPI plus 5 and more. Now, imagine you are a client in a living annuity.
That's not a function of the performance of the funds.
It's a function. It's a combination of, because over 10 years, funds have performed much better than that, right? It's because of the behavior. It's because clients constantly switch. The switching behavior between just when COVID started in October 2020, we had an 80% increase in switch activity on our platform. Clients destroyed more value. In that period, they destroyed 6.5% of value. We call it a behavior tax. It's the tax you pay due to bad behavior over that 9-month period due to switching.
So another risk is looking in the mirror and you see another risk, or you look at your financial advisor who advised you to make the change.
Exactly.
I think that is behavioral mistakes is definitely a big risk. Do you want to add?
Yeah, well, that talks to your opportunity cost, right? Because if they had sat through it and just kind of buckled in and gritted their teeth, they wouldn't have missed out on the opportunity of a rising market. So, I mean, there are so many examples of this. You know, the GFC, exactly the same, right? The market crashes, everybody panics, and or they go on retirement and they are forced to take out their money. And it took a while for the market to recover. It was probably just over a year for the market to recover after GFC. But then if they had sat in it for another 3 or 4 years, I think, if I remember correctly, they would have made 157%. Yeah. So that opportunity cost, I mean, I love the Brits, right? Because if you talk to them on a Friday night and they're buying their lottery tickets and you think they'd know better about stats, and they go, but you've got to be in it to win it. and that's the opportunity cost. If you're not in the market in risky, volatile assets, then you're not going to make up that loss. So all those clients of yours, Jeanette, on your platform, all they were doing is crystallizing their paper losses, turning losses. Paper losses into absolute losses.
You only make the loss when you sell.
When you sell, but then it's too hard to get back in. Because what do you want now? You sold on very bad news. Now you want positive news. Before you'll believe
you
that
want to wait until it falls a bit more, then you get it back in. And then you become greedy and...
Human nature cannot handle that decision. So you got out because of fear. But now when are you going to get back in? And it is impossible for a human person to be emotional about your losses and think, okay, but let me just go back into the market. Then you should have just stayed in.
Bonga asks, what is the most risky asset classes outside the crypto space? Let's do this one quickly. Normally, when you refer to a risky asset class, it's been, the equities seems to be that class. Is that the general perception?
Well, I mean, I would say that that is the general perception, probably, and I don't know whether Anthea has a different view on it, but I think it's also when clients actually buy and sell shares themselves. So there's also, remember, if you invest in a general equity fund managed by a fund manager, at least what you get is a blend of quite a few counters, quite a few different companies that's tied, up in there. Some will do better, some won't, but at least you'll get that kind of average. But if you then go and you bet your market on a tip that someone says, here's this new company coming, put all your money in there, then you just actually multiply the risk that you take, because you don't have a general exposure to the equity market, you're actually in one stock.
So I think a lot of talk historically has been kind of equities are risky because they are volatile. But I think private equity is risky because it's long term, and that's back to your liquidity question. So you don't have liquidity. So when you need the money, you can't get out. And we're talking again about valuation. So probably if you have a private equity fund and you went to your asset manager and said, I really need this money, I've got an emergency, the valuation they put on your unit price in your private equity, your venture capital, or whatever it is fund, is so low because you have effectively in the beginning locked up your money for 7+1 or 12+1 years, or whatever the case may be. So from that perspective, I think you can probably add a few, others to risky assets. Property, again, my father always used to remind me, is only worth what someone will pay. So you could have paid 10 million and you think that the market is still 10 million rand for your house. But if you want to sell it and somebody's not prepared to pay you more than 7, that's the valuation and that's your risk. So if you look at the property index and the equity index over the long term, chances are it's gone up significantly more than your money market fund, for example, except maybe, when was it, late 90s, when interest rates in South Africa were like 20% or something, right? But that perception of riskiness boils down to what you think is risky. Is risky not meeting the return you need? So for me, I've got many years still to retirement, wink, wink. But if I don't put my money in a risky asset, which is going to give me a decent return, I'm not going to meet my required return profile so that I have enough money to retire.
But
that's risky, but I've got to stay in, right? Yeah. And exactly that. If I want a return commensurate with what I think my assets should grow to, or what my liabilities are going to be, then I must take the risk, or I must be able to get out when I need the money, I should say. So different risk metrics, different styles of risk.
But there are also different risk profiles within the equity sphere. You can invest in Renogen or Orion, which are really junior mining companies. If they hit it big, they're going to really become massive. If they don't, they're going to go bust. And compare that to, say, investments in Remgro, AB InBev, BATS. That risk profile of those companies really do change.
You remind me of the dot-com bubble, right? And I feel like we're almost going through it again because, so having lived through that kind of dot-bomb era where everything just went up, I have a specific story where I looked at 2 companies and I thought, you know what? I am never going to buy books online. I love books, so that is a rubbish company never to be invested in. Look at Amazon now. Right? Whereas other companies, I thought, oh yeah, that's great for me. I want to work online. I want to deliver groceries online. That's the company I want to buy. Webvan is long gone, let me tell you. And I think when we're looking at things like our efficient frontier as asset managers, that does play significantly in our heads because we're trying to understand historic fundamentals, or fundamentals based on historic data, and what the outcome should be or what return we should expect from this company when it's different this time, because we think the company is different. And so it's incredibly interesting for me to look through the Facebooks, Amazons, Teslas, and you think, but hang on, a company that is going to give me a decent return has got profits and, is generally on XP price earnings ratio, and that's where I should be. And then I look at Tesla or Facebook, who never made profits for I don't know how many decades, and they were the companies that actually gave me a good return. So I think that just makes our...
Yeah. Is there any scientifically proven correlation between risk and yield? Because it's not linear. especially if you look at equities. The assumption is the longer you stay in equities, the better it will be, and you will beat the yields of other asset classes. There are a few questions related to financial advisors, and I'm going to use Dinio writes here. He says, as a 25-year-old, how much risk should I be taking in my investments? And I just want to turn that question around. So Dinio goes and he sits in front of a financial advisor, and he gets that question. How much risk do you want to take? Is he able to answer that question? Is he able to perceive the absolute massive opportunity cost it may have come 40, 50 years later?
If you're 25 years old, what are you investing for? One,
let's say long-term for retirement.
Exactly. So you're investing for retirement. So I would say, take as much risk as is suitable for your pension fund. So go into, in inverted commas, your high equity, high risk portfolio. Because at 25, you've got time in the market, right? And we want to talk about that probably. It's not about timing the market, right? It's not about should I invest today or tomorrow. It's about staying in the market and time in the market and staying there for as long as possible. The other thing, though, is that Dineo probably is going to need to buy a car, so needs cash at some stage, put it down a deposit on a house, pay for a wedding, pay for child's education. And so there's no reason you shouldn't diversify your portfolio. Like, why do you ask a question that needs an absolute answer for one investment? I mean, you've got to think about an emergency fund, a short-term fund, medium fund, and long-term fund. And again, we're talking about liabilities or cash flow, I should say, expected cash flow, right? So, and again, this is all important because a lot of people think, well, I can't invest because I'm taking high risk and it's volatility and I have to sit through it till the end. But if you've got 100 Rand, then I don't know, and I'm guessing a number, right? Maybe 80 Rand goes to retirement and 20 Rand goes to the short-term fund, which if you need it tomorrow, and it's not sitting in cash because as we now know, inflation is eating into our cash.
How many people do that? That's what you should do. You should also have a budget.
Rake, I really want to kind of, fly the flag for good financial advice here. A great financial advisor will firstly not answer this question the same for even 25-year-olds. Every person is unique. Look in the mirror, that person has to have a unique plan. And like, I have an advisor. In fact, I have more than one because they have different things that they look after. And this is my job. This is what I do every single day.
So you're the CEO of an investment company.
And I have 3 different financial advisors, and they look after different things. Why is that important? Well, firstly, because I have a different plan for different goals. And it's exactly what Antti is saying, and it works out differently. So that's the first thing. Secondly, and we often say if your plan don't change, then don't change your plan. Like, it should stay the same. If this is a 40-year investment, it should stay the same for 40 years. But let me share with you just something that I think people miss when you look at it too linearly. We've stopped asking people, how much risk can you take? Because who knows? We've started doing, and we've done a lot of research on what we call advisor archetypes. And all it is advisor personality, client personalities, archetypes. So you have avoiders. They are by nature conservative. It doesn't matter that it's 40 years. They will not be able to handle it. They are so risk averse that the whole personality will force them to make stupid decisions at the wrong time because they cannot handle the risk. Then you'll have people, you'll have risk takers, you'll have market timers. You have people that we call anxious investors. They get very anxious when things happen, but luckily they don't necessarily respond to it. That's why I'm saying finding the right advisor is far more important than trying to understand these things. Then walking that road with that advisor. Just a piece of research that was done in Canada recently have shown that households that has an advisor over a 15-year period accumulated 3 times, 295% more assets than unadvised households. And this was done with thousands of Canadian households. Why is that? Because there's a plan, there's discipline. In order to know how much you have to have a budget. An advisor can help you with those things, and they become your coach, your kind of conscience to say, do not buy that car, or take your money out to go on that holiday. Let's remind you of your long-term goals.
And one of the issues we always have, Jeanette, is that when we get clients, one of the first questions they ask is, how much is the advisor going to charge, right? Sorry, right?
Yes, absolutely.
And I mean, it shouldn't be that. You shouldn't be, well, it's going to cost you more if you don't get an advisor. And most advisors shouldn't, correct me if I'm wrong, but they shouldn't charge up front, right? It's dependent on the assets under management, or how much you give your advisor and how much they make for you.
More people, well, I've heard a statistic that many households do more research into the cost of a financial advisor than actually speak to other clients and make sure that it is a good advisor. But Jenny, before there are a few questions about financial advisors. I think we've opened a hornet's nest here. What bothers me is that financial advisors do not take any risk with investors' money. They don't accept any risk for themselves. It would be better if there is a shared risk between the advice given and the actual result. That was a comment from Andre, and then Anne says, my experience has been that I follow the advice from my advisor. It seems communication from the advisor or their investment decisions affects you most if you lose money, but I'd rather be using an advisor than trying to take the risk decision myself.
Well, so my response to that would be that, remember, an advisor is not a person that kind of work for a salary. There's nothing that catch them and back them up, right? So over time, advisors build up client portfolios through looking after their clients' money, and they share in a small percentage of your kind of annual asset growth. So maybe it's not that they're going to write you a check to kind of, cover the shortfall, but what they are going to do is that their income's also going to decline if your asset base is declined. So in an indirect way, they are affected by it. And that is also why it's so important for advisors to remain in contact with their clients, to avoid that their client make a decision that can cost them 33%, of their assets because they made a rash decision. And that same study that I've referred to now, I've actually shown that it's the same Canadian market, it's the same study, that just by being the behavioral coach, so what they did was they isolated decisions clients was about to make and their advisor prevented them from making it, added 3.5% to client returns. Just by being your coach that says, stop, we have a plan, let's stick to our plan, 3.5%. That 3.5%, your advisor is not getting paid as a fee, you don't write them a check for it, but it saves you that 3.5% of your capital you would have lost if you made that decision instead of listening to your advisor. So I do believe that advisors add value. The right advisor that is aligned with you.
The key word there is the right advisor. A poor advisor is the biggest risk you can probably have.
No, absolutely. Shop around. Ask people you trust. I tell you what, there's a study that says we all hate advisors, but we all love our own. Like, you know what? I tell you what, if you ask me for a recommendation, I'm not going to recommend you someone that I haven't walked the road, someone that I know, someone, and like, our friends and family, I'm sure they can tell us who, do a good job for them.
Maybe we are digressing a bit, is that most people would recommend an advisor because he or she is friendly and there is regular communication. It's difficult to compare the performance of an advisor because people are so different.
Indeed, I mean, it is very difficult. I must admit, I agree with Jeanette. Like, I have a couple of advisors who I recommend because I know they're good, because I know that if I need them, they are there, they've done their homework. And so what you're looking for in an advisor is somebody who can tell you about the different types of assets or portfolios, I should say, that are available to you. And I mean, there's an obvious one, right? You can check the FPI website, right? It's fpi.co.za. It's
FPI, not FBI.
Yeah.
Financial Planning Institute.
Looking for something different in the FBI website.
But I think what is so important is interview that advisor. Ask them. You wouldn't go to a doctor and just kind of walk in. Ask them, what is your value proposition? What can I expect from you? How often will you communicate with me? What will happen if my portfolio fails? Like, I think you need Why are we too worried to ask the same questions to a person that we're going to entrust with our life savings? Why are we too afraid to ask them how much they're going to charge us and what we could expect for it?
I was going to add to that the chasing of returns is a big risk in itself, because what people do is that they want the big return. So if you go to the BRI, everybody's talking about, oh, my crypto or my gold fund or my equity fund or my offshore fund was up 30%. Now, if you're chasing returns that are not commensurate with how the market is performing, you must understand that there is risk involved in chasing that. And that's how people get caught in Ponzi schemes, right? So they don't go to the FPI or the FSCA website. They just chase the highest return that their friends were saying to them, oh, I bought this and got this return. And this is where financial planners are much more savvy than your mates around the BRI, I'm afraid, because they know the association, or they should know what is associated with the return that you are chasing or that you require versus what is actually attainable in the markets.
Herman says, it's easy to say if you cannot take risk, you should invest in lower equity unit trusts. Yet the pure equity funds have outperformed low equity funds and balanced funds for 5 years, 3 years, 1 year, and 6 months. So what is past performance of asset classes and asset allocation tell us about risk?
I want to get back to the first statement I made. Yes, it is absolutely true. You look at the historic returns of these different asset classes, and it is absolutely true that over the long term, equities will outperform and have outperformed for the history of the world, these other asset classes. My question is, how many clients got that return? Because how many clients were actually able to get in and stay in? And I think that's the crux of the question an individual need to ask themselves. And that is where, I mean, your first question was, should I be in an equity fund that can give me 10, or is it better to be in a less risky fund that gives me 8? I would almost say human behavior will tell you, be in the one that gives you 8, because you might actually get the 8. The 10 you might never get, because the 10 might be 10 today, minus 20 tomorrow, and plus 30, because all you see is the average over time. What you do not see is the volatility of that fund. That's the question you need to ask yourself, but an advisor can help you to answer that question.
And as I pointed out earlier on, the market is so set up to help investors do the right thing as long as they can quell their inner kind of demons, right, and handle the volatility. Because, again, we use the efficient frontier. We understand historically where each asset class lies on that efficient frontier. And for X amount of risk, you can potentially get this amount of return. It does change. So we have an efficient frontier model in our office, and we look at it and we keep looking at it, because historically it has changed. It will, because not everything performs perfectly. I mean, the JSE, if you looked at it 4 years ago, was on average returning 16% per annum. Now suddenly it's returning, I think it's like 12 or something ridiculous. Maybe that'll change in future, but it's that volatility that you have had to sit through that brings you to back to that 16%, I think, that you're looking for, or that you wanted from the JSE. Now, if you are 64 and retirement age is 65, then maybe you don't have enough money. Should you be taking more risk? I think that is kind of quite an important question we need to cover. Should you be taking more risk? But if you are forced to take more risk, in other words, be in a higher volatility fund,
and stay there,
is your risk at 65 going to be that fund has plummeted 30%, and so you're from a year ago you're 30% short on your target retirement fund? I think that's almost the more important question of what is my target, and what are my targets? Because there are short, medium, and long-term targets, and how am I going to get there?
But nowadays, when there's actually a seamless kind of process between pre and post-retirement, that most products don't force you to say, oh, today I'm 65, I've got to sell all my investments and go invest in something else. You can continue with those investments. And I think that's another kind of mistake people often make, to think, well, what I do up to the day of retirement need to be completely different to what I do after. Why doesn't it need to be? Because your time horizon is again another 30, 40 years. With longevity and how long... No, it's not a dead end or a dead stop. So for 40 years, I've been building up my wealth. Now I have it. Now I'm forced to go into a different instrument that's now maybe going to pay me an income. But you've got another 40 years, at least 35 to 40 years ahead of you. So your time horizon have not changed. The problem is if you are on a product where you're forced to kind of turn it into cash today and then go back in the market tomorrow. But 99% of products now with in-fund retirement and preservation and so on, you actually don't even need to do that. So your portfolio doesn't end on a specific day just because it was your birthday. You can seamlessly continue and over time change the kind of underlying portfolio.
There's a question, nobody wants to lose money and it's difficult to sit on your hands. And you know, I get a report every day of my investments, how they performed the previous day. And some of them are really long-term investments and it's really not nice to see a red number. So I just stopped looking at the email. And I think ignorance is bliss, especially if it is a long-term investment. How do you mitigate risk through asset allocation? Is asset allocation a critical part of managing risk, especially if you're 25 years old and you've got a 45-year investment horizon? How should you look at that?
I would say it is important, but probably more important is managing your liquidity risk, right? So what are your liquidity requirements rather than should I be in equities, commodities, property, fixed income? Like, should I be in short, medium, or long-term style investments? Because along with the risk metrics that, every at the top of every fund fact sheet, it's low, moderate, high risk, right? And two in between. Surely that would be an indicator of the volatility of the fund and therefore also an indicator of liquidity. So I would say if you're thinking about mitigating risk through diversification, which is really the question, then maybe look at that rather than should I be in gold, property, commodities, equities, or fixed income.
We can just actually look back at the flows into unit trust funds over the last 10, 15 years or so. And by far, your asset allocation funds, where you actually leave the asset allocation decision to the actual fund manager, your so-called balanced funds, stable funds, or high, medium, and low equity multi-asset funds, have attracted most of, if I say most of, it's probably 80% plus of the flows in the industry. And that tells you something about people's ability to sit in an equity fund and or, kind of keep their money in the money market, which is actually in the long term the worst decision, by the way, because inflation is your biggest enemy there. But rather put it in a type of a asset allocation fund where your fund manager make that decision on your behalf. Sometimes there'll be maximum in equities because it's cheap, it's the right time to buy, and they're a little bit less emotional about your return. And in other times, they will de-risk the fund simply because the market's high. They kind of, cash in some of those profits, de-risk the fund a bit, and then kind of go and invest in the market again.
There's a question related to the risk profile of different funds, and I think it ties into what you've just said. How much more risky is pure equity funds versus multi-asset funds?
Again, depends on your time horizon.
Say it's 10, 15 years.
Time horizon. In 10, 15 years, and it's the right 10, 15 years, your equity fund's probably going to outperform your multi-asset, asset allocation fund by a 3 or a 4%. It could be more, and times, it's a lot more than that. Again, it depends on whether you could stay in for that period of time.
And I would say that it also depends on the style of investing. So you could have a pure equity fund that is invested only in small caps. Now, I would say that is incredibly volatile and incredibly risky because of its volatility, as opposed to
the top 20 fund.
Exactly, which potentially is less volatile, or historically, not potentially, historically less volatile. So again, there's absolutely no need to have all your eggs in one basket. You do not need to have all your funds in a high equity fund or all your eggs in a money market fund. There's so many different ones in between that the industry, and we keep talking about unit trusts, there are thousands, literally, of unit trusts in the country. And it's because the industry has made a point of accommodating everybody and giving everybody the opportunity to diversify across the risk spectrum. So 25, I think it was Daneo, that was 25 years old. You know, sure, you have the ability to sit through long-term, another 40 plus years in some of that money, but some of that money needs to be short-term. So some of that money, you know,
your car breaks down.
Right.
Emergency fund.
You need a fixed deposit, or you need a money market or an income fund that is not as volatile, so that when you need that money, it hasn't fallen 30%.
Our number is 3 times. We say that you need 3 times your monthly salary in an emergency fund. Then you probably save, and safe enough that if you need cash quickly, that you can access it. So, you know, if you have about at least 1 month's salary, but, you know, 2-3 times a monthly salary in an emergency fund, which then is as close as cash as you can get it, actually is quite a safe way of then just de-risking that kind of life happens to you and you have those emergency funds available.
Yeah, absolutely. And it reduces your personal risk.
It does.
You know, if your car breaks.
And stress.
Yeah. I was waiting for this question. Busi asks, how do I assess company-specific risk in my investments? Does a company's lack of future growth outlook affect its value? I just want to, that first question, Steinhoff, Tongaat, there are company failures, big ones, and within, weeks and months before those companies crashed, professional investors were still investing in those companies. They couldn't even pick it up. So how do you assess company risk?
I really want to cut Busi short and say, why are you even trying? You know, if professionals are struggling, professionals who look at the market and look at companies every day, who have teams of analysts.
All we do.
Yeah, are unable to pick up certain things, then why are you as an individual investor trying to do that? Now, I must point out that I think Steinhoff was fraud. That's kind of my call on it. And no matter what, it was very difficult for analysts and fund managers to pick up. So when you're being lied to, that is it. Like, how do you know you're not being lied to? It's going to take something quite special to figure that out. But then there are other, you know, there's kind of African Bank, which the writing was pretty much on the wall. And again, even professionals got caught in it. So, Busi, very difficult to give you an answer. You know, we spend our lives looking at it.
No, I appreciate that, but many people work for a salary. Their pension goes off their pay slip, and that contribution goes to a company and has been invested, and that is long term. The only way you can really, you know, screw that up is if you take that money when you leave your job and you resign. But many people also want a discretionary portfolio. So that's, I think, the purpose of this conference as well, is to help people like Busi to go and try and get some skin in the game, get some exposure to how the market works, and then suddenly you look through a totally different set of glasses at your performance of your portfolio, where the professionals invest. You know, a lot of people go to a restaurant and they order the oxtail, and then they said, listen, my mother's oxtail is a lot better than this one.
I think the way you should look at it, if you have the time to do the research, if you have the time to really study those companies, I think take a little bit of playing money. A little bit of money that if you lose all of it, it's actually not going to destroy your entire financial future. So start with your emergency fund. Then have your pension portfolio looked after by a professional. And take that percentage of your bonus every year and see that as your, I want to say, your gambling money, because then the possibility is there that you could wipe it out. But if that doesn't destroy you financially, it's a fantastic way to get into the market and to learn.
I love that people are looking at investing directly, and from that point of view, I have to say diversification, right? Yeah. So if you've got 100, if you had 100% in Steinhoff, well, you were like, it was crazy. Like, your fund manager is never going to put all your money into Steinhoff. But if you had 3% in Steinhoff, or you were close to even kind of the market allocations or weightings, then sure, you would have lost some money, and yes, it would have hurt. But on the flip side of that, you would have been in Naspers at the time, which rallied and probably tripled your money. So diversification, if you're going to do it yourself, diversification is absolutely key.
Yeah, and I think try and get research. I think the more mistakes you make, the more you learn. And my biggest investment lesson I've ever learned, I believe it's a degree in investment management, was when I lost a lot of money. And I think you can learn through that as long as you don't really get financially hurt by that. You need to be able to afford that loss, and don't take positions where you're not in that position. Just lastly, a last message for Denio. Again, we've spoken for close to an hour. In one sentence, how should he approach risk? Is there a homogeneous one sentence, one paragraph answer to that question?
So I would have to say that you have to do a budget and you have to diversify.
I would say look in the mirror, understand your own dreams and your own nightmares. You need to know the dream is the goal, but you need to understand when that turns into a nightmare, what does it mean? And I think it teaches you a lot about yourself and your ability to then make the right decisions and stick them through. Time in the market.
Yes, and I think emotion is also a very big risk. If you're an emotional person, take that into account. And I think this was a fantastic session. Anthea, Jeanette, thank you so much for your participation. And yes, I think risk is a critical element everyone needs to take into account when they invest in a portfolio. And I think the main takeaways from this session is, listen, take decisions based on facts. Let emotion not dictate any of those decisions, and stay in the market. Don't have a knee-jerk reaction. Stay there, you will profit.
The Moneyweb Frequently Asked Questions Series. Part 2, Investing 101.
Hello, I'm Simon Brown. Welcome to Part 2 of Moneyweb's FAQ video series. In this series, we give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I will take you through the main facts you need to know about investments. The big question, what are the different types of investments? You've got shares, you've also got unit trusts and exchange-traded funds. Unit trusts are active, they buy and sell all the time, trying to do better than the market. Whereas an ETF is passive, they buy and hold the market, giving you that market return. What about the risks involved in investing? You certainly can lose money, especially in the short term. Long term, quality companies do well and increase profits, and this will see the share prices increase as well. When is the right time to consult a financial advisor? If you're not comfortable managing your investments yourself, there's always a lot of help online. But a financial advisor can add real expertise, and Moneyweb's Click an Advisor is a great place to look for one. How do I monitor the performance of my investment portfolio? Your broker will help you with the value of your shares as well as news from the company. Financial publications such as Moneyweb also offer amazing content. How can Moneyweb equip me to invest better? Moneyweb has a great tools and data page, as well as company news and a great selection of podcasts and articles every day to help keep you informed. In the next video, part 3 of the series, Moneyweb's editor Ryk van Niekerk will unpack Moneyweb's premium subscription offering, Insider Gold. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Our next keynote speaker is Valdine Reddy. Valdine has over 17 years' experience of direct marketing and having worked the first decade at international investment banks in equity derivative sales and trading, and the latter at the Johannesburg Stock Exchange. It's my pleasure to introduce to you Valdine Reddy, the Director of Capital Markets at the Johannesburg Stock Exchange.
Hi, my name is Valdine Reddy and I'm the Director of Capital Markets at the JSE. A little bit about myself before we kick off the session this afternoon. I have been in financial markets for the past 17 years with a love and passion for capital markets. I started my career at a US international investment bank, and I really started on the trading environment, which sparked my love and interest for markets. What I found most appealing about markets is that they were really real-world impact and drivers to what was happening out there. It gave me an interest to understand economics, global drivers, activities, and really engage with the marketplace to showcase South Africa and the investment opportunities that we hold. My career spans over 17 years, and in my most recent position at the Johannesburg Stock Exchange, I am the Director of Capital Markets, and in that my portfolio includes looking after the listings for the JSE, so all of the public market capital formation, as well as the secondary market trade activity across asset classes. The JSE is a multi-asset class exchange, so we have equities, which is our main marketplace, as well as our derivatives markets, including equity derivatives, FX derivatives, commodities and interest rate derivatives, and a cash bonds market. It really is a diverse marketplace to showcase the investment opportunities out there. What has been really evident in the past couple of years is the connectedness of markets, and I will go through some of the themes and trends that we've been experiencing over the past 2 decades. The most relevant of these trends is the current geopolitical tensions that are facing the impacts of our market and activity of late. What it shows is that the world is connected and that different investment decisions stem not just from the regional markets that you operate in, but from what's global drivers and what is happening out there. So the biggest topic of conversation probably in the past 2 weeks has been that of an inflationary concern. As we see through developed markets, inflation surges have really put markets in the spotlight, and we're feeling that in the global volatility we're experiencing at the moment. From a rising inflation environment, it really speaks to how will consumers manage through this, and then ultimately what reserve banks or central banks are doing with their rate cycles. All of this feeds into investment decisions, whether you are investing in equities or bonds, and any other instrument of late. The second driver that is really driving investment flows and trends is that of geopolitical tensions. What we've seen through the Russia and Ukraine crisis is that other emerging markets such as South Africa has really come back into vogue. In fact, so much so that we're seeing offshore investor interest into our market, and really where South Africa has even been cited as a safe haven of emerging markets. So each ecosystem is subject to political concerns that form either overhang or an opportunity to your marketplace. So in the current market environment where you have political uncertainty in the current leadership in Brazil, geopolitical sanctions from a Russian marketplace, concerns that are coming out of China, whether it has political concerns or if it's just too big to ignore, you're really seeing shifts and flows. South Africa has deep liquid capital markets, and we're seeing that evidence through the flows coming through in our equity space in particular, and even in our bonds markets where we see high yield and people hungry for return on their investment invest into our country. So what the global macro looks like is really important to drive shifts and trends in the marketplace. Another area that has been an area or trend of noting is that in the rise of the retail investors. Retail investors globally have really been showcased probably about 2 to 3 years before the global pandemic, and then flows driven through the crisis in hyper volatile markets. What it has made us pay attention to is not only is there a shifting retail investor base and a growing retail investor base, that the marketplace has moved to trends and information access that will drive investment decision. Previously, where you had only institutional or qualified investors investing in markets, now you're seeing every individual really drawing attention and access to marketplaces. The retail investor, for example, has access to different kinds of information, such as even social media platforms or YouTube broadcasts or broad-based mediums where access to information is easily accessible. Access to markets and trade investments are really accessible, and people can go in and out of investment opportunities very quickly and on their own discretion. South Africa is a little bit of a laggard to that, and while we are seeing an increase in retail investment, we really have fundamentals in our marketplace that we have to address. Ease of access is one of them, and access to information, the qualification of our investors, and knowledge and awareness. So investor education is really important. And then finally, the cost of accessing these marketplaces. How do you do so? What we're also seeing through a rise in a higher retail investment base is a shift to new assets and investments. Where people were previously looking at stock markets, now there's plays in bonds markets, as well as, for example, in new digital assets such as crypto. Obviously, that has drawn more spotlight in the past 2 weeks as you see global uncertainty. You've also seen massive volatility. For example, the crypto market that has seen a surge and a run in the past 18 months, and an equally sharp move on the downside in the past 2 weeks. So it really draws then investor education as a high importance and imperative in terms of how you invest and allocate capital. The last shift and trend that I'd like to explore before we go on to how you access markets is on disruption in the marketplace. As an exchange of 134 years, we face disruption in many facets, either through the advent of new exchanges or shifts in whether you are trading in South Africa or flows offshore, or players in the marketplace who are not traditional exchanges but alternative venues and ways to access the market. We are also seeing a demand for high accessibility to real-time 24/7 trading markets. And then overarching in terms of all of this is, how do you deploy your capital? Do you save your capital? Do you invest your capital? If you invest your capital, what are the alternatives out there? So we have been faced with a lot of disruption over the past 2 decades. What that has made us do is embrace technology and innovation, rethink the models of access and how we reach investors, as well as become more responsive in product and investment opportunities. So that brings me to the status quo of the investment landscape for South Africa today. The investment landscape for South Africa is really one of vast diversity and liquidity. It showcases many opportunities that you as investors can target and access. Let's start with our equities market, probably our most deep and liquid market. The JSE boasts over 300 counters listed on our exchange today, of which almost 25% of that is dual listed. That means it is listed between ourselves and another marketplace. What that gives you is it gives you the opportunity to invest in South Africa, but have diversification opportunities or growth opportunities to international markets. It also shows that the interest goes between South Africa and other marketplaces and enhances the liquidity in our marketplace. Within the equity stable, we've also seen a rise in structured products, particularly in exchange-traded funds. ETFs are really tools and access tools that give clients like yourself or retail clients a real opportunity to access our markets in a very cost-effective manner and really expressing views in themes or trends. The ETF market is probably about 20 years old in South Africa and was started in terms of allowing exchange-traded funds access or investors access through exchange-traded funds in some of our main indices. It launched on top 40 indices and a few other indexes thereafter. And now what we're seeing is a high activity in the commodities ETFs, whether people want to play gold, platinum, palladium, or any of the others. There's high activity and liquidity in the commodities angle. We've also seen major innovation in the ETF space through getting access to international stocks. We often talk about the US FANGs, where there are stocks that are really stocks that resonate with a growing shareholder base. Facebook, Apple, Google, Amazon, Netflix, any of those and those staples. So we've got ETFs and ETNs that give you access to those stocks. We've also seen growth in new geographical plays, whether it was an ETF into China or any other market of interest. We've seen growth and development. And lastly, we've seen growth and development in ETFs outside of just equities, but even adding debt instruments. As people have also given more allocation and interest into ESG investing, impact investing has really grown in scale. ESG's options for environmental, social, and governance aspects, where those get prioritized for investment making decision. It sees more conscious allocation of capital and really speaks to what investors out there would be interested in. So ESG investing is growing and it's of high interest to the clients that we serve. The JSE's recently launched sustainability segment, which really encompasses issuances through debt as well as investment through some of our bonds, whether it's green bonds, social bonds, or transition bonds that we're looking to introduce. This really introduces options for investors to channel outflows to impact investing. And we've seen high demand in this space. So the opportunities for investment and the universe for product is really great and vast. The JSE has also had what we've called the Alternative Exchange, ALTEX, which has been a graduation board to see the growth in our small and mid caps really come to market and give you as investors opportunity to invest in the space. While there's been lots of mergers and acquisitions and opportunities in the small and mid-cap space to unlock value, we've also seen high demand in other markets to grow this segment. And we remain focused in terms of showcasing what investment opportunities are there in this segment. We work in terms of channeling and trying to bring new investments and listings to market so that our retail as well as our investor base, our institutional or retail base, can get access to these investments and really diversify their portfolios. Another area of interest for investors is really the angles you can play in the derivatives market. The commodities market is probably one of our markets that are closest to the real economy. Things like food scarcity or options to invest in terms of global markets really come to the fore when you look at our commodities market. And we've seen growing interest in this space. And then finally, just to elaborate on the FX market, our currencies market. I've spoken earlier about trends we're seeing in the crypto space. But what we are seeing is also high volatility in our rand. As we face investment opportunities in our marketplace, we're seeing this trends in terms of people interested in trading currencies. Also in our continent, we are seeing lots of interest in terms of hedging activity, where there's uncertainty in currencies across the continent or more trade opportunity in a volatile rand. There's high demand for products where people can make money as well as express investment views, and where you find volatility, you find opportunities for investment. As a potential investor of the JSE or in the South African marketplace, I encourage you to look at the diversity of investment opportunities out there. We have deep, liquid capital markets. There's a vast array of investment opportunities out there, whether it spans equities, Forex, ETFs, bonds, commodities. There's many options available for investors at the moment. We encourage you to get into contact with people like investment advisors, find ways to access the market, get to understand the dynamics and drivers behind the market, know the global connectivity of South Africa and the positioning of South Africa to some of the international plays. So there's options out there available for investors like yourself. How do you play these options? It really would come down to getting access to information, contact with your advisors or access to markets, and understanding ways in which you can responsibly invest. There's a few options that have been channeled to try and facilitate the investing into markets. Take, for example, the tax-free savings account. This has been a mechanism where you as an individual can invest or try and become better owners of your own savings and investment portfolios. The tax-free savings account really enables you to save either through investment in money market or through ETFs. And we would be continuing to work with policymakers to understand other opportunities to expand that universe, to enable and empower you as an investor to make good investment decisions for your future. We really would like to encourage better savings and investment for South Africa. Not only does this enable growth, but it also gives better democratization of financial inclusion so that each one of us can be commanders of our own future and really unlock the potential of wealth creation and savings that we could unlock for ourselves as individual investors, but for future generations to come. This also leads to a stem and a drive in what we would like to see for the economy. There's massive growth that is needed for SME development. Small to medium enterprise growth is key and critical to economic recovery as well as job creation. Through capital markets and allocating of capital through different investment opportunities, we all play our part in funding that growth. And then being able to share in a piece of that growth by investing and taking stakes in companies through listed opportunities or through investments that we can make in various forms. I encourage you to really get aware of the choices that you have. We have a diverse marketplace with deep and rich offering for each one of you guys to explore as well as to make key investment choices. There's many mechanisms or outlets in the ways that you can express these views, whether it is to get in touch with your advisors, reach out to different and various financial service providers that can give you access to market participants, get in touch with a deep array of retail brokers that are members of the JSE, as well as chat to some of your banking counterparts who can give you access to markets. Get better understanding and knowledge of what are the investment opportunities out there. The JSE tries to bring these investment options closer to you. We've recently launched an initiative called the JSE SA Stock Picks. What this does is it brings investment managers as well as market professional showcasing and awareness of the stock opportunities out there. We encourage you to subscribe and tune into some of these initiatives so you can get better aware as well as engage with market participants of the options and investment choices out there. So really what we're encouraging you to do is get to know your options, really think about the investment decisions, know that this comes with risks as well as opportunities to the upside, and make tangible efforts to understand ways in which you can channel your future wealth creation and investment opportunities. We want to see an economy that has greater financial inclusion. We want to see a marketplace that is diverse and thriving not only with institutional investors, but retail investors as well. And we want to make investment into our stock markets, into our different options, not just for institutions or high net worth individuals. We really want to make this a marketplace that is open and welcoming to all types of investors. Please reach out to people at the JSE, people in your ecosystem and your network through Moneyweb to just get more insights and interest into the marketplace. There's diverse opportunities and real rich commitment to growing South Africa and the economy that we serve. I look forward to an engagement with you, and we really would like to welcome and see you invested in markets.
Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from creditworthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
Thank you for attending day one of the Better Investor Conference hosted by Moneyweb. Stay connected with us throughout this event on moneyweb.co.za and the Moneyweb app, which is available for download on the App Store and the Google Play Store. You can also send your questions to our YouTube channel or email them to events@moneyweb.co.za. On behalf of Moneyweb, we'd like to thank you for being a part of the Moneyweb community. So we'll see you tomorrow at 9 a.m. for day 2 of the Better Investor Conference. For more insights and valuable expert advice from industry heavyweights from the financial sector. Thank you.